Good morning. Mindy has asked me to introduce myself. I'm Gretchen Sierra. I'm a principal in Washington National Tax at Deloitte. And we are here this morning for our fourth panel, I think, of the conference, Reforming Our Controlled Foreign Corporation Regimes, the second of the two panels on that topic. This one focuses on CFC distributions and stock sales. And since 1962, the US has prevented the double taxation of currently included CFC earnings through the PTEP system and its associated 961 basis. Having worked on the 2006 proposed PTEP regs, I can attest that the pre-2018 system was complex enough for us to wrestle with. And as we all watched 2017 tax reform start to unfold, I think we thought surely the system that was going to be defined would be simpler and more coherent. Instead, our authors posit in their paper that TCJA managed to make the PTEP system more consequential, orders of magnitude harder, and achieve results that were even harder to justify. As if that wasn't enough, TCJA developed another and parallel system to prevent the inclusion of CFC incomes with its own and complex set of rules. Against that backdrop, it shouldn't surprise us that our panelists in their paper have some thoughts about how we might begin again. While they have a range of proposals from small to large, the paper fundamentally asks a question that sounds both like overdue, and because I remember asking similar things like, gosh, this PTEP stuff is so complex. I wish I could, rewrite the statute instead of write regs. But they ask a question that's both radical and honestly overdue. Now that OB3 has made CFC look through permanent and nearly all income is taxed currently, do we still need the PTEP system at all? Their answer is no, and they argue eliminating it may do the rarest of things, which is give us something that is both taxpayer favorable and favorable for the fisc. So with that, I'm going to turn to introducing our panelists. I'm going to start with Eric, all the way furthest to my right. Eric Sensenbrenner, who's a partner at Skadden Arps. To his left is Azika Abramoff, who is legislation counsel at Joint Committee on Taxation. And then lastly, closest to me is Ron Dabrowski, who's a principal at KPMG and whose government career is so storied that he hit all of the branches of government. I'm a little jealous, as is Azika. We only hit two. So with that, I'm going to turn it to Ron. Yeah, that's right. We have time. We have time, Ron, to hit one more. Do that clerkship at the end of our career instead of the beginning.
Exactly. All right, I'll kick us off, kind of unpacking where Gretchen began and talk a little bit about the problems we face. One kind of caveat at the beginning, we are talking today primarily, actually exclusively, about corporate U.S. shareholders. So we are not addressing individual U.S. shareholders in the CFC environment. There are a number of issues that should be addressed regarding individuals in the CFC environment, but they would not give us the full day to have this panel. All right, three problems that are kind of framing what we're concerned about. First, we have currently two regimes addressing double taxation of CFC earnings or taxation of CFC earnings. We have the PTEP regime, as Gretchen unpacked. It provides a dividend exclusion rule. Again, we're trying to prevent the U.S. double taxation of earnings. There's a dividend exclusion rule. There is a gain exclusion rule that works through fairly intricate basis rules. The PTEP regime also has kind of certain penumbra, things that rely on the PTEP regime but carry out different policies. One area is the foreign tax credit. So we have the 960B and C rules, which govern the taxation of distributions of PTEP from CFCs to CFCs. So trying again to capture foreign tax credits and relieve double taxation on PTEP itself. The second area is in the subchapter J, foreign currency rules. So section 986C tries to capture FX gains or losses from the time of a deemed inclusion under subpart F or section 951 cap A and when the earnings are actually distributed, when the PTEP is actually distributed, we have kind of intricate FX rules that track that gain or loss. So, there is this anti-double taxation element, and then there are these other kind of policies that are carried through on the PTEP regime. Our second regime is Section 245 Cap A, our TCJA created fig leaf of territoriality. It is trying to prevent the first inclusion of U.S. income, so to prevent U.S. taxation on certain earnings. It has a dividend exclusion rule, 100% DRD. It also has a gain exclusion rule that operates through the 1248 mechanic and basically turns gain attributable to earnings into a deemed dividend that is then exempt. But again, doing the same job as 959, a dividend exclusion rule, a gain exclusion rule. There are also penumbra, if you would, under 245 Cap A, mostly addressing kind of loss issues. So Section 1059, in certain limited circumstances, will require a basis reduction or gain recognition upon a distribution of 245 Cap A earnings. Section 961D, a little more robustly, addresses the losses attributable to distributions of 245A earnings. And we'll unpack that latter one a little bit more as we go along today. Both of these regimes require a fair amount of tracking and tracing, and they have their own complexities. 245 Cap A is mostly built around the 301 regime, but as applied to 1248, we have venerable old 1248 regs that are doing a lot more work today than perhaps they were envisioned doing in 1966 when they were promulgated originally. Certainly the 959 regs, as Gretchen said, doing a lot of work today, a lot of complexity, and we've waited sort of 60 years and don't really have a settled package around distributions and bases.
They're still being worked on. They're eminent, yes.
Any day now.
Any day.
Our second sort of big picture issue that we're dealing with is we have different rate environments. So pretty simple and straightforward, well documented. Section 951 Cap A is a 12.6% domestic effective tax rate, a 14% global effective tax rate floor. Subpart F is working in a 21% environment. U.S. shareholders' sale of CFC stock will be taxed either at 21% or at 0%. So kind of big differences there. A CFC sale of CFC stock similarly will give rise to either 21% or 0% taxation. So a variety of options here. And importantly, the same economics. We're just looking at what's the CFC doing? What's it doing in its environment? How well is it doing? All these sort of differences in how you do business, how well you're doing business can affect your effective tax rate. The last item, and kind of a big driver of our discussion today, will be around losses. In the first instance, it's probably important to, how are losses created in CFCs? Hey, there's the traditional, you do bad in your business, you lose money, there's a loss in your CFC. I mean, that's great. That's only 1/4-ish of the story for CFCs. Second is I can invest in an asset, and maybe my asset's going to go down in value, and that's going to create a loss. So it's not an operating loss, but my assets might depreciate in value. The U.S. tax system views operating losses and built-in losses in assets differently, and that's going to be a big sort of theme that we work through here today. Third, when a U.S. person invests in a CFC, it's a bet not only on the business, but it's also a bet on the currency. And so FX is going to drive gains or losses in the stock that are just exogenous and outside of the business's control entirely, but nevertheless an element of potentially creating losses. And finally, this is kind of a creation of the U.S. tax system, but our 245A regime can create losses. So when I distribute 245A earnings, I reduce the value of my CFC. That might well create a loss, and in certain circumstances can create a loss. There is no basis adjustment there. It's a dividend, so there's no basis correction. So 245A distributions themselves can create losses. Now, as we discussed, Section 961D and 1059 police this space, but they police it imperfectly. The next area within losses, so stock losses get treated very differently in the U.S. tax system. When a U.S. shareholder has a stock loss with respect to its CFC, that's a 21% loss. It's in the full domestic environment. It is kind of the most valuable thing you can have in tax. It reduces, albeit at capital gains, but it is a 21% benefit. Interestingly, when a CFC has a loss on its stock, it is practically worthless. It doesn't do anything. Now, keep in mind that loss, that economic loss, is going to be embedded in the first tier CFC stock. The loss doesn't go away. It is kind of replicated. But for a CFC itself, with respect to a lower tier CFC, there's no benefit there. And that tension between 21% if it's in the US, 0 initially at the CFC level, drives a lot of behavior and is something to consider in this. The final area around losses is tested losses. So our 951 Cap A rules are basically global. So every US shareholder is going to aggregate its CFCs, look at all of its CFCs. It'll take all the positive tested income. It will take all the negatives, the tested loss. It'll aggregate them together. That net number is what gets taxed. This effectively means that my loss CFC, so it has an economic loss, as we discussed, its value will be reduced because it's had that loss. I might have a loss in my stock from that. That loss is being shared across the way with a positive CFC. There's no mechanism to sort of balance that out. So we are effectively duplicating losses in this tested loss environment to the extent they are used. Just a feature of TCJA, not really addressed. There were proposed regs that tried to address this coming out of the gates in 2018. They have authority issues. There's nothing in the code that sort of says this is a problem. There are also questions on just how they should operate and what the effective remedy should be. So that issue has stayed with us since 2017, still with us today, and something else we consider in our journey. So with that, why don't we move on to what we're going to do about all this mess?
Yes.
Thanks, Ron, and thanks, Gretchen, for teeing that up. So there's a lot of complexity, and when we looked at this, I think maybe as a starting place, at least for me, like thinking about all the complexity in PTAP, that seems like low-hanging fruit. Like there might be something we could do about that to simplify. I worked on the PTAP regs, and Gretchen, I had a similar experience to your experience working on the PTAP regs. We're not, by the way, the only people who've worked on the PTAP regs. There's like generations of people who've worked on various stages of regs.
For sure. At least you and I got drafts out. Yeah.
Yes.
I mean, every Treasury or ACCI, branch 4 personnel since 2004
has worked on them in some fashion.
Yes, indeed. We could put an end to that if we make some changes to the PTAP regime. Like big picture, one might ask, do we even really need to have this PTAP regime? I mean, my experience working on the regs was similar to yours, Gretchen. Like, why is this so complicated? Why do we have to do it this way? But a lot of that complexity is really from the statute. Like, it's not.
It is.
It's not chosen by the people drafting the regs. So, like, there's 10 different categories of PTAP. I mean, it's not because someone like wanted there to be 10 categories of PTAP. Like every single one of those categories has something different about it that has to be tracked separately. So like 965A PTAP, which is, from the transition tax, like currency gain and loss and foreign tax credits are reduced proportionately to the reduction for the 965 deduction. 965B PTAP, there's no currency gain and loss, but you're still reducing foreign tax credits in proportion to the reduction. So you can just go down the group, down each group and see like, what is it about this that makes it, necessary to track it separately? And then you have to track the PTAP by year because the statute says that it's distributed on a LIFO basis. You have to track the 904 basket because the statute says that the foreign tax credits are categorized by the 904 basket. You also have to track whether there was a 962 election in the case of individuals. You have to track whether there was a 1411 election. You also have to track the dollar basis for the PTEP because we need to calculate currency gain and loss on each category of PTEP. And you need to track the 961 basis adjustments as they go up and down. You need to track the foreign tax credits that are associated with the PTEP that accrue and stick with that PTEP as it's distributed up to the US shareholder. And that's in addition to the 245 Cap A system that also says distributions can be made tax-free. So one thought is that, yes, TCJA, by adding all of this PTEP to the system, certainly magnified the complexity of PTEP, added additional categories of PTEP that needed to be tracked. But TCJA also gave us 245 Cap A, gave us a different way to distribute distributions tax-free. And so I think it might be reasonable to ask at this point, do we still really need to have the PTEP system at all? There's three pieces to the PTEP system right now, I think, that make it necessary. So I want to talk through those one by one. And the first is 986C currency gain and loss on PTEP. So as you distribute PTEP, you track its dollar basis, and then when it's distributed to the US shareholder, you recognize currency gain and loss on it. For one that's already a little bit weird, we're kind of inconsistent in the way we do it. Like 965B PTEP, you don't have, there was no inclusion for that, but you don't have any currency gain and loss on it. 245 Cap A PTEP, though, there was also no inclusion. You do recognize currency gain and loss. Also, 965A PTEP, this was the transition tax. It was reduced to like a 8 or a 15.5% rate. So you reduce the currency gain and loss proportionately. Guilty, it's reduced by the 250 deduction, but there's no reduction for currency gain and loss. So we're kind of inconsistent. Also, for untaxed D&P, we don't track currency gain and loss at all. I think there's a policy question there, whether or not that makes sense. Like you might say there was no inclusion, so there shouldn't be any currency gain and loss on it. On the other hand, how did you come to have that untaxed D&P? Well, there was a US shareholder level calculation of tested income and tested loss, which were first converted into US dollars, the shareholder's currency. Before OB3, there was the reduction for the net deemed tangible income return, all of which was calculated in US dollars. And all of that might have come from attributes from different CFCs. So you calculate that, you translate it into US dollars, and say you determine that there should be an exclusion. There's $100 of E&P at the CFC level that is not going to be NECTI, so it's not going to be taxed to the US shareholder. But if that CFC is recognized or has a functional currency in like the Japanese yen, so it's tracking that 100 in yen, and then the yen goes up by 50% or 100%, does it suddenly make sense that the exclusion that you get under 245 Cap A should have doubled just because the yen appreciated relative to the US dollar? I'm not sure whether that makes sense or not, but I would just note we're not tracking currency gain and loss on that now. The other problem with tracking currency gain and loss is that when you distribute PTEP to the US shareholders, well, they recognize the currency gain and loss then, and that's, of course, very manipulable. So US shareholders can and do choose to only distribute their PTEP that has currency losses on it and not distribute the PTEP that has currency gain, or only distribute PTEP that has currency gain if it has enough foreign tax credits associated with it that you can use it to offset them, or only distribute PTEP that has currency gain in years when they have other excess credits that they're going to lose, so they can just absorb that gain. So it's not really, it's not really sort of like a wash to the US government. It's not like half the time the currency goes up, half the time it goes down, and it kind of nets out. Instead, people just choose to recognize losses and not gains. So one thing you might think to do is just stop tracking 986C currency gain and loss. You might think, on average, that'll just net out. That really will be a wash. Like half the time the currency goes up, half the time it goes down. But it'll take away the manipulability for taxpayers. They won't be able to choose just to recognize losses. And so that would address 986C, currency gain and loss. You also have 960B, foreign tax credits, which are foreign taxes paid on the distribution of PTEP up the chain. Right now, we essentially apply a tracing rule to PTEP. So we're looking back to see like what the original inclusion was that generated the PTEP, and that's how we characterize the foreign taxes that are associated with the PTEP as the PTEP moves up the chain. But we don't have to do it that way. We have a totally different rule for distributions that are disregarded distributions, and also for distributions that are treated as a 301(c)(2 return of basis. There we just look to the tax book value of the assets to determine how we characterize the currency, the foreign tax credits that are associated with those distributions. And that, opens up the door to tax planning as well, because taxpayers, if they prefer the answer of looking to the tax book value to characterize their foreign taxes, they could check open the CFC, for example, and have a disregarded distribution and characterize it that way. So as a starting place for addressing foreign taxes on distributions, you might think you want the same rules to apply to all three types of those distributions. And if you did that, you could start calculating or characterizing the foreign taxes based on the tax book value method, or you might decide you want a different method that applies to all three of these. But I think if they were consistent, that would take away some electability by taxpayers. So if you made that change, you also wouldn't need to track PTEP just to characterize the foreign tax credits. And then I think the last one is individuals. And so we said we're not going to talk about individuals in this panel. I just want to do a quick little footnote for individuals, because you do need to do something for individuals, at least by default. From an individual perspective, the CFC pays the tax. The individuals also have a subpart F or NECD inclusion. They don't have a 250 deduction. They don't have foreign tax credits. So at minimum, that's a second level of tax, maybe at a fairly high rate. And so if you didn't track PTEP for them, then when the PTEP are distributed, that would be subject to a third level of tax. Well, that's too many levels of taxes. There is at least one easy way to think about individuals, I think, and that is the 962 election. When individuals make the 962...
Which is not easy. 962 is not easy, but yes.
Well, so the goal of the 962 election is to treat individuals as if they own the CFC through a corporate U.S. shareholder. So the first level of inclusion is taxed at the 21% rate as if a corporation owned the CFC. It does get the 250 deduction. It does get foreign tax credits. And then when the PTEP or the earnings are distributed to the U.S. shareholder, they're just treated as if they were dividends being distributed to the U.S. shareholder, and they're taxed a second time. So that's the second level of tax. So I'm just going to throw out there that if we did make the 962 election mandatory, you would no longer need PTEP.
Yeah.
And since I think most of the time individuals make the 962 election anyway, that's probably not too large of a lift.
It would be hard to argue for corporate simplicity and make it more onerous on individuals. So you have to, to some extent, have to have some solution there.
Yeah, I mean, you can't just tax them three times.
Mindy?
Yeah, I'm not sure. I thought you were going in a direction of PTEP is too complicated, and so we need to simplify it. But is what you're saying that PTEP is too complicated, but we're stuck with it because of the statute, and we'd have to make other statutory changes?
I was just getting to answer that question.
You're right on time. It's perfect transition.
Yes, no, perfect timing. So at least for me, the takeaway is if we made those changes, if we eliminated currency gain and loss on PTEP, if we changed the way that we characterized foreign taxes on PTEP distributions, and if we fixed the problem for individuals so they didn't need PTEP to prevent being taxed the third time, we could get rid of PTEP altogether. Does that answer your question, Mindy? Yeah. So if we got rid of PTEP altogether, we wouldn't need to track the 10 categories of PTEP. We wouldn't need to track their 904 basket. We wouldn't need to track the dollar basis of the PTEP. We wouldn't need to track the foreign taxes associated with the PTEP. Instead, we'd have untaxed D&P, which would now apply to both what was formerly PTEP and what's currently untaxed D&P. We'd prevent double taxation with 245 Cap A and prevent double taxation on the sale of stock with 1248 and 964E, which recast the gain as a dividend to the extent of the shareholder share of the earnings in the CFC, and then allow that dividend to get a 245 Cap A DRD. So I think there is potentially some low-hanging fruit and enormous simplification in the PTEP system by simply not having it and just going down to having a single system to prevent double taxation.
Yeah, Mindy, I think the paper sort of sets out a series of simplifications, a few of which actually beg the question, should we just, once we make those simplifications and we decide that simplicity overrides what pieces of the PTEP architecture we're preserving, why do you need it at all, given 245 Cap A is sitting there?
And as much as anything, we have the two regimes, and I think we don't necessarily agree on everything. We probably have 6 views on every issue we discuss. But
I
I
asked
think
them to fight about that on the panel, but they refrained.
I think at least we're like, yeah, we can scrap 959 and just rely on the 245 Cap A architecture. Having been built out, it is doing, again, they're doing the same jobs, and 245A is doing it in a bit simpler way.
It's a simpler way because, look, it's just one step. It's untaxed D&P, it's treated as a dividend, it comes up with 100% DRD.
Yeah.
There's a thought exercise, I think it's fair to characterize it that way, in the paper that goes through really looking at the problems with 961, right? And sort of the places where you create uneconomic losses, you may reduce gain in ways that are inappropriate because of the 961 basis adjustments. And it sort of walks through a number of alternatives for how you could deal with that within the existing system, right? Through making adjustments to 961. And I think it sort of gets increasingly difficult and complicated is how I would describe it. And it sort of naturally just leads you to the conclusion, well, wait a minute, what about 245 Cap A? It's a little lonely today, right? I mean, after TCJA, we've got it. It doesn't apply to much, really, right? I think you said fig leaf at the outset, I think, Ron, of territoriality. Perhaps that's an approach and a regime that could be more efficient and more effective in terms of dealing with the double tax issue for our inclusion regimes.
And I want to go into that a little bit. So if we get rid of PTEP, I think that raises the question, do we get rid of 961, the basis adjustments, or do we hold on to them? You could get rid of the whole PTEP regime and also just get rid of the 961 basis adjustments completely. 245 Cap A would prevent double taxation. But you don't have to do it that way. You could also still have basis adjustments. And if you're doing that, it might make sense to sort of rethink what these basis adjustments are intended to do. Right now, Ron, you were describing how we double count tested losses. You use tested losses to reduce NECT, but they also create a built-in loss in the stock that the shareholder can get a second time when they sell the stock. So, you can do guilty tax rate arbitrage where people get, income inclusions from NECT that might have been, attributable to built-in gain in the assets when they acquired the stock. That's taxed at 12.6% when they trigger it and creates a basis increase, which creates an offsetting 21% loss on the stock. And you can do that fairly easily. You can buy a CFC with a bunch of built-in gain in the assets and set it up so you've bought it, 75%, 25% to do a granite trust liquidation, a taxable liquidation, and then check the box on the CFC. And you've now triggered the gain on the assets at 12.6% and a stock loss at 21%. So something about basis is not working right. I think if we were rethinking basis, we might want to go to the partnership model or think about going to the partnership model, or at least think about maybe reducing basis for...
Nazika, what do you mean by a partnership model? Just unpack that for a second.
Great question. So for PTEP and 961 basis, you only increase basis for the income inclusions to the U.S. shareholder. You don't ever actually reduce basis under 961 except for distributions of PTEP. So when the CFC has tested losses, you don't reduce for tested losses. When the CFC has other losses, you don't reduce for those. And when the CFC has other income that doesn't generate an income inclusion, you don't increase for that. So a partnership model would just increase for all income, increase basis for all income of the CFC, and reduce basis for all losses of the CFC and for distributions. I mean, if you started by thinking about just reducing basis for tested losses, I think that would be a helpful starting place because that would prevent double counting of the tested losses. It still kind of gives you strange answers when you have losses that aren't tested losses. Like you have an income inclusion that's NECT that increases basis that's taxed at 12.6%. And then if you have losses that are like sub-F losses that are not taken into account or other losses in the CFC that can't be used, like tested losses maybe that can't be used, that if that doesn't reduce basis, then the shareholder is going to get that at a 21% rate when they sell the stock. So that seems odd to be increasing basis at a 12.6% rate, but having stock losses be taken at 21%. If you try to move to the partnership model and just reduce basis for all losses, well, that sort of gives you odd answers too sometimes. Like if you're in a zero rate jurisdiction and you're paying tax, the US shareholder's paying tax at 12.6% or 21%. And then when there's a loss in the CFC, if the loss just reduces basis, well, they're paying tax at 21% on the income, but they're not getting the loss at all. So that also doesn't seem right. And I think there's not really going to be an answer where you either just increase basis for all losses or don't increase basis for all losses that gets you to the right place. Because really it kind of depends on what rate the US shareholder is paying. Like if they're paying 12.6% tax on the income, you should get the loss at a 12.6% rate. And if they're not paying any tax on the income because it's all offset with foreign tax credits, well, you shouldn't be able to take a loss in the US. Like the loss should be absorbed in the foreign jurisdiction only. And if you're just paying like, you know, a residual maybe 3% rate in the US because the rest is offset with foreign tax credits, well, you should get a loss, but you should take that loss at the residual 3% rate that you were taxed on the income. So I think the question is, how does one do that? One way you could think about conceptually is like start with the partnership model where you're just increasing basis and reducing basis for income and loss, but for losses, recapture the rate based on the rate you were paying on the income. And I think that would get you to the right answer, but that's really hard to do because you have to be tracking the rate for that CFC from the beginning of time, and you also have to incorporate the rate for lower tier CFCs. And then if you move those lower tier CFCs around, you have to like break apart your rate and figure it out and then put it back together with the remaining CFCs. So that gets really tricky. Another thing you could do is not increase basis by the full amount of the income or reduce it for the full amount of the loss, but instead increase basis just for the income equivalent to the tax paid in the US. So like if you end up paying tax at a 3% rate in the US and that's $30 of tax paid in the US, well, what's the income equivalent to $30 of tax? And if it's, I'm not going to do the math on the fly, but if it's $150 that generates $30 of tax, you would just increase basis by $150, even though there might have been $1,000 of income in the CFC. And then if you later have a loss, and if you had $1,000 of income and you lose all of that money later, you'd still have your $150 of basis that would still generate up to $30 of reduction in tax. So that would net out at the end of the day. And I think that would get you to the right place. That is also pretty complicated, though, to do. I mean, maybe not that much harder than what we're doing right now. We're already making basis adjustments under 961, so you would just, make basis adjustments by the income equivalent to the tax instead of the full income inclusion. But you might also sort of look at that system and notice, like, it's usually not going to matter that much. If there is $1,000 of income and you increase basis by $150, and then reduce it, right away when there's a distribution, you're often just not going to have any basis increases at all, especially like if we're in a world with PDMTTs and people aren't really paying that much residual U.S. tax.
I think you've managed to convince us we like your leading theory of getting rid of the PTEP system.
Yeah, it has tremendous persuasive value, I think, in terms of, as I said, it's kind of, to me, it's like a thought exercise, right? It's once you go down that rabbit hole of sort of 961 adjustments and really trying to make it work and make it track, it gets incredibly complicated,
Yes.
right?
Yes.
Which I think just, to me, sort of
To what end?
begs the
Like,
question,
yeah, right. Why are we doing this?
is 245 Cap A maybe a better approach? Is it a more streamlined approach? And so in the paper, we sort of try to explore that, right? And part of the question, I think, to me is, what should the scope of before even getting to the question of sort of using it to sort of track PTEP, to track, CFC inclusions and sort of, make that regime work, what should the scope of 245 Cap A be to begin with? Obviously, today, as written and as applied since 2018, it applies to CFCs, applies to 1050 companies. It also applies to pre-acquisition earnings of CFCs and 1050 companies. And so there, I think there's sort of a question as to, Ron said fig leaf. Do we have a territorial system where we sort of have NICD sub F that are sort of operating on the one hand as inclusions, and then we just sort of have a residual and everything comes back tax-free? It was either taxed when earned or not and comes back tax-free, sort of working hand in hand with 1248. Or as, Build Back Better would have proposed, I think, limiting it to the just CFCs, right? So only earnings that have run through the filter, if you will, of 951 Cap A. 951 would be subject to the 245 Cap A DRD. I think that's somewhat of an open question, and I think you could take either approach. But the one thing that, when thinking about the scope of 245 Cap A and its role, if we were to use it as a sort of a PTEP type protection regime, is dealing with the pre-acquisition E&P. How do you think about that? Obviously, you've got, there's an acknowledgement that, right, pre-acquisition E&P, you buy a CFC that's got E&P in it, you could pay out a 245 Cap A DRD. That would reduce the value, arguably, of the company, not its basis, because obviously 245 Cap A is divorced from many basis adjustments. You do have an acknowledgement of that issue, right? You've got 1059 was expanded, obviously in TCJA, to pick up 245 Cap A. You've got 961D that, at least in the case of losses, would reverse out 961 adjustments. As Ron mentioned at the outset, I think they're somewhat limited. I think they probably, in the most acute cases, deal with the issue, but you might think about, over time, that purchased E&P is still in the system and perhaps is reducing gain that would otherwise economically accrue to the shareholder. And so perhaps that is something that should be dealt with in a more holistic way than just the sort of, adjustments based on DRDs that we have, today. And it sort of led us to two different alternatives. I think the one first instinct was naturally, well, why not just treat it as PTEP? Now, notwithstanding what we just said about eliminating 959 and 961, let's say that regime was retained. If we just simply treat it as PTEP, that would compel basis adjustments, right, when it comes out. So, it essentially is like a true-up where you acquire a CFC, treat any E&P in the system at that time as PTEP, and then that should work, right? But I guess you still then need basis adjustments at lower tier levels to the extent that PTEP is down a tier. It kind of works 961A, you've got purchase basis on the outside, functions the same way, but it still would compel basis adjustments to the extent that PTEP is not at the highest tier CFC. And so I think we kind of naturally concluded, well, that seems like that's just reintroducing a lot of the complexity, need for adjustments, et cetera. And so then the second approach that we thought about with purchased E&P is essentially capitalize it. Just treat it as eliminated. So it's sort of wiped out, you know, the E&P is just kind of eliminated as of the acquisition date. So then you essentially have what's a non-dividend distribution, right? Sort of return of your capital, you've got bases outside. That seemed to us to be a more elegant way of you know, kind of holistically dealing with the purchased E&P point. And also just in thinking about that, then we started thinking about other, you know, places, and you'll see in the paper we sort of discussed some more technical changes to the rules to kind of deal with 1248, and sort of 1248, as Ron said, and I like the way he said it, you know, it's sort of the second piece of this, right? Because then it picks up 245 Cap A with respect to gain. But of course, there are a few places where even today, 1248 doesn't align with a distribution of earnings in terms of ECI, for instance. You get a 245, you know, little a DRD for that, but you don't get that included in your 1248 amount. So I think there would be, if you were thinking about 245 Cap A as kind of the model for previously taxed earnings, you know, CFC inclusions, I think you'd want to also think about a even closer alignment with 1248. In other words, that 1248 was aligning even more closely with the treatment of distributions out of the CFC, treating gain in that manner.
And it's really breaking 245A from the 301 model to the 1248 model, where you track based on holding period. I mean, that's the rub of it, but it is wildly different from our kind of traditional origins in Section 301 and 316.
It certainly is. And thinking about the sort of purchased E&P issue, I mean, it kind of goes to a point that when we were developing this, we all talked about, which is that either system actually works fairly well if you look at it sort of during the kind of the running course of ownership. It's sort of the transition issues of on the front end, like purchased E&P, and then on the back end, kind of what happens on a sale. And you know, the observation is, you know, some jurisdictions have mark-to-market regimes. You sort of mark on the way in, mark on the way out. We have something, you know, similar. Obviously, 338 is something that could be thought of as a model as well to deal with some of these issues.
Are we segueing?
I was trying to.
Oh, that was elegant.
It's very smooth, yeah.
So with that, you can tell we haven't quite practiced that. But yeah, so we have a 338 model, right? So a qualified stock purchase, we're going to turn a stock sale into an asset sale. And because we're tinkerers, you know, we look at and we recognize that a lot of the problems we're discussing here, as Eric just teed up, are on either the disposition or the acquisition of a CFC. And so that's, you know, either on the seller side or the buyer side, somebody's not quite happy, they're economic and other kind of, I don't know, gaps and mistakes and things that can be rectified. So we've come up with a proposal for, we call it a mandatory 338 election, but recognizing that mandatory and election are oxymorons, it's really like a mandatory 338 rule of some sort. So again, just big picture to ground in 338, you know, it sets up in the regs this kind of elegant fiction of old target, you know, our CFC that we're selling is going to sell its assets to new target, and the purchaser is going to require new target. So in CFC land, our seller has had its CFC sell all its assets, generally going to be in 951 Cap A, you know, kind of 12.6% happy land, maybe in subpart F, maybe in exempt, but basically going to be in the CFC operating income rules. The purchaser is going to get kind of a clean basis. It gets a fresh new company, stepped up basis, inside outside basis parity, just kind of very clean and kind of aligns to this holding period in 245A. Like everything is just sort of starting anew. So we've thought about at least some adaptations from the current 338 regime to what this mandatory 338 would look like. So First of all, mandatory, and probably mandatory for a U.S. seller or a U.S. buyer. It could be triggered by either side if you have enough. What is enough? So we'd probably look to changing the qualified stock purchase rules. It's currently an 80% purchase by a corporation. Maybe you bring it down to 50% or greater than 50% to align with CFC status. So, when a majority CFC shareholder or group of shareholders acquire, that ought to trigger it.
And that may also depend on what you do with 245 Cap A and whether you limit it to CFCs. If you do so, do you make an election for 1050 companies to be treated as CFCs? Kind of getting those to align is probably an important aspect of this as well.
Yep. And you might want to continue down the road, look through partnerships to corporate owners. Currently partnership acquirers are bad. That could be addressed as well. As for the consequences of this mandatory 338 rule, the seller side, as we discussed, your ending results, you have basically the operating subpart F and 951 Cap A rules get to act on the income generated by the deemed asset sale. You'll get a basis increase or exempt earnings, and that will govern your gain recognized on the stock sale. So you still have two levels of transaction at the seller level, but the first CFC gain rule will be kind of the primary operating rule. The interesting issue comes for non-selling U.S. shareholders. So if I have a U.S. shareholder, my 60% owner sells, my 40% owner stays along, what happens to them? They're kind of along for the ride, because that deemed sale, or at least as we've constructed it, that deemed sale is still happening. They have inclusions, they have basis adjustments. The regs currently kind of contemplate this and have a rule for retaining EMP to trace to that shareholder so that, for example, 1248 could operate and the distribution rules could operate. Probably need something like that, but I mean, it's an interesting issue on how much you want to build out.
But for the 40%, you're accelerating years of inclusion.
Correct.
Yeah.
Yeah.
Wow.
Wow. And
That's bold.
that's
10 plus
that's
years.
sand. That's sand in the gears.
Yeah.
It's a mandatory election.
But there is.
The 40%er is not so happy.
Well, there is. It's not good to be a minority owner.
Yeah.
There are a lot of, and again, it's sort of an eyes wide open and set up the rules. Transition will be a huge issue here.
Totally.
But nevertheless, that's something to consider here, and there would have to be a lot of build out in that space. On the purchaser side, again, they get a clean start. Just kind of a new corporation, inside-outside basis parity, no EMP, no built-in gain, no built-in loss in assets. A lot of the distortions we've talked about and been concerned about are just not going to arise. So it does seem to cure a lot of things. And in the normal course where we're dealing usually with, not situations with minority U.S. shareholders kind of hanging around, it's seems like a pretty robust solution. I'll actually maybe go into this a little bit. There are a bunch of second order considerations that we get into, and then Eric in the final part is going to touch on some of these as well. Let me just highlight the first one at least. There, as I discussed at the outset, there are FTC rules that kind of work in conjunction with all these different rules. In the context of a 338 election, there are two things we're focused on. There's 338H16, which applies on the seller side, and basically says we're going to disregard the source and character created by the 338 election, so the deemed asset sale, for purposes of determining the foreign tax credit limitation. On the buyer side, there's section 901M, which says, hey, we're basically going to disregard that basis bump for purposes of determining your effective tax rate in the CFC going forward. Very complex rules. Interesting, they were not changed in TCJA. They've never kind of been reconciled with, like, what do we do now in this TCJA and in the guilty environment? They're both rules that can probably be looked at again. They're very complex. They're probably right, But for a lot of these things that we talked about, like 986C, 960B, is right worth it in this context. And in this global rate environment, when we're relatively low rate, it's a 15% kind of pillar 2 world out there. A lot of taxpayers are excess credit. We'll see where OB3 leaves taxpayers after the limitation changes, but if we are in a systematically
There's still largely excess credit, just
rule,
less so. Yeah.
yeah, if we are in a systematically excess credit rule, a lot of these things which were built upon, the old 902 regime with creating high tax pools and elective repatriation was a really big issue. Not the same case anymore. Is the simplicity we can get by getting rid of these rules kind of worth it for the FIS? So something to be considered.
Can I just raise, I think there's a thread going through, both of these recommendations. Like E&P could be much more of a shareholder-based concept rather than a CFC level concept. And that's sort of what we're talking about when we're talking about limiting purchased E&P. So you can't have a dividend out of purchased E&P, or you could limit E&P to not only say you can't have a dividend out of purchased E&P, but just to the shareholder share of E&P. So they can't have a dividend out of more than their share. Like they can't take other shareholders' shares of the E&P. And then once you start to think about E&P as a shareholder level concept, like the mandatory 338 becomes much more sensible because it's already preserving the minority's share of the E&P. Like that's sort of already built into the 338 election. And so it just becomes a concept where like for each shareholder, if they only have a dividend out of their share of the E&P, you have much less concern about uneconomic distributions. And then even though that itself is more complicated, that simplifies so many other things. Like you don't have to worry about holding periods for dividends anymore. Don't have to worry about 1059 anymore. So I just wanted to raise that.
Yeah, I think in some ways it's sort of like really doubling down on 1248, isn't it? Because today that really is sort of the model of tracking very much the what happened on the shareholders' watch, right? Sort of what is the E&P that's sort of available for the recast for them, right? And the question to my mind though is sort of still dealing with the minorities, and if they're not having an inclusion on the deemed asset sale, how do you think about the E&P and adjustments to that for them? Because I think there's still going to be some disconnects there.
Yeah,
we all tend to think in the model of CFC is 100% owned, right? It's a big, U.S.-based group. That's kind of that probably is in reality. Although for many practitioners that may feel like the whole world, that's probably maybe even a corner case, right? I mean, in terms of the real world.
Probably a shrinking part of the world with private equity and other investment structures.
We see more complex JVs. Yeah, please.
So I think Azika was the only one here for yesterday's discussion on the first round of the first CFC
Yeah, where they
panel.
suggested
We were
getting rid of-
listening remotely.
sorry,
You have a
okay.
very
Oh,
slick,
Live, live.
very
We're in the
slick
room.
YouTube. We were on.
So,
Yeah.
just
remotely.
So that panel, they were talking about getting rid of EMP also, but I think differently. They were talking about how the concept of EMP doesn't make sense, and maybe substituting taxable income instead is, I think. Right. So how is if we did that, then how would that slot into what you're talking about?
I mean, I think there's a reason E&P is different than taxable income. Like there are things included in E&P that are specifically excluded from taxable income, and there are timing differences for taxable income that don't apply for E&P. I mean,
but hold on, I just want to, just for a minute. So I want to go back to what the prior panel said. So I thought, and maybe I'm wrong, Mindy, so remind me, but I thought they were fundamentally asking, does the E&P limitation for subpart F still make sense? In a world in which you have guilty and the like, and does that, so it was really driven, I thought, by starting with our origins in subpart F as something like, we should be thinking of it as the end of deferral and therefore something akin to a dividend, and that's why we were looking to E&P. And in the world order where we have this guilty system that's really about income, should we be going to income? Did I follow I want to make sure you and I are interpreting the comment similarly. Yep.
I'm not sure I followed it completely,
Yeah.
but in order to get rid of the EMP, they weren't just saying get
Yeah.
rid of the EMP limitation.
Yeah.
I think. Can someone else help me out?
Well,
No, I think they were saying
there is
both.
the tension between the guilty, which is
Yes.
EMP agnostic,
Yes.
and subpart F,
They're
which
saying,
is
why do we have these two different
EMP
systems?
based.
Yeah, right,
But
right.
like in our world, at least, where we're concerned about gains, and EMP is going to be the economic,
Yeah.
kind of the more pure economic, and EMP will be reflected in gain or loss in stock or deficit in EMP. Like we probably need to retain the EMP system.
And we're
there.
actually talking about distributions of earnings in this context. So to me, it's a different. That's why I wanted to go back to the core comment. To me, it seems different, but I might be wrong about that. I don't know how you interpret it as you.
I mean, you could definitely get rid of the subpart F EMP limitation, but still keep EMP. I mean, like there's two ways that you can prevent gain on the sale of stock. Like you can have an increase in basis, or you can apply 1248 and recast it as a dividend, and then just apply 245 Cap A. You don't have to have both of those systems. You could just have one or the other. And so maybe they were leaning towards basis adjustments, and I think our system leans much more towards applying 1248.
You sure?
Go for it.
We need questions.
Ron,
so,
you were
yeah.
saying,
Uh-oh. Not if it's for me.
it is. Ron, you're saying you still need EMP. I think you're just saying you need to keep track of EMP because you need to know which dollars that come out
Yeah,
as
I
a
think it's
dividend
easier
before
to
you
see
get
in
to
the
the gain.
gain context. Like, if we're still going to exempt fogey, right? Like, if it's taxable, that's not
Yes.
taxable income, that's exempt income.
Yes.
But like, we need to track those earnings because
Yes.
that gain attributable to fogey earnings needs to be exempt. And
Yes.
so, like, I think we're tied to EMP, or else you're going to be
I mean, you can just
expanding your
exempt
concept
it.
of income to not just taxable income, but
Yes.
broad income, which is
Yes.
basically EMP.
Yes.
So,
Yes.
I don't know.
I
Well, for
didn't
as
know
long as you're using a deduction to exempt it, yes.
Yeah. In the 245A kind of paradigm
Yeah.
that we're discussing.
they might have been recommending a participation exemption yesterday, because if you get rid of EMP, how do you know what your 1248 amount is? And if you're not going to measure your 1248 amount, are you just going to say all gain is
Right.
tax-free?
Yeah,
Not to
we're
mention, it's going to
essentially
continue to be
talking about
relevant
different
once it crosses the border. And so, I don't know, just
Yeah.
Now we have
if you're
Paul
not
with the mic.
tracking it offshore,
Now
it's
it's
going
about
to
to
be
go
a lot
downhill.
harder
Paul
to
was definitely here yesterday.
it
So
up
Paul, what did they
on
say?
No, I think they were primarily focused on the EMP limitation.
Yeah,
but,
that's what I thought.
my question with the seller side of the mandatory 338, I take it you would apply that when there's losses as well, right? And that's one of the main features of applying it to sellers, so that they would be getting their losses as tested losses, presumably not as stock losses, right? And that would be true both at the second tier level and first tier level, right? So it would benefit
Potentially.
some taxpayers and disadvantage the oil companies, but that's okay. But when there's gains, do you really need it to be mandatory? Or could you have it be mandatory for the acquirer, but not for the seller? Let the seller decide whether they want to have stock gain
Yeah.
or
This is getting
well,
into
or
your
asset gain.
piece. And
Yeah.
do
It's a
you-
great.
Sure,
wanna-
yeah,
you
you
wanna
want to
take-
go there?
Yeah, we should. This is the last section, right?
It
Yeah,
is. So
Can I just make
go
a
ahead,
quick,
please.
Paul's comment is where all simplicity goes to die, right? Which is to say, here's a great idea, mandatory 338 will simplify everything.
on one side,
but
though.
only
Yeah.
do it some of
Yes,
the time.
yes, yes.
And so I just can't help but react to that, Paul. Apologies.
I mean, it's already true that it would only be some of the time, though. Like, I mean, we only propose it if there's a more than 50% sale. Like, if a 10%
Good comment.
sellers.
To be
Yeah,
sure.
good comment.
To be sure. The other thing I just sort of observe, and I know you guys have more to talk about. I sort of feel on the one hand like this is really compelling, the stuff that you guys have laid out, and sort of I hear as I'm sort of processing this real time what is potentially breathtaking in the simplicity it could deliver. Truly. And then I feel like I'm Charlie Brown with the
Nicely
football.
done, guys. Your proposal is breathtaking.
Well, hang on a
In
minute. That's-
2070.
I thought I was using flowery
There was
language
a
in the
but.
beginning.
Hold on, it was qualified.
Right.
Keep going.
Mindy, note that, okay?
Because then I hear things like shareholder level E&P accounts, and I hear things like partnership model, and I think that may be lots of things,
Yeah.
but it sure as heck is not simple.
Yeah.
So I guess the question.
But those aren't critical, right, to the court. The paper fundamentally is proposing some more incremental within the system changes, and then starts to go further, right? You know, partnership, and then say, hey, let's just blow up the whole damn
So,
PTEP system.
fair
So,
enough. Thanks, Gretchen. Yeah, and I agree with that. And it is clearly a line drawing
Yes.
exercise, as you know.
Yes.
And just because I can't help myself, I'm going to make one last very quick comment,
Yeah.
which is to say, if we are going to have a foreign tax credit system, we cannot, in my view, adopt the notion that income that is fully taxable by the United States but sheltered by credits is equivalent to exempt income. They are not the same. And Azika, that's in reference to a comment that you had made that somehow income that is sort of taxable, not nominally taxable, but sheltered by credits is sort of not, it's basically, the US is not really taxing it effectively. I'm putting words in your mouth. So you're welcome to push back on that. But that's not relevant to your panel directly. It's just, I take umbrage to the notion that E&P or income that is sheltered by credits is the equivalent of exempt income.
I mean, I do think that they are the same from the perspective of the US fisc. Like, if you have income that's not taxed in the US and then there's an offsetting loss, the offsetting loss also shouldn't be absorbed by the fisc. So from the fisc
we just
perspective,
we agree to disagree on that.
Yeah, your comments in the paper on
the
that are really
foreign
interesting.
country will recognize
Like
that
your point in the
loss.
paper is really interesting, which is that we suffer the losses, but not just because of the nature of taxing jurisdiction, right? Which is really what we're doing. We are not suffering the income turnaround. We're not getting the benefit of the income turnaround from a FISC perspective. We're giving the credit if their rate's high enough, and yet we're giving the loss in every instance.
Yeah.
So I totally agree with your notion of the credit. I also thought that was a really interesting observation. And how do you kind of reconcile them? I'm lost. I'm kind of left in the middle. But I want to go back to Paul's comment. Can you repeat your comment one more time so we can not lose the thread? You said, how about we do the 338 on the buyer side, but we don't do it on the seller side, correct?
It's elective on
It's
the
elective
seller
on the
side.
seller
Where
side,
there are
sorry.
gains, you'd have to make it mandatory where there are losses,
Yeah,
right?
yeah, understood. Or it fails.
Actually, you wouldn't have to make it mandatory where it's a second tier or lower,
yeah.
because you would always choose it, presumably. Unless you're a financial institution, Ron, the one thing you misspoke on is that second tier losses are available for financial institutions. They're just not available for if you're not in the financial services
Yes,
business,
they're always in industry.
and
Yes.
that's not
Yes.
a small segment
Not a
of
small
the
segment.
CFC world.
Most people
so
do not
don't
want their
forget that.
CFC. They're not very valuable. But let's come back. So can we respond to, and then go into that last section? Eric?
Sure. Look, in the last section of the paper, I think it's really very interesting. So I just have to say that. We consider, well, what if we don't have mandatory 338? Just generally, how should you be dealing with gain on CFC stock sales? And we've got the 959 and 961 regime that sort of deals with past earnings that have been subject to tax, right? Okay, so that kind of works because there's obviously a pool of E&P that isn't taxed as a dividend. You've got basis adjustment. For the past earnings that have not been subject to tax, I may have misspoke. Past earnings subject to tax, you've got 961 adjustments. That's sort of excluded from the gain calculation. Past earnings that have not been subject to tax, you've got 1248. I think it recognizes a fundamental principle that that the gain is effectively economically the same thing as the earnings give rise to the gain, et cetera. And that then leaves you with sort of how you treat what we termed residual gain, just made the word up. It's not wedded to it, but we needed something to identify kind of the economic gain. In some ways, it's kind of the true economic gain over and above the earnings that are in the entity. And today that's 865A, residence-based sourcing, U.S. source, capital gain. Is that really appropriate? And what occurred to us is really no different than the elements of gain embedded in stock for past earnings. Really, your residual gain is also a reflection of earnings, right? Fair market value is an expectation around future earnings or future earnings growth. The RON 338 sort of model reflects that your outside gain in stock is sort of the equivalent of the inside gain in the assets, but they themselves are also a function of earnings. That's fair market value, right, is sort of future earnings. And so maybe we really should be taxing that residual stock gain in the same way that earnings would be taxed if and when earned in the future. You're really just accelerating a stream of earnings from the future if you compare a baseline of continuing to hold the CFC stock versus selling it today. It's just an acceleration of that income stream that you would expect to earn. And so we started thinking about whether you could have sort of an expanded notion of 1248. Indeed, you've got sort of 245 Cap A working in connection with 1248, but maybe that residual gain itself should also be taxed like earnings, which then led us down a couple of different pathways as, well, how do you basket it? Okay, so it's going to be obviously foreign source. You're going to treat it as earnings, ordinary income, not capital gain. Then sort of what do you do with like the basketing? How do you treat it? Should it be taxed as net CFC tested income? Should it be taxed as subpart F? Should it be some other category of income? And I think that, there's some hard questions in there in terms of, you could, for instance, we propose a couple of different ways you might think about it. You might sort of take an sort of as actual approach, which would be like, say, looking back 3 years and, looking at the income profile, how much subpart F, how much, NICD. That's pretty rough justice. Another approach would be simply to treat that residual as CFC tested income, thinking that that's kind of the residual, category of sort of all earnings are falling into that unless they're subpart F, and keeping in mind, of course, when they are in fact earned on the buyer's watch, then it's a different taxpayer, different item of income. It will be fully available to be tested through the inclusion regimes, whether it should be taxed as CFC tested income, subpart F, et cetera. And so there's nothing necessarily that's being lost there. If you're saying that there's a sort of a quality of income that we want to tax in a certain way and we don't want to let it escape. And so it then sort of took us to this notion of, well, what about foreign tax credits? I mean, the one thing we know about these hypothetical as yet to be earned earnings is that they will never be subject to tax. And so do we need to ensure that they stay in sort of a separate segregated basket, like a treaty basket, sort of a model to ensure that they don't sort of have an impact on tax credits and other baskets? Or might you say that it actually, by putting them into a basket, could alleviate timing concerns? Because after all, what we're really doing is taking that gain and sort of treating it as though it was income, and over time you would expect sort of timing issues to reverse. So I think there's a couple of different approaches there, but I think the fundamental notion, I appreciate it's fairly radical, of a sort of prospective application of 1248 with respect to that residual gain is at least something worth thinking about. If what we're really trying to do is to align, and this is kind of going back to yesterday's panel, kind of trying to align like our inclusion regimes of how we tax income earned through CFCs with shareholder gain on sale, for instance. I think that there's a place where you really could articulate a rationale for trying to like fully align those and to treat the gain as if it was earnings.
And to Paul's point, there would be symmetry on kind of looking through stock gains for losses. So,
Yes.
So your losses now go into a look-through environment, and the question is, do you want to push that into the foreign tax credit system?
Yeah.
So I mean, it's rate, source, and character. Are kind of the three things. Rates, I think we feel generally as a group more aligned toward. You can see the argument a little bit better. The foreign tax credit and kind of primary versus secondary jurisdiction, it's a more complicated discussion. But again, the parity at least, and removing incentives to have losses being more valuable in the U.S. system, in the U.S. than gains is something to consider, and again, trying to take tax out of the equation and make it more neutral is a goal that's worth thinking about.
That, I think we're out of time. We're a little bit over. Were there any other questions?
We're in Q&A time.
Yeah, we're a little bit over our comment time.
Oh,
Do you know what I mean? Any other questions? We do have time for that, obviously.
Going back to the 338 piece, I guess I'm curious if you get a dramatically different answer requiring a 338 election versus, say, in the case of a minority shareholder or something coming in, just having them reduce their purchase basis, with the idea being that they're not going to recognize gain for purchased EMP because of 1248 and 245 Cap A. I guess maybe the concern would be if there are future losses, then maybe you would end up not being able to recoup that EMP. But otherwise, it seems like you get to. Am I thinking about it correctly that you roughly get to the same place?
I think
On the
Two-
purchaser
Yeah,
side,
things.
on the purchaser
Yeah,
side,
so,
you
so a
might.
buyer comes in and they, what's the mechanic? Just what's our launching point?
Oh, sorry. To the extent you don't want to do a 338 election as
Yeah.
the buyer,
I'm the
if
buyer.
you just if you just reduce your
Oh.
purchase basis by the amount of the purchased EMP with the assumption that you're not going to ever recognize gain on that, it's either going to be 245 Cap A or 1248 and then 245 Cap A, and so you don't really need.
Is this
the
more akin to
purchase.
your elimination of the
Yeah.
EMP? Yeah, I think,
Yeah.
so maybe you should just repeat,
Yeah,
yeah.
it's a flip
It
side
kind
kinda,
of feels like it's very similar to
Yeah,
your
it's
elimination of the
in
EMP.
essence capitalizing the EMP, sort of just eliminating the EMP. So it's a different way of coming at it
Of coming at it, but the
mathematically.
same
But it's
thematic.
245 Cap A wouldn't apply. You keep your basis. Alternatively, you could reduce the basis and have 245 Cap A continue to apply.
Yeah.
Right?
But you're right.
Yeah, and I guess the
think
thinking
that-
is like, do you want to track EMP at the shareholder level or at the CFC level? If you're tracking at the CFC level, then you sort of impact the pre-existing shareholders, whereas you can adjust your basis without having to do that. Was all I was.
Yep, and that is already a taxpayer shareholder specific attribute.
Yeah.
Right.
And you wouldn't, you're right, you wouldn't be able to get your losses if you had losses in that instance. And I think the other place where that might create problems is if EMP is not shareholder specific, you can still lose it if someone else like does a redemption and that sort of eats up all of the EMP, like the EMP that you thought you were going to be able to get, you might not be able to get. But otherwise, I think that works. It's an elegant solution because, it just, instead of using basis to prevent gain in the future, we just use EMP to prevent gain.
So my ears perked up when I heard that there was a way to do tax arbitrage with the stock loss that you mentioned at 21%.
Don't quote me on that.
And then the
But-
foreign,
Yeah.
I just,
That's been well documented by others. Okay, so that's
I just think
It's out there in the literature.
It's out there quite a
so
bit.
I wanted to
Yeah,
ask,
many
I
people
wanted to ask
commented on
Thomas
that.
a little bit more
There's
about the
many ways to
mechanics
do that.
of
Yeah.
that. So the rates that you quoted, I think, were like 21% on the U.S. side, 13% on the foreign side because of NECT, if I'm understanding, like roughly. But so the real arbitrage that occurs. So from the firm's perspective, the foreign country's tax rate is also important, right? So like the actual difference depends on the foreign country's tax rate. Is that?
I mean, so a caveat, like the way I was talking about it was with the check the box election.
Okay.
And so the foreign country wouldn't see that. So the foreign country, at least in the scenario I talked about, the foreign country isn't going to tax that income at all.
Oh, wow.
Instead,
At that time.
At
They
that
will as
time.
operating income over time, but yes,
That's right,
at that
yeah.
time.
So instead, what happens at that time is checking open causes there to be a 331 liquidation, which is taxable at two levels. It's taxable to the CFC, but just for US tax purposes. They'll recognize gain on their assets, and that gain would be NECT that's taxed to the US shareholder at 12.6%. And there's no foreign tax credits there, again, because the foreign country doesn't see the income, so they're not taxing it. So the US shareholders tax on the gain at 12.6%. They get a basis step up equal to the gain. And then they have a stop loss by the exact same amount as the basis step up because they started with a fair market value basis. But the stock loss is at 21%.
So the future taxation of the foreign country is going to be relevant? So like the arbitrage is something to do with the present value?
I
of the
just think
future?
it's something that's built into TCJA, and people have marveled at ever since the legislation became public law, which is that you had, in order to have a full inclusion system at reduced rates, you effectively, and that ends at water's edge, and the US is still being taxed at a higher rate, roughly double, then you had this problem where attributes were being created on US shores that were more valuable on US shores than the income inclusion was being taxed at, that CFC income was being taxed at. So this is something that's been well, I mean,
It's endemic in the
Yeah.
system, and
It's
look,
just
it's
built into it,
necessary
unfortunately, yeah.
to the extent you're going to distribute those earnings out, right? You need to have a full dollar
That's right.
basis increase. The difference is where you're not distributing the earnings out, and instead you're taxing gain or loss on
Yes.
the stock on the outside. That's where I think the alignment
Yes.
in the 1248 model with a sort of expanded notion of 245 cap A could be really quite interesting, right? Because I think it also can tend to solve that that distinction where there's, you need to have the basis adjustment to be able to get the earnings distributed, right?
You need something
Yeah.
to let you distribute the earnings without a second level of tax.
That's
Right
right.
now, we use a
Yeah,
basis
okay,
adjustment.
fair enough. In the current
Yeah.
system, you
Yeah.
need to have the basis adjustment,
Yeah.
and it needs to be a full dollar. I mean, the policy call was made in Section 250, right? The fact that it's taxed at a lower rate is sort of neither here nor there in terms of how the basis adjustments work, right? It's fully taxed income at whatever rate it's taxed at. The full dollar, if you will, was taxed, so you need a dollar basis increase. Again, it works fine if your model is
distributions are great.
distributing the earnings, that all
That's
works
right.
fine. If
Gain
it's
is
gain or loss,
problematic.
it doesn't
Elective
work so
gain
well.
is the
That's
worst of
the
all.
difference.
That's right.
Elective loss.
We should be taxing the gain as distributions in all cases.
That's time. Thank you.
Okay.
Thank you.
Thank you. Cool.
Good? Oh, now you can hear me. Hello. Kick it off? Okay. Ooh, I'm going to try to talk not so loud. Hi, everyone. I'm Elena Patel. I am the co-director of the Urban Brookings Tax Policy Center. I'm also a senior fellow at the Brookings Institution. Thank you to Kyle and AEI for hosting this great event. Today and in this session, we're here to talk about the way we tax international businesses and the paper that these four have written that sets out a series of alternatives that they call moving to market. So I'm going to start by just introducing the panel, and I'll set a few framing remarks, and then we'll have some kind of back and forth questions up here, and we'll leave 10 minutes at the end for questions for folks in the audience as well. So I'll go in the order of the stage. So to my immediate right is John Vella, who joins us from across the Atlantic. He's a professor of law at Oxford. He also directs the law side of the Center for Business Taxation and studies how we tax multinationals. Next to him, everybody should know Kyle, our host. Kyle Pomerleau is a senior fellow here at AEI. Before that, he was chief economist at the Tax Foundation. Next to him is Alan Cole, who is now a senior economist at the Tax Foundation, where he works on business and cross-border tax. And then all the way at the end, we have George Callis, who is founder of Callis Strategy Group. Before that, he was executive vice president for public finance at Arnold Ventures. And before that, he spent 15 years on Capitol Hill as a senior tax counsel to Ways and Means and Speaker Paul Ryan. So like I said, I'm going to begin the session just by laying out the problem and some context for all of the panelists to weigh in. So over the last 15 years, we've reformed international taxation more times than in the previous 50. In 2013, the OECD launched its base erosion project. In 2017, we passed our own corporate tax reform that included rewritten rules for multinationals. The OECD rolled out 2 pillars in a global framework in 2021, after which dozens of countries adopted the global minimum tax. And yet, by almost any standard, the system still performs poorly. The question this panel takes up is why? And the answer that the paper offers is that the continued patching of the US tax code is really unlikely to fix this. So that's a problem of architecture in the corporate tax itself. So to describe that, I'm sure everybody is familiar with these tensions. Today we tax business profit based on where a company produces, so where its people, its assets, its IP, and its legal entities sit. The difficulty is that all of those things are mobile, and so a company can move them, or at least move them on paper. That means we get the problems that we've spent the last 2 decades trying to fight. Profit shifting to low tax places, real investment being pulled alongside that, and a tax code that's grown enormously complex trying to police all of this. So in a moment, I'm going to hand it over to John, who's going to talk us through how the current system performs against standard criteria and whether the global min tax is a fix or just another layer. But I'll leave it to him to diagnose that. The reform question follows directly from that discussion. If the problem is that we tax what a company can move, should we instead tax something that it can't move? So in answer to that, I'll note that there is one factor a company will struggle to move, and that's where its customers are. It can move a factory or a patent or its headquarters, but it's harder to move the people who buy its products. And that's the intuition behind moving to market. We tax business profit based on where the sale happens rather than where the production happens. That intuition is something I think everybody is familiar with. The hard parts are really the focus of the paper and what we're here to learn about. So after John, I'm going to turn over to Alan, who's going to define what moving to market actually means, because it's really not one idea. It's a spectrum from full replacement of the corporate income tax to narrower reforms that can layer onto the system we have. Then we'll go down to George, who's going to be the grumpy man on the stage, and discuss the practical limitations of these ideas. So he'll talk about whether reforms are comparing the idealized system to an idealized system to a reform system, or are we really talking about the messy system we have right now? So what's the point of comparison that makes sense? And he'll ask and talk about whether any of this could survive a legislature, and importantly, whether the US can solve this on its own without the buy-in from the rest of the world. I would just offer that that question is really pressing right now. The fiscal outlook we know is sobering, and the corporate tax base itself has been shrinking even while corporate profits are rising. The politics have also shifted, right? We're in a moment where we've layered on potentially trillions of dollars in tariffs, some of which people argue is a crude way of taxing at the border. The courts have since thrown a lot of that into question, but with that in mind, Kyle's going to try to bring all of this home to the current situation in the United States. He'll discuss how far we've already moved in this direction, whether tariffs have really changed the politics of what we're talking about right now, and what options we really have short of rebuilding the whole system from the ground up. So that's an overview of the session. I think we're going to hear a lot about the case for reform and what's hard about it. And I will start by handing it over to John to ask him to describe the current origin-based system and what the well-established issues are with that.
Yeah, thanks, Elena. So in a way, I'm going to elaborate on what Elena has already said. But I think it is important to take some time to think through how well or how badly the existing system performs, because the case for fundamental reform really depends on what we think about the performance of the current system, right? And the second point, which Elena made as well, is if we could identify the root cause of the problems with the existing system, that might give us something useful to build on when trying to design alternatives, which is what a destination-based system seeks to do. So if we look at the existing system, I think the two key features of the system are that it's an origin-based system and it adopts the separate entity approach, right? So by origin-based system, we mean that under the existing system, multinationals are by and large taxed where their functions and activities take place. And by a separate entity approach, as you know, what that means is that at least as a starting point, the existing system treats different parts of an entity, different entities within a multinational as though they were separate for tax purposes. Now, you could have an origin-based system without the separate entity approach, right? So you could have a unitary tax system with formulary apportionment where your factors are assets and labor, but under the existing system, we combine both the origin basis of taxation with the separate entity approach. And okay, so how does this system perform? As Elena intimated again, there are very well-known problems with the system, and we all know them, but it's useful to start by setting them out. And I'll set them out by following Mindy's recommendation, starting from first principles and saying, okay, what would we think the characteristics of a good system ought to be? What does a good system look like? And then evaluate the existing system against those criteria, right? And I'm not reinventing the wheel here, going back to Adam Smith, and maybe even before that, we think a good tax system is one which is economically efficient, fair, easy to administer, and then we can add two other criteria which are specific to international business taxation, which are robustness to profit shifting, which actually could fold into ease of administration, but I'll separate it out because it's so salient. And the fifth would be incentive compatibility. And by the way, we did this, we used these 5 criteria, these 5 principles, in a book which Paul Oosterhuis and myself and a few others worked on a few years ago called Taxing Profits in a Global Economy. Okay, so how does the existing system perform against these criteria? Let's start with economic efficiency. The existing system distorts economic behavior along all kinds of margins. It distorts investment decisions, both in terms of whether to invest, how much to invest, and where to invest. It distorts financing decisions. It distorts competition within markets, et cetera, et cetera. So the existing system is highly distortive, and so it doesn't perform well on that criterion. Fairness, as we discussed yesterday, is a difficult concept to operationalize in the context of international business taxation. But I think we could all agree that at least a number of countries around the world seem to think that the existing system is not fair, and that has consequences because these countries are agitating for change. So whether we think they're right or not, it's definitely true that countries think that the existing allocation of taxing rights is not fair, and that's why they're agitating for change. For a number of years, it was only developing capital importing countries that were making these arguments that were being dismissed by other countries. Now, some of the countries that were dismissing those appeals to change the allocation of taxing rights are arguing that we should change the allocation of taxing rights, mostly because of the frustration they feel due to the rise of digitalization, etc. Susceptibility to profit shifting, I would argue that the existing system is fundamentally susceptible to profit shifting, and it doesn't take a genius to figure this out, right? So if the global tax paid by a multinational depends to a significant extent on cross-border intra-group transactions, of course such a system is going to be susceptible to profit shifting. Like, it's not difficult to figure that out. That said, it doesn't mean that I blame multinationals for their planning, and second, it's just the way the system works. And secondly, there's also a question of the scale of the problem, right? And there was an important paper by Jennifer Blewin and Leslie Robinson, I think it was published last year, which cast doubt on some of the well-known estimates on the scale of the problem. So there's a question about the scale of this issue, but I think it's clear that the system is just susceptible to profit shifting. Next, ease of administration. I think we can all agree that the system is extremely complex. It gives rise to significant compliance costs for taxpayers and is hard for tax authorities to administer. I mean, sitting in the room yesterday and hearing people talk about the foreign tax credits and CFC rules just reminded me of how complex the system is. Somebody at one stage spoke about guidance fatigue when I think another 100-page guidance document was released on foreign tax credits, right? The system is just really complex. And again, it's complex because of the fundamental features of the system, right? Both directly and indirectly. So directly, if you have a separate entity approach, then you need profit attribution rules, then you need transfer pricing rules, and those by their very nature are complex rules to set out. And also indirectly, because of the susceptibility of the system to profit shifting, right? Because the system is susceptible to profit shifting, we need layer after layer after layer after layer after layer of anti-profit shifting rules, which just make the system really complex. And finally, the system is not incentive compatible in that it provides incentives for countries to compete with one another, which leads to the well-known race to the bottom, and which suggests that unless we do something about it, the system does not seem to be viable, at least in the very long run. Okay, so overall, what are the problems with the system? I said it is economically inefficient. It's considered by many to be unfair. It is susceptible to profit shifting. It is hard to administer and comply with, and it's incentive compatible. So yeah, it doesn't perform really well. Now, the really important point now is the last really important point is why does it perform so badly? Is it that an origin-based system with a separate entity approach can be designed well? It's just that we did not design this one well. And for the reason that Elena gave, I think the answer is no. It's because of the fundamental features of the system, especially the fact that under an origin-based system, we're taxing multinationals where relatively mobile factors are found. That gives rise to economic inefficiency, it gives rise to profit shifting, therefore we get complexity, therefore we get this race to the bottom. So I would argue that many of the problems of the existing system can ultimately be traced to this one cause.
So then, is a global min tax a fix for this?
Okay, so I guess we could start by discussing what we mean by a fix. So one response to that is to say, okay, does a global minimum tax even improve the system relative to not having a global minimum tax? And as you heard, I'm not American, so I'm not an expert on necktie, but I have studied GLOBE quite carefully, and I would argue that it's not even clear that the GLOBE has improved the system overall, right? So I think I would argue that it has improved the system along some dimensions. For example, I think it has made the system more robust to profit shifting, but it clearly has made the system worse on other dimensions. Most obviously, it has made the system more complex. On others, I'm not quite sure if it has improved or not improved. So overall, I would argue that it's not even clear that GLOBE improved the system relative to before having GLOBE, let alone, and that's a much lower bar than saying, has GLOBE fixed the system in that? Has it led the does an origin-based system plus a global minimum tax lead to a good system? That's an even higher bar. I think we're nowhere close to that. Now, I think what's interesting to ask then is why don't global minimum taxes, why hasn't GLOBE fixed the international tax system? Why hasn't it even improved it overall? Is it that we haven't designed and implemented GLOBE well? Or is the policy of trying to shore up an origin-based system with a global minimum tax flawed, right? So is it a question of policy or is it a question of implementation? And I would argue that the problem is one of policy, not implementation. So I think GLOBE could have been designed better, but I think fundamentally trying to shore up an origin-based system with a global minimum tax is a poor policy choice. And at a very high level, I think this because my starting point would be, okay, what's the problem with the existing system? The root cause of the problem is mobility that creates these competitive forces which destabilize the system, right? Which destabilize an origin-based system. What GLOBE does is it keeps those competitive forces in place. It simply tries to build a superstructure of rules to contain those forces. But those competitive forces remain in place. And they do three things at least. One, they affect the design of the global minimum tax. I can explain this further, but it means because of these competitive forces, we get a global minimum tax that's weaker than what we might want. It makes the implementation and the operation of a global minimum tax hard to achieve because countries are still competing within GLOBE. And finally, it continues to destabilize the system overall. So I haven't been very optimistic this morning, but I think the existing system is a mess, and I don't think a global minimum tax can really shore up an origin-based system to bring it to a point where we can be happy with it.
Okay, we're going to turn to Alan to pep things up a little bit. Can you talk to us a little bit about how destination-based taxes address the many downsides that John raised with the current system, in theory?
Well, at least in theory, destination-based is better for locating things because the customers are easier to locate. There are exceptions to this. There are things that kind of don't work in the way you'd expect economically. A big one is just when people physically cross borders, that becomes messy. That includes both tourists and you could also throw remittance sending households into this category because there you have kind of this interesting dual household where they work in one jurisdiction but partially consume in a different jurisdiction. Both of those turn out to be a little bit messy for the destination base. And there's a familiar remote seller problem. We've talked about the kind of permanent establishment problem of it's gotten easier and easier for a seller to make significant profits without having any physical presence in a country or in a U.S. state if you're looking at things like the Wayfair decision. So there are exceptions to this, but overall these are a lot better and a lot smaller as kind of a percentage of the tax's total base than one would find in an origin-based tax. That said, we kind of have observed a continuum from the most kind of full and complete destination-based systems to kind of ragtag patchwork that actually exists today. And one of the goals of the paper is to explore that continuum.
Can you talk through some of them, like what the practical implementations of a destination-based tax look like?
Yeah, we'll kind of draw the full range here. I'll go quick on them though. At the very fullest, you might have abandon the corporate income tax system entirely and look at something like the New Zealand goods and services tax, very complete, very based on final consumption in the destination where it is. The next most complete thing, and this is where we start getting into kind of proposals that are actually corporate income tax-ish, is the destination-based cash flow tax. Cash flow means has to do with treatment of investments and other long-lived assets, and that has virtues, but we'll move on from that because it's not directly pertinent to the destination base. The other part of DBCFT is the DB, destination base. It is almost a VAT by construction, but like corporate income taxes, it exempts domestic labor from the base. And that is a significant reduction in revenue relative to a VAT. So in one sense, you have the same issues as a VAT in terms of like remote seller. Like a trivial example would be if I create some sort of software product and I sell it to some individual in a VAT country, and the individual just pays me over the internet and doesn't report that anywhere to the authorities. That's just kind of lost, even though it should be part of the VAT base. Same for DBCFT, but with domestic labor exempted from its base, like those problems become larger as a percentage of the revenue gained. There's also a greater issue, not necessarily with the import side, but with the export side. VAT requires a full rebate of the value of an export. But if there's also a deduction for domestic labor, it's kind of like you've got a double non-taxation of that domestic labor, and you get this super interesting situation where large exporters in the United States, probably something like Boeing, would end up in perpetual loss territory. And so there are greater issues than the VAT. Then we go to proposals that are a little bit more half implementation of destination base. And some of them use destination a little bit different from DBCFT or VAT. In the previous taxes I mentioned, it's kind of built into the idea of we'll start from revenue collected in our country. That fundamentally puts you in a destination base automatically, and the subtractions follow from there. Here, we're more using parts of the existing system and parts of a destination base together. The first set of proposals is residual profit allocation. That's a family of proposals. We, the co-authors, are most familiar with the one that John worked on, and that's the one that I'll use as an example. But roughly, you divide profit into a routine portion and a residual portion, and the routine portion is taxed by something more like an origin-based system, and the residual portion is allocated by formula, usually to include destination countries. In the specific one that we outline, the routine portion is handled by the existing transfer pricing system, and routine is there defined to be kind of the things that transfer pricing actually handles reasonably well. Shipping iron around, there's not going to be much transfer pricing problems there. But as you get to one-of-a-kind patents, things like a dominant enterprise software that has no real peers, The value of that is kind of both hard to calculate and hard to locate. That goes into the residual side. In the proposal we outlined, that we refer to, the entire residual side is allocated to market countries. Then, as we get more into the actually existing in the world territory, but not quite, you have the OECD Pillar 1. Pillar 1 is an attempt to allocate a portion of profits to market countries. That portion is called Amount A. Interestingly, and kind of dubiously, the nomenclature, one would think that Amount B is the complement that is not allocated to market countries, but that's not actually true. They do it a little bit differently from residual profit allocation. Instead of routine and residual, it's a little bit closer to normal return and kind of a supernormal return-ish concept. There's some subtle differences between those, but you could imagine something that's hard to locate, like a patent, that nonetheless only earns a relatively normal rate of return and not a supernormal one, and that's where the differences between these would lie. And then you get to the really ugly patchwork stuff that could include tariffs, which are kind of destination-based in an obvious way. That could include the portion of beet that doesn't really, that's nominally a base erosion measure, but in practice often falls on imports from countries of a legitimate substance in the US. And digital services taxes, which are also kind of a patchwork. And then finally, one could even argue that the export exemption of foreign-derived deduction-eligible income, that is sort of the beginnings of an export rebate. And one idea here is that perhaps like destination-based principles are good enough that even kind of unprincipled taxes start to migrate in the destination-based direction over time, but they do so in a kind of haphazard way. And these are the things that actually exist in the real world, not the more fleshed out proposals I described earlier.
Great. I'm going to turn to George now to throw water on the fire and talk to us about, as a start, what do you think some of the biggest practical issues with moving to a destination-based tax are in the U.S.?
Am I throwing water or gasoline? I'm not sure.
I
guess
think
it
you're going to
depends
put
on your
out the
perspective.
excitement fire. I was anticipating you putting out the
Gotcha.
excitement
Okay.
fire.
Yes. So let me start by making clear, because everything I'm about to say will probably lead you to a different conclusion, that on net I am intrigued by the idea of moving to more some sort of market or destination-based system. I think there are a lot of potential improvements to the current system, and so I want to lay that out there. I think where I'm kind of coming from is, for various reasons, I think people will end up being underwhelmed by those benefits. There may still be benefits, but it won't be as exciting as maybe some people thought. And I think the first thing you got to do is not fall into the trap of comparing an idealized system that has been designed in a pure and elegant way with a current system that has gone through the ringer. And I used to say when I was on the Hill that you can write the most brilliant, and I mean that sincerely, I'm not, brilliant white papers you want to write about a new kind of system that would be better, but until you sit down and try to draft internal revenue code language, you don't even uncover 80% of the questions you need to be asking. They just pop out as you go through that exercise, and there's just no way to uncover those things when you're not trying to reduce an idea to a set of rules to be administered and complied with by the tax authority and taxpayers. And a lot of complexities arise, ambiguities arise. Oh, if we write the rule this way, there's going to be a loophole there. Or if we write it that way, there may be an inadvertent double tax over here. Or is the taxpayer even going to be able to get the information necessary to comply with that rule, and so on and so on. And that exercise begets more rules to try to deal with those things, more, both at the statutory level and at the regulatory and administrative level, to flesh out ambiguities, to plug holes, et cetera. And then it just gets more and more complicated before I've introduced politics. Right now, I'm just creating rules that can work. That exercise just naturally creates a lot more complexity that doesn't come out when you're thinking of an idealized system. Then you introduce politics, and this company in the finance committee chairman's state wants an exception to this. And well, if you have an exception, that kind of changes how the system works. And once they have an exception, well, then the most creative tax planners, some of whom are in this room, are going to start figuring out how to exploit that exception for their clients and get their clients into that exception. And then the tax authority, Treasury and IRS, maybe Congress, well, we got to come up with some new anti-avoidance rules to layer in to stop people from doing that. And then the cat and mouse game begins. And we are currently living under a system where the cat and mouse game has been going on for over 100 years. 100 years of piecemeal changes, of regs and administrative guidance and congressional action and tax court holdings and so forth. And so, it's just not a even comparison to say, let's compare this idealized system to something that has sort of evolved over decades. Human beings tend to make that mistake. As Mindy showed on a slide yesterday, ChatGPT also makes that mistake, I think. For those of you who were watching yesterday, she had that slide where, on DBCFT, all these green circles and squares, and current system, a lot of orange and red for the different things. And I'm sitting there thinking to myself, of course, ChatGPT is limited to what's out there, right? And I think there's a lot out there involving people complaining about the current system. And I think that there's much less, not zero, but much less criticism of idealized systems, and it's much more kind of on the proponent side with what's out there. And by the way, that's kind of a natural thing in politics and policy, is that folks who might raise concerns or have criticisms tend not to put resources into that when something is not ripe, when it's not a realistic thing yet, right? Then if it becomes realistic, then they come out of the woodwork. So some of the ideas out there that just are still kind of not real, when it's not live ammunition, are not going to have a lot of criticisms. They're not going to have a lot of people taking time out of their day and spending money to try to figure out what could be wrong with this. And so I think that's a really important framework. And I think the potential benefits of moving to a destination-based or market-based system, there's two components. There's the actual benefits, maybe reduced opportunities for profit shifting, some simplification. I do think that exists. I think it's non-zero. But then there's also another component that's just that apples and oranges comparison, that once you implement this new system, that part will disappear. That portion of the benefit will disappear. And so, I think that's just kind of a really important way to evaluate these things. We talk about DBCFT as an example, something I've worked on for a large part of my life. I'm old enough to remember when we called it the X tax, and David Bradford kind of started that. I don't want to say started it, but he pushed that work forward, and been thinking about that system and all the potential benefits of it for 20 plus years. But Alan referenced permanent losses, exporters having permanent losses, right? Well, I think it's probably not politically viable to have a system where we're giving Boeing a check every year, a rebate for its sort of negative tax rate. But if you don't do that, if you just have permanent losses accumulating, you don't have a full export adjustment. So if you have a full import adjustment, but only a partial export adjustment, the difference between the two is basically a tariff, right? The exchange rate won't appreciate fully. You'll have a tariff. So you've got to figure that out. How are we going to monetize the export adjustment to make sure it's adjusting? That's going to require a lot of thinking, a lot of drafting, a lot of rules. People used to joke in sort of 2016, 2017, when it did kind of become live for a period, they were joking, maybe half joking, that Boeing and Walmart would merge. And you'd have all these mergers of big exporters and big importers, so that the importers that were taking the hit could monetize the export losses that the exporters couldn't use. Seems like a pretty big distortion that you want to take into account. Again, and I'm not trying to kill the idea. I'm just saying there's a lot of stuff that has to be worked through, and a lot of reason to think that there can be a benefit, but we would be underwhelmed by the benefit. Where the customer is located. Alan used the phrase "where the customer is located." Is that self-evident? Is that harder to manipulate than where the profit is located? I would say yes. But nobody's really had any incentive to try to manipulate it yet. And is the rule where the customer is located? Is it where like FIDI, where the consumption happens? Is it where the customer's tax residence is, or where they're physically located? In an age of increasing electronic transactions, is it where the IP address is? So there's a lot of design questions that first have to be answered. It's not enough to say market or destination. You have to define that precisely. And then once you define that precisely, then people get to work saying, how can we manipulate that? And I think they will. We were talking about a scenario where, okay, company A doesn't want to have sales in the U.S. for tax reasons. They want to minimize their sales in the U.S. Could they sell to company B, who's a foreign company? And then company B can sell into the U.S. Well, under some systems that might work. Under other systems, the U.S. might not care whether it's A or B. They're still getting the sales. But what if B is a loss company? Is there I'm asking questions, right? I haven't really started to think through this, but are there going to be accommodation party structures where you go find a loss company to sell into the jurisdiction that you want to minimize your income in so they can soak up their losses? And it's kind of, again, throwing things out there that I think have to be thought through, worked through, dealt with, and will diminish, but if done well, hopefully not eliminate potential benefits from switching to a more destination-based system.
Yeah, I would just add two more that come up every time everybody talks about this, and I still wish I had better answers than I do right now, which is, what about the financial sector in the U.S.? I think when you read white papers, all of us, myself included, say, well, we mean non-financial, and so don't worry about them. But that is a pretty pithy thing to do given the importance of the financial sector in the U.S. And also, what about pass-throughs? And again, I think most people, even in 2016 when we were talking about the DBCFT, we meant corporations. We didn't mean pass-throughs. And we have this other inefficiency sitting in the system that is often adjacent to the white papers. And so I think where the rubber meets the road on this is why we can write all the white papers we want. But it's hard to think about, and I would just invite you, George, if you want to add a couple more thoughts about whether any version of these reforms really can survive contact with the legislative process in light of all of this.
Yeah, and financial services is a good example to bring up, right? My vague understanding is that most existing credit invoice VATs deal with that by excluding them from the VAT. Okay, politically that might be fine, but if DBCFT or some other destination-based system that is sort of a replacement for the current origin-based income tax and therefore viewed as the corporate income tax is exempting JP Morgan and Citi and Goldman Sachs, that's obviously not going to happen, right?
I will note, however, that the challenges in taxing the financial sector under consumption taxes exist in the same way for the income tax. So it's not as though you're introducing a new challenge. It's the same challenge. It's just you might want to get it right if you're doing a reworking of the tax system.
Yeah, that's fair. That's fair. So I'm sorry, Elena, you had a follow-up question.
My really brilliant question was, I think we all know the answer to it, but I'm going to make you say it anyway. Can any of these reforms really survive contact with the legislative process?
So is this a rhetorical question?
Yeah, it could be. You could just say pass and be done if you want.
I think, survive is there are different levels of survival, right? I don't think any make it through the process substantially similar to kind of the idealized version. I think, and again, it's not just because of politics. As I mentioned, like when you try to reduce something to code language, that's a non-political exercise. All the hours and hours and hours I've spent sitting at the Office of Ledge Counsel with committee staff and JCT staff and Ledge Counsel staff trying to do that, like that's why I say you don't even know 80% of the questions to ask until you try to do that. A non-political process that requires changing, that reduces the survival, then the political process. So there's a real risk that you go through the process and you come out with this sort of Frankenstein's monster that's could be even worse than the current system, but the momentum is such politically that you get to a point where it's too late to turn the battleship, and then you're kind of stuck with it.
Right. I think we have one question, but then I'll say we'll hold the rest until the end. Yeah. Yeah.
George, back in the days when the House Republicans were considering the destination-based cash flow tax, one idea that came out and that we actually talked about in the book that John and I helped co-author was having a mixed origin and destination-based cash flow tax, so that, for example, if you had a 25% rate, the deduction disallowance for imports would be 40%, and the exemption for exports would be 40%. That would help you a lot in the Boeing problem. That would keep the U.S. from being a tax haven for for export activities, if you will. And I know there was some talk about that in the legislative process, but it never surfaced. Was that seriously considered, and do you think that might have been a way to try to bridge some of these gaps?
I recall that as well. I don't recall, and if Barbara has any thoughts on this, she's shaking her head. I remember it being raised. I don't remember working on it diligently. I don't know if you have a different memory.
It was raised too late.
Okay, is that what it was? Yeah.
It was, I recall, because I was working with the export group back then, that they raised it on the House side. The gamble was you could get it through the House and do that on the Senate side, and it obviously cratered in August of 17, so it never made it through the House side.
I think that, it's an interesting question. What is a hybrid better? There are some situations where a hybrid between two tax regimes is worse than either of the two tax regimes, right?
So in this case, I don't know if that's true. This isn't actually all that exotic. This just explains what most European systems look like: a value-added tax and a corporate tax.
Right.
Yeah.
Right. That's right. But a low-level corporate tax, it's a 15% origin tax and a 10% consumption tax, which, to my mind, was something that should have been front and center back then and shouldn't be discredited by what happened back then, because it wasn't really vetted that well. Anyway.
Paul, I remember discussing that. I remember, and I think it's worth continuing to discuss. I think, Barbara is absolutely right. It was just sort of too late in the process. Going to my point about you get to a point where you just can't pivot, in certain ways. I also remember phasing it in, over some large number of years and having it very low and partial and kind of stepping it in to deal with the exchange rate issue and the potential disruption. There are two concerns raised about the border adjustment. One is that the exchange rate wouldn't fully adjust. The other concern was that the exchange rate would fully adjust. And I remember specifically Gary Cohn raising the concern that because all these third world or emerging economies borrow in dollars, their sovereign debt is dollar denominated, that a very big exchange, a dollar appreciation could trigger a emerging market debt crisis. And I was like, well, I don't really want to do that. That sounds bad. less than 10 years after the financial crisis. So figuring out ways to get some of the benefit of the destination-based system while mitigating the potential disruption, I think is worth people continuing to work on.
Okay, I think this is an important conversation in 2026, given the experience we've had over the last 4 years. To what extent, I would ask anybody on the panel who wants to weigh in on this, do you think destination-based reforms require multilateralism, or can we go it alone?
I think it depends on the proposal, and I think this has been discussed many times in different contexts. But I think using Alan's spectrum of policies, I mean, there are certain policies that countries can go it alone. That's destination-based cash flow tax, a value-added tax. Those are things that the United States could do that move more in the direction of destination-based taxation that don't require other countries to move at the same time. And certain changes might induce other countries to move in that direction for competitive reasons or to protect their own tax base. But that's going to be different than, say, Pillar 1 or sales factor apportionment, where that's going to require buy-in from a bunch of different countries to get the base right. And then there's the practical consideration of which is going to be easier, which the United States is going to want to do. I think in the United States, multilateralism, I think, is a little unpopular right now. And so thinking about what policies the U.S. might want to pursue, I might want to consider the fact that the U.S. might not want to go back to the negotiating table with over international tax after years of at least Congress and both political parties being skeptical of the OECD process.
Yep, I agree. Okay, I'm going to turn now to you, Kyle, just to bring us back to the United States and ask you just a couple of questions. So the first is just to lay out the framework of, like, to what extent have we already adopted or integrated destination-based principles in the current U.S. corporate code?
Yep. This was mentioned yesterday a little bit, that lawmakers have enacted destination-based principles in the tax code. Now, whether they realize that's the case or not is another question, but that's certainly true that we are using destination-based principles. And a couple examples here. So Alan's mentioned two of them. So one is the BEAT, Base Erosion Anti-Abuse Tax. This minimum tax in certain cases captures imports by denying certain deductions. Those imports are being taxed. That aligns with destination-based principles where you're taxing where the consumer is. Another is FDII or FDDEI. Both of these proposals are export-based reductions in tax liability, reducing the tax bill on exports. That, again, is consistent with destination-based principles, because under a destination-based tax, you're bringing in all imports into the base. It's going to be consumed here, but you're also relieving tax on exports. You're removing exports from the tax base. And both of those provisions are doing a little bit of that, although they're not doing it in the same way that, say, a value-added tax would, where you're excluding the entire sale. These are tax reductions on a net income basis. The next one, and bear with me, is the combination of GILTI and FDII under the Tax Cuts and Jobs Act. So this is more of an economic point in that those proposals together have similar economic characteristics as the destination-based cash flow tax or a value-added tax on outbound investment. So briefly here, so if you're a U.S. resident and you're choosing to make an investment, you might choose to put it in the United States or put it overseas. Now, under a value-added tax, the way the border adjustment works and how it impacts currency, you're effectively getting a deduction when you make an outbound investment. That investment is cheaper for you to make. But because the currency is more expensive, when you bring those profits back or the returns back, they're more expensive to you. And in present value, that ends up netting out. So it's very much like the idea behind expensing, where you make a deduction, or you make an investment, you get an upfront deduction, and that deduction is worth, in present value, the amount you expect to pay on those returns in the future. A border adjustment does kind of the same thing for outbound investment for US residents. So it's exempting those, kind of the normal return or the routine return on most assets. However, if you make an investment that has above normal returns, where you're expecting returns in excess of your initial investment, you're going to face positive tax liability. So under a destination-based cash flow tax, you are indifferent with respect to where you place that investment. You either place it here in the United States and you face, say, 21% on your above normal returns, or you place it overseas and you also face 21% on your above normal returns. Your location indifferent. Contrast it with the current system where you'd like to place those above normal returns in low tax jurisdictions. You'll face a tax benefit if you do that. Now, that description should sound somewhat familiar to those that know how GILTI and FDII worked under the TCJA, where if you're a US resident corporation, you place an asset overseas that serves a foreign market, you are going to face GILTI as a minimum tax. But GILTI has an exclusion for a deemed routine return. So if you're putting tangible assets that are serving foreign markets, you're going to get exempt from taxes. But if you have high returns, say from intangible assets, intellectual property, you're going to face that minimum tax. And then, but if you placed that IP or that intangible income in the United States, you'll also get that lower rate, that 13 1/8 tax rate if placed in the United States. So, under certain circumstances, and it's more complicated than this, but under certain circumstances, you are also tax indifferent with respect to where you place these high return assets. So the combination of those two have similar economic characteristics to a destination-based system or a destination-based cash flow tax. And the other one I'll mention quickly are interest deduction limitations. This one also needs a little bit of explanation, but under a border adjustment, you as a firm do not get the benefit of tax avoidance through deducting cross-border interest payments. If you are deducting a lot in the United States to avoid taxation, sending those profits overseas and getting a lower tax rate, eventually you got to bring that money back home, and under a border adjusted system, you're not saving any money in present value. So doing that, limiting interest deductions is kind of a round the back way to get at that. So anyway, we've moved in this direction in a lot of ways. So it's not something that's completely exotic or unfamiliar. Now, whether lawmakers know that this is the case is another story. As you can see from some of these explanations, it takes a lot to describe why it's the case that we're moving in that direction, but it is there.
Okay, I have to ask this, because if I don't, we have to revoke all of our public finance economist cards. Nobody's talked about federal revenue yet. So if we think about federal revenue in the context of moving to a destination-based system, how do concerns or interest in federal revenue interact with the conversation?
So I can make two points here. So the first is maybe on the principles of international tax and how much should revenue collection be part of the equation. And my personal feeling is it shouldn't be a huge part of this, that I think the efficiency concerns are primary and that we should get the tax base right to reduce those distortions. We can pick up some revenue from that, but if you're looking at the federal budget, it's basically nothing. So I think it's really the other issues like addressing profit shifting, economic inefficiencies, administrability, that should be the primary concerns, revenue being down the list. That being said, I think because the federal government is running a very large deficit and debt is accumulating quickly, I think we're going to hit a roughly debt as a share of GDP of around 175% by 2056, and it will continue climbing thereafter. And those numbers are optimistic because they assume that the tariffs that were in place in February remain in place, and it assumes that OB3 policies will expire, when they are scheduled to expire. If you assume those things aren't actually part of the baseline, we're closer to maybe 215% of GDP for borrowing. This is going to be something that is going to be front and center to any tax policy discussion. And the one thing that I keep coming back to, given the challenges of designing specific or smaller destination-based reforms to the corporate tax, is that there is like one easy way to do destination-based reforms while also addressing debt and deficits, which is a value-added tax. Again, it has its own political issues, but it is something that could be used to simultaneously cut back on the amount of origin-based taxation we're doing by cutting the corporate tax and by raising net revenue, because value-added tax base is very broad. You could do both of those things at the same time.
Okay, the next thorny question I have for you is, given the last 18 months of tariff policy that has been put in place, how do you think that changes the politics of this conversation?
I used to say that it changed it quite a bit. So back in 2016, one of the biggest groups opposed to the destination-based cash flow tax were retailers. And so naturally you'd say, well, we now are facing $300 billion in annual taxes on imports that retailers are bearing quite a bit of, at least directly, that they would be, I think they lighten up a bit about the idea of a destination-based tax, which would have similar effects on the amount of tax that they're at least directly paying. And so that should make the politics at least somewhat easier. They'd get a system that's actually more coherent, and they're paying roughly the same amount of tax. Now, the other side of that makes me a little bit more skeptical is that, while you might have taken care of the retailers and other importers that are subject to the tariffs, but you're introducing another political coalition that might be opposed or skeptical, which are services. So something that's different, a big distinction between tariffs, traditional tariffs, and a destination-based cash flow tax or any broad-based VAT is the inclusion of services. Services have to be included in the base for the economics to work. Services have to be included in the base to get the neutrality and the economic efficiency that we talk about with destination-based taxes. So you're going from a system where you have a lot of tangible property being included in the base, adding services. That's the one political coalition or group, trade groups that you'll have to deal with if you're going in this direction. So the politics might not have changed on net very much. Yeah. I think it's just shifting from one group of concerns to another.
Yeah, can I jump in on the politics and again to throw something on the fire? I don't know. There's some game theory involved, I think, in trying to figure out how the political dynamics have changed with tariffs and everything. On one hand, you might think there's an opportunity to make a trade there, as Kyle was alluding to. One thing that complicates that is, would you rather be hit by a tax that every day you wake up, it's possible you could get the president to remove at the stroke of a pen, or a tax that's in statute permanently and would require an act of Congress to change? And then kind of related to that is, would you agree to a tax in statute if the president is going to continue to have the arbitrary authority to put tariffs on later on, right? And so at a minimum, I think you would need changes to trade law to considerably restrict, maybe in combination with a Supreme Court case here and there, but to severely restrict the president's ability to unilaterally impose tariffs. Otherwise, the political concern is, well, we're going to get both.
Yeah, that's a good point. Okay, some closing questions for the panel, and then we'll turn to the audience for Q&A. One of them, I think we've already talked about this in a lot of places, but just to elevate things up high, what options do you think we have, short of fundamental reform, to get the U.S. to adopt destination-based principles beyond what already exists through the TCJA and what we've kind of modified through OB3?
I could throw out a small one, and Alan and I have written about this. So one of the changes in OB3, and I think we've talked about why this occurred, is the elimination of QBI, or the exclusion, the 10% exclusion for the deemed returned on tangible assets. That was eliminated. Politically, I think we understand why that's the case. Although it's an exclusion for deemed returns, I think on net that was raising revenue, not reducing revenue for the federal government, because QBI was a subtraction from your benefit for FDII. So on net, it was a tax increase. But that policy was one of the things that made the TCJA reforms, at least in my mind, more consistent with destination-based principles, and I think tried to target those provisions to highly mobile income. So that's a small policy. Now I don't know if there's going to be any momentum to get that back, especially since it would represent a tax increase, not a tax cut on net for companies. But that's one I'll throw out there.
There is kind of a high-level question that a very high-level question, first principles kind of question that we both in this discussion and I think in our paper have not really wrestled with, which is that what are we really trying to do here, right? Are we trying to figure out a better, simpler, less susceptible to profit shifting way to allocate profits within the construct of an income tax? Or are we trying to change the tax base from income to consumption or cash flow? Those are actually two different things, allocating profits and moving to a consumption tax. And I think it is important to remember, maybe do want to go back and ask that question, because that leads to different options within this destination-based, world that we're discussing. Paul got me thinking. No, he's gone. Paul's gone. And this is not incredibly politically realistic, but he got me thinking about sort of hybrid ideas, and I was thinking about the old Gratz plan, where you create a credit invoice VAT and you use the revenue to significantly reduce the income tax, which if you do it on the corporate side as well as the individual side, that takes a lot of, you still have an origin system, you still have the arm's length principle and transfer pricing rules, but you take a lot of the pressure off of them potentially with using the revenue from a VAT. It's probably, again, not super politically realistic, but thinking about some different ways to do a hybrid model where you're not trying to do it all in one fell swoop. Restoring QBI is even more incremental than that, but that kind of partial shift is kind of an interesting area to explore, I think.
Good.
At least in principle, when you look at the U.S. trade balance, you would think that the politics and the kind of international negotiations of a destination base should go great with the U.S. because the U.S. is a net importer. In practice, that hasn't happened. I think much of the fault lies with the narrower base of Pillar 1 Amount A, which applied to very large multinationals, essentially, only roughly maybe 100 companies, give or take. And the problem with this, you can almost think of it in a very real, tangible way. I spend my workday thinking about primarily, the taxation of these mega valuable U.S. exporters or quasi-exporters of services. And I think about that, and then when it's time to come home and work on something in the house, I'm often assembling flat pack furniture from China or Vietnam. And the scope of destination-based Pillar 1 is fundamentally such that all of the exporters, U.S. exporters I think about on a day-to-day basis, they're included, and all of the imports I use on a day-to-day basis, they're out of scope. And that's a problem for any global tax proposal, because most of the things we've discussed so far really require kind of a strong enforcement arm, and it's enforcement of global taxes, basically like the IRS plus a few smaller entities. And so if you don't have the kind of political constituency that owns the IRS on board, it's not going to work. But that does suggest to me, like, if you get more people in scope and perhaps change the scoping to work some other way, some way that's not based on global revenues. Global revenues is kind of per se discriminatory against the largest economies. Global revenue is a proxy for did you succeed in the US, which is also kind of largely a proxy for are you American. That has to change to something else, and then you might have a deal for global allocation by destination base.
Could I just make one point about the options countries have going forward, which is the global minimum tax makes a shift towards destination much harder, right? So it's still possible because politically everything's possible, but it makes it much harder. And I think it was, my guess is that it was deliberate, right? So the global minimum tax doubles down on origin-based taxation. And I view it as, I think Germany and France got behind the global minimum tax in late 2018 in a way to drop an anchor to stop the existing system to drift too far away from the origin basis to a destination-based taxation. So if a country wanted to adopt the DBCFT now, it would be in breach of GLOBE, and so you'd have to deal with that. I think it was an intentional move.
Okay, I think we have time now for Q&A. And there's a microphone. So just raise your hands, and we'll just, Kyle, you want to direct the traffic, or should we just go around the room?
I think Alex was first, then Mindy.
Thanks. Hi, I'm Alex Parker with Eide Bailey. I'm in danger of doing a comment instead of a question, so I'll try and keep this as short as possible. But I kind of wish there'd been more pushback to this idea that the international system as it is now is so irredeemable. Obviously, it's very sort of conceptually displeasing. But if profit shifting is the main problem, as you mentioned, we're not even sure about the scope of that problem. And just anecdotally, what you hear is that it's become much more difficult to do a kind of classic profit shifting maneuver into a pure tax haven than it was maybe 10, 15 years ago because of all the developments, OECD, BEPS, even GILTI. And what I find really interesting is you don't hear much about the AI IP being moved. That may just be because it's so new and the companies aren't public yet, but I'm told that it would be difficult at this point to try and construct it. It's already under too much of a spotlight. And related, in a post-AI world where that's the main driver of the economy, it seems like destination would be a much more difficult concept to pin down. And on top of that, you might have, right now, the data centers need to be near the use because of, I'm told it's actually the speed of light that slows it, that is but who knows, maybe we'll beat the speed of light soon. And you might have data centers that are in countries where they have, they've got so much data center, they're doing all the processing, but they don't have a lot of the use, they don't have a lot of the customers. They might feel that's kind of unfair, so.
So I would say that even just in terms of administrability, the system is under real danger of collapsing under its own weight. We have hybrid mismatch arrangement rules in the UK, which are 140 pages long, accompanied by 400 pages of guidance. Pillar 2 now guidance is over 1,000 pages. I could go on and on and on. So it's hard for countries with well-resourced tax authorities to operate these systems countries which don't have well-resourced tax authorities have no hope in hell in operating this system as well, which then means these countries might then agitate for reform, or they might take, measures such as, not bullying companies, but just saying, we don't quite know what the answer is, so this is the amount of tax you have to pay. I mean, I'm told in practice that some transfer pricing disputes have become so hopeless that somebody told me the revenue now, and we had the dispute, and the revenue and my client both pretended they've come to the right solution. They said, but we know they don't know what the right answer is. They know that we don't know, but hey, the rules are such a mess, let's just come up with something which, yeah, we can kind of both live with. I mean, to my mind, that's not a sustainable system.
Two points. So the first is the current system, compared to what? I think being in the United States, we know what the system was like and all the complaints prior to the Tax Cuts and Jobs Act. And I think that lawmakers did improve things, and you can point to all these policies and some data that suggests things are better than it was. But then there's the separate question of, can we do even better than that? Can we make things simpler? Can we reduce the amount of profit shifting? And then on the point of AI, I'm not certain I agree with the idea that AI really changes anything about the challenges or the opportunities to move to destination-based taxation. I don't think that we should think of it as any, I don't think it should be thought of as a special or distinct or unique service. It's a service. People are going to purchase it. We're going to know where the consumers are, and it's going to have the same challenges as other services.
Yeah. Some of the discussion yesterday on withholding tax for services, wouldn't that be a substitute for, or wouldn't that be another way to get to a more destination-based tax system, also staying within the origin-based system, and also thinking about like adjustments to transfer pricing rules that weight factors more heavily in the location of consumption? Is that an alternative way to get there also?
I think the way I describe stacking withholding taxes on services on top of the origin-based system, it's more akin to having our current system and then doing tariffs rather than like destination-based reforms. Because again, what's central to being destination-based is it's both on the import and the export side, not just the import side. Just doing the import side, I think you get into some trouble. You introduce additional distortions.
Yeah. I wanted to come back to George's point, because I think actually I don't disagree too much with George about the fact that the DBCFT has not been getting from where we are now to implementing a DBCFT requires a lot of work. There is a lot of thinking that still needs to be done. My only regret is that rather than spending all these years working on a BEPS, then on a global minimum tax, etc., wasn't spent thinking about such proposals. I mean, there are all the political issues which George mentioned, which means that almost certainly we will not end up with a pure DBCFT, and that's problematic. But I guess my only, what still gives me some hope in destination-based taxes over the current system is that at least with a destination-based tax under the DBCFT, when on paper it works better than an origin-based system does on paper, right? So if I had to choose where to start, so let's say both are going to get messed up by the time we try to put them down into rules, and the political system is going to mess them up. But one is already messed up on paper. So wouldn't it be a better starting point to start with one which has better promise at least? Now then there's the question of, If we started completely from scratch, which of the two would you choose? And then there's the separate question is, given that this is what we have now, and given transition costs and the uncertainty and that, would you choose to move towards that, given where we are now? But I just want to say I agree with the points you made about things getting messed up.
Yeah, we don't disagree, and that's why when I started talking earlier, I tried to lay out that. Let me be clear, right? I do think there are potential benefits here. I just think they might be much more modest than people think, and I think also think there are various points in the process where things can go awry, and there's a lot of hard work that has to be done there. I also, Kyle, you just made a comment to Alex that we know where the customer is, and my reaction to that is, do we? Or going forward, will we, once a new system's in place? I do think it matters whether every company is just only producing and selling widgets versus stuff in the cloud. I do think that matters. There's already widespread use of VPNs to hide locations, to hide IP addresses, right? So that might just be the tip of the iceberg of what people will start doing under a different tax system. So I do think that the technological change is changing the composition of the products, of goods and services, in a way that where there is probably a lot of opportunity to manipulate the location of the customer or the consumption, et cetera.
I think that movement favors destination-based taxes over origin-based taxes, because as we move to more services that are easily manipulated, and that's going to put much more pressure on an origin-based system than a destination-based system. So you're right that there's probably issues under both.
Yeah.
But I think it's just going to compound more on the current system than it would under a destination-based system.
And you might be right, and I'm not saying it's greater than under an origin-based system. I want to be clear about that. I'm a little less certain than you that it won't be. I think you're probably right that it won't be, the magnitude won't be as much. But I just going back to my original comments, I think it's the law of unforeseen consequences, right? One thing we can be absolutely certain of is that any brand new system is going to have downsides that none of us can contemplate right now. It just is. Yep. There's got to be a weight on the scale for knowing that is going to happen, even if none of us can figure out what that's going to be.
Yep. I would just add one more weight that the durability of whatever reform looks like is equally important, right? We're in a situation where a lot of tax policy through trade policy has become incredibly transitory, and that makes the business environment complicated. But we got permanent expensing, and that was a real boom for durability in a movement toward a destination-based system. And so I think what floats in the background from a policy standpoint is, are we implementing changes that really are durable to the legislative and other political processes going on?
And the corollary of that is transition is so critical. Getting the transition right is so critically important. Yep. Transition is something as dramatic as this. Yeah. Transition rules cannot be an afterthought that you throw on at the end. It's part of the system itself. The transition period can be decades, and before you get to a real steady state. And the political system will only sustain negative disruption for so long before it just starts changing the rules again before you've gotten to the steady state, right? I mean, these tariffs are going to be great. You've just got to wait 10 years. Right. 10 years of pain, and then it's going to be great. Well, are we going to wait 10 years to find out whether that's right or wrong? Most people are not.
Right. Okay, we are at time plus 2 minutes over. So thank you for your attention, and we will see you on the other side.
Okay. Hi, everyone. Welcome to our luncheon keynote speaker, Todd Castagno from Morgan Stanley. So I think a real treat for everyone in this room and everyone listening online. A little bit different for Washington, D.C. crowd. Todd spends a lot of his time thinking about tax policy from the perspective of the financial markets and how companies react to and how investment decisions are made in response to tax policy. So really looking forward to a unique presentation from Todd. Todd has a master's in accounting from University of Missouri, has been with Morgan Stanley for over 10 years, 17 years, and managing director at Morgan Stanley, where he runs a group that does a lot of quantitative work, which you'll see in his slides, focused on valuation and accounting and tax policy questions as they manifest through financial statements. So with that, before I bungle anything else that Todd is going to say, Todd, thanks so much for joining us. I know you had some travel mishaps getting here, and looking forward to your presentation. Thanks.
Yeah, so thank you for having me. Thank you, AEI. Thank you, Mindy. You know, I think the title kind of says I'm going to try to give policy from a different lens. Most investors, big institutional investors, are not accountants. They're not tax professionals. But you have to navigate it. It's one of the largest cost components of an investment on the line item. We could debate 25 or 21 or 35%, but it's large, right? And so it's a meaningful component of an investment thesis. If you're going to invest in a company, you want to understand what their tax position is. The accounting's very difficult because we have an accrual-based accounting system. Our tax code is probably more of a quasi-cash-based system. If you don't have a CPA, navigating those two can be fairly challenging. So that's, I guess, why I have a job. So we work with both institutional investors. I wear kind of a dual hat. I also work with the investment banking side, working with companies, so how they can look at the tax system, how they can look at investment, how they plan to deploy ROI. And so there's a mix between both the institutional side and the capital providers, if that makes sense. So what I thought I would do today is kind of look at the current landscape, because I think there's a heavy AI tilt to this, but we have never seen such capital intensity as we've seen at this point in time. And I think that's very relevant in terms of what we look at in terms of tax policy. So what I'm going to try to do is hopefully help you look at things through the lens of an investor, and hopefully that will inform how we think about some policy. If you have a question, you know, you guys are technical in things that I'm not. I'm probably technical in certain areas that you're not. If you have a question, just raise your hand. Like, I'd like to make this interactive. We'll also pause for Q&A. So with that, maybe I'll get into it. So this is what I'm known for. We did this about 1.5 years ago, and this is the AI ecosystem. And so the term of circularity has come up. I'll probably take some credit for that. What you're seeing here is effectively, if I added the banking system to this is effectively the US tax base. I can't even keep track of how many more deals there are in transactions, but these companies plus the banks are effectively, I would say, near the majority of the US tax system. So that's why this is relevant. That's why I put this chart number 1. The level of investment is unprecedented. So what we're showing here is what we, in financial, in analyst terms, where we look at CapEx, so level of capital deployed as a ratio of sales. We're at about 40-something%. And if you look at that little yellow blip, that was the cable fiber build out back in the 90s. So what we're showing here is what we call the hyperscalers. These little arrows that go, what the important part there is these are what analysts estimate. So we call these revisions. And so looking at that same period in 2028, if you go back to November, it was 20-something%. just between that time and now, it's popped all the way to 40%. So the level of capital intensity and the expectations for capital intensity are, again, unprecedented. Now you say, well, these are just a handful of companies. That is true. That is also 40% of your S&P 500 ETF. So the magnitude is high. Sure.
Going back, that yellow blip, is that like the global crossing investment?
That's communication services back when we put fiber in the ground, so Quest Communications, et cetera, yeah.
So that led to large bankruptcies?
It did. I'm not saying that for here, but I think the magnitude is significant. And then also, if you go back in that point in time, as a percentage of market cap for those communication companies, I would call it like 20% of the index. Now we're close to 40% of the index for the arrows on the side. So to view this a little bit differently here, this is total CapEx gross. And so you can see the amount. What this red bar here shows, again, is the AI hyperscalers. And so that's it's an exponential shift up, and it's going back to the other chart. It's only going higher. Again, it's a handful of companies, but you can see it's nearly, if I did the hyperscalers and I added on the energy and the turbines that go into that, you're probably talking 55% of all CapEx is AI. This is just another version of the same thing. So you see the revisions going higher. Again, so I go back to November. This is gross. So it's just a similar viewpoint, just a different way. So you can see the exponentiality in terms of what the Wall Street is expecting for CapEx to be. I won't belabor the point here since we get into it. So I think this is an interesting chart. Because I went back to chart 1, that was the majority. If you go back 2 years ago, that was the majority of the tax base. And so if you think about if the tax code is primarily with expensing and R&D, et cetera, more of a cash flow regime versus an accrual regime, what you're seeing is these large companies are actually going free cash flow negative. So again, it kind of ties in the level of the investment. I'm not saying that's good or bad. What I'm saying is, I think from a tax policy standpoint, we have a lot of expensing, and we'll get into this from an accounting versus tax. A lot of these chips, the equipment, et cetera, can be deducted up front. And so what I think that what we're seeing, and I'll get to in a minute, is you're talking about a $380 billion corporate tax base that is the largest players are now expensing a lot of that. And so you're going to get into likely some NOL positions for some of these companies. This just gives a kind of a more of a forward look. So a lot of the CapEx also is being offloaded into intermediaries. So it could be a bank, it could be a private credit fund, et cetera. So you're seeing a lot of different structures, maybe for tax purposes, for instance, I don't want to get an NOL position. Maybe someone else can take the deduction within financing. So we're seeing a lot more leases and purchase commitments as well. So a lot of the oncoming CapEx is increasingly going through leases versus outright sales. So there's a middle party there that's usually a financial institution or call it a shadow financial institution. This is kind of just an illustrative what we're seeing in terms of how this CapEx is being brought online to that point is, again, you're having a lot of banks that will set up a facility. That facility will be funded by private credit, right? So private credit controls maybe some of the chips, some of the racks as the data centers are being built out. And then the ultimate user of those is effectively leasing or will guarantee or will enter into a take or pay arrangement to acquire that capacity at some point in time. So what I've seen is the structures are being more sophisticated. And I do believe there's a tax angle here. You can almost look at it as someone else can use that upfront deduction, roll that into the NPV of the investment, and that gets a better pricing for the ultimate buyer. Mhm.
Your point here was that these expenses are not being currently deducted for tax purposes.
I would say most of these are not currently being deducted. These are being deducted. So what this is showing is these will be deductions at some point. These are leases. And you can see, I'm just trying to show the magnitude of the increase. So you can buy the equipment up front. Increasingly, we're leasing, and so those deductions are going to be pushed over time. But I think going back to this, you're going to, if you look at the top right chart, increasingly, if you think about that as more of a quasi of from a tax side, you're going to have persistent negative free cash flows, which is going to drive expenses and losses and deductions. Even though the GAAP profitability right now, which is an accrual state, which we'll get to, is high. So we were speaking, I think a few last night, we're kind of in a Goldilocks period right now, where a lot of the CapEx, the spend, whether that's through direct purchase or through a lease or sitting in a warehouse, is accruing to the providers of the equipment. Yet from a financial standpoint, profitability, it just hangs on the balance sheet until everything gets turned on. So it's kind of a best of both worlds right now. This just shows effectively what's been contracted. And I think the rate of change is more important than the actual, the stack is large, right? That's $1 trillion. But you can see these are basically purchase commitments. So if I combine what I intend to buy, what I've contracted to buy, plus CapEx, you're talking close to $2 trillion effectively. And it has to roll through the system at some point. But this number keeps going higher. I probably could refresh this morning and it'd be over $1 trillion.
One is that $2 trillion will eventually be deductible for.
Someone's going to deduct it, right?
I may be thinking about this completely wrong, but isn't that's just one side of the ledger, right? When things get turned on, they also start generating revenue.
Correct.
And that's the whole point. Under GAAP, the whole point is you're trying to match the timing of the revenue and the expense.
We'll get to that. No, I agree with that. It's that I'm not, why would you commit to something if you don't think you're going to get it? All I'm saying is the numbers are large, and it's challenging to kind of watch the pig go through the python, right, and try to model all this out. We are seeing a lot more off-balance sheet financing. So again, I think that's could be lease commitments. You're seeing, leases signed but not yet started. So there's a lot of contractual elements that you don't see on the financial statements. It's kind of the point of this slide. So there are chips, equipment, et cetera, that's owned by a third party that you can't see from the financial statements. So what I'm giving you is admittedly an incomplete picture. I kind of hit this point already, so I won't belabor it, but again, we're seeing a lot more leases. One of the reasons why we keep putting this forward is you could think about leases in two ways. It's like, all right, so if I have a 10 or 15-year commitment, if I'm just looking at the principal payment versus what I'm actually in theory, bringing on the balance sheet, those can be two different amounts. So leasing is very attractive because from a ratings standpoint, from a credit standpoint, it's not as punitive if I went out and took out debt and bought. Usually you just look at the principal payment versus what's the implied CapEx. All right, so maybe to your point a little bit here, this is what you have to look forward to, and this is the grand debate. So the big debate on Wall Street is, what is the ROI from all this investment? And so the way accounting works for those non-accountants is, I'm going to build a data center. It's going to take me 24 to 36 months. I don't depreciate any of that until I turn on the switch, right? That's a concept we call construction in progress. So you buy it, it sits on the balance sheet, no depreciation. Even for tax purposes, it needs to be placed in service. And so you can see here, this is what, based on the latest Qs and Ks, you have about 520, I think it's about 600 now after an update, of a depreciation expense that's going to come online and roll through. So the question is, does the revenue model support, and this is just CapEx, so this is not leases. So again, if I add the stack together, you're clearly north of $1 trillion, and you need to have the revenue potential to offset that. This just shows kind of depreciation and percent of revenue. The chart to the right kind of shows effectively what analysts are looking at for all expenses except depreciation. This is my favorite chart because effectively we're assuming lots of productivity and lots of efficiency. So if expenses ex depreciation are going down by 30%, that's, in theory, making up for the depreciation expense that's coming online. So this to me, that chart on the right is the one that I think I look at the most. It's, again, to your point, will the revenues and profitability and efficiencies make up for the spend? Spoke about construction in progress. This is just a stack, it's the balance sheet amount. So you can just see, I think over time, the scale of that. Again, this doesn't count leases. If you put leases on top, you'd probably double each chart. But again, this is CapEx that's yet to be placed in service. To your point, George, so there's this concept called RPO. So nerdy accountant, I'm guilty for this one actually, remaining performance obligation. And this is effectively, if you contract with a customer into a revenue contract, a few years ago, you have to start disclosing what is my contracted revenue. So that's what RPO means. Basically, I've contracted with you, I've yet to provide a service. This measures what that amount is. So let's circle all back around to your question. Of the hyperscalers, you have $2 trillion of expected revenue. So that could square up, right? You got $2 trillion of cost, $2 trillion of expected revenue. So to your point, you do have a bit of a matching principle, which you don't have right now as a timing. You have a timing mismatch, not a necessarily revenue mismatch. This is probably the most, on Wall Street, the #1 metric people look at. And it's not just the stack of that metric, but the rate of change. You want to see that number keep going higher. If that number starts to stagnate or pause, that's when the calculus flips a little bit. So far, you can see the charts, it has a good trajectory. But this is what analysts look at. I'd say besides the CapEx metrics, this is probably #1 or #2. All right, so let's get into BBB. So again, I look at things through a little bit of a different angle. So we try to aggregate through the financial statements. It's probably at best imprecise, but if for investors, that's what we have. So we're starting to see the benefits from immediate expensing, the R&D expensing and roll forwards. And so you can see where we've measured, where you've seen the biggest beneficiaries. based on the charts I just showed you, probably shouldn't be a surprise that hyperscalers and communication services have seen the kind of the biggest benefits. That should make a lot of sense, given the Venn diagram of what they're investing in and the amount that they're investing. So this is a chart. So let me explain methodology here a little bit. So again, I'm coming through this from an accounting lens. So the effective tax rate, again, is on an accrual basis. It doesn't capture timing differences between cash taxes, right? So that's the blue line. The little dotted line is the statutory rate. And then we call this, the red line, the cash tax rate. So this is probably an imprecise measure as well. It says this is what cash taxes paid divided by pre-tax income. Now, pre-tax income is on an accrual basis, so I understand we're mixing and matching. But effectively, you can see the difference between an accrual system and a cash system is what that delta shows you. And I think what we're seeing here is that that red line we are expecting based on our estimates and given all the capital intensity that I just showed you, will probably dive to its lowest level, is my guess. That's not necessarily a bad thing. I mean, if you look at the policies, and they may be intended to incentivize investment, and that's what it's doing. But from a revenue standpoint, you could see some fiscal pressure, based on our interest rate strategies in terms of the corporate tax base going from 400 billion-ish to something further south than that. We looked at these companies. We do think there's going to be an earnings and free cash flow tailwind. So it's good for companies. They're going to have more free cash flow. In theory, you can reinvest that and go buy more NVIDIA chips. We are seeing the benefits of the expensing policy. This just tries to measure what we're seeing in terms of where that incremental capital investment is going. And it is going to the largest spenders. It is going to the hyperscalers. It is going to the largest taxpayers. And so this is our look at the Russell 1000 and looking how those benefits have revised up over the past couple of years. So we don't call it FDII anymore, right? I don't know what the new acronym is. So we looked at foreign derived intangible income, and we looked at the impact, the provision of that is favorable on a GAAP basis, both for the effective tax rate and for free cash flow. You can see on the bottom left here where we sized who has kind of purported the most gross benefits. It's probably unsurprising, but again, it fits with the theme of all the other charts that we've showed. It's a lot of the hyperscalers, it's a lot of the AI providers, a lot of the media and tech companies. This is we're just kind of sizing what that benefit is for a handful of companies here where we've seen the biggest benefit. So you can see that decline in the effective tax rate, particularly for Amazon. And then the right side, you can kind of see the gross benefit per company. Probably hit on this as well. We've already seen the chart at the top, so let's replay that one. But we do expect these benefits to build. I think if you have profitability come online, a lot of the R&D benefits are also going to get pulled forward as well, so that will continue this dynamic. So, one of the things we witnessed is the share of revenue from corporates, again, it's about $400 billion, but it's declined from 11% to 6%. I think our view is, again, describing everything we've kind of walked through with the elevated investment, that 6% probably has a lower bound to it. And while it's not a large share of our fiscal, it does, everything at the margin is impacted, particularly when we're in a rate kind of managed environment on the short term of the curve. Yes, it's on the list. Sorry, should have labeled that, my bad. And we've seen that through the receipts data as well. So we've kind of seen less receipts than expected. And that does matter. Again, these numbers really aren't that big in the totality of things, but if you look at it on the margin, it does actually impact the rates market and the funding markets, particularly in the short term, if we have a yield control in the long term. So, and if you pair that with some of the changes with the Federal Reserve and how they're managing, it does take liquidity out of the system. So all these things in aggregate are maybe more meaningful than a few $1 billion. The last thing I just want to hit, I can have it as Q&A. For those of you that are non-accountants, I'm also guilty for this one. So we do have new accounting disclosure where we break out in the tax footnote what your expected tax rate is, which is the top line or tax expense. I guess we have both here, gross and rate, and then what your reported is. So it's a reconciliation table. What is new is the foreign tax effects used to be one line item. So you'd blend together all of your jurisdictions. Now, if it's material, you have to break out on a company-specific basis what's moving your tax rate within that differential. So I think it's a good step forward for investors to try to understand why the rate is what it is. I will agree with some companies that it could be misinterpreted, but transparency at least opens a conversation. And so we've had a lot of conversations with corporates, with investors. Why this company doesn't have a significant presence in Singapore? So I do think it's a helpful conversation. And so that started this year, and I think it's a footnote that will be helpful for investors and for tax policy experts as well. All right, maybe I'll pause there. If there's any questions I can help with, or.
Thanks. I have a question about the pairing up of revenue and costs. So the CapEx for a hyperscaler, you're talking about there's a time mismatch with their revenue, but I'm also thinking that all that CapEx is revenue to someone else, the chip manufacturers, the construction firms. And I know like some of that will be imported generators and whatever, but where do you see that fitting into this conversation about deductions versus maybe like more profits somewhere else in the system?
No, I think that's absolutely right. That's why I called it like the Goldilocks period, because to buy the turbines from Caterpillar, to buy the chips from NVIDIA, to buy the TPUs from Google, there is revenue flowing in, and that revenue is being recognized. There's just a timing mismatch in terms of the cost. So if I spent a lot on CapEx and I've got to turn it on, your margins are more or less protected, right? And so you can also choose when you want to turn that on. And I think it goes to that RPO slide. There's the expectation that revenue is going to come through, right? So you build a data center, you contract a bunch of compute. That sits in the RPO, that's off balance sheet. The CapEx is you have to turn on, that's, I guess, on balance sheet or maybe a lease. And then it just kind of flows through. I think if the ROI disappoints, though, that's kind of the risk factor.
That was going to my question. Yeah, are you concerned that the revenue won't be there and there'll just be this $2 trillion expense without offsetting revenue?
I think that is the concern. That's why I think that RPO number is probably one of the most important financial metrics you can look at. Because if that stops growing or if that gets walked back, then you have a bunch of costs that are committed. And that's where things kind of could escalate. The RPO. So this is just a handful of companies, right? There's more RPO within the ecosystem. But this is what we look at. What is that rate of change in that cadence? This is $2 trillion of committed revenue. So these are contracts with people committing to buy compute. So it could be OpenAI with Oracle. I'm committing to buy this much service revenue compute. This could be. That's a good question. So each company's RPO's definition is a little bit different. So I would generally say this is a balance within the next 2 years. So the other risk you have, I think, this is a huge investment, and you're going to have, we've already seen it last week, you're going to have construction delays. Like the two biggest constraints are labor and energy, right? So trillions of dollars, and it's hard to find people to have the skill sets to build very sophisticated investments. It's hard to get a natural gas pipeline. And so those are the constraints. And so it's not like, I don't think there's a view really, a consensus that this compute won't be built. I think it's when is the question. And that's where I think you have particularly potentially some issues that if you have delays and they're being funded through different investment structures, that's where it could get a little challenging, right? So I think the 2 trillion is real. It's higher than that. I think what the concern is the bottlenecks, labor and energy. I think the biggest risk is a timing mismatch.
Todd?
Yeah.
Isn't there also a location mismatch? Like if we go to your last slide of where the income is, because the expenses are all in the United States, right? Every single expense that you've shown on those slides is a U.S.-based expense, right? It relates to build out of data centers primarily.
I think that's an issue.
Yeah, but the income, I mean, this is random, but the revenue may come in, but there's no indication sitting here today of where that revenue was coming from, the United States or elsewhere.
Correct. And by the way, this is a consumer company, not a hyperscaler. But I think that matters. And I think also, probably you all know in this room better than me, getting liquidity from foreign jurisdictions back to the US for the investment, I think has been tricky or challenging. Where you've seen a lot of more foreign denominated bonds. So I do think liquidity and capital constraints are a dynamic as well.
On the tax side, it's also that the U.S. tax system will bear all the expenses, right? But the income may may go to other countries, and so the timing mismatch and the may work itself out, but the location mismatch for the U.S. tax system may not work itself out.
I think that's fair.
Well, it's not going to be earned by somebody who doesn't own the company, right? I mean, it's either going to be owned in the U.S. or in a foreign affiliate. They would in the first place.
Depends on how much foreign tax gets paid. The income is going to be taxable here one way or the other, whether it's under necktie or directly in the U.S.
But the primary tax
So how do we have foreign sources? These are United States data centers, right? The CapEx is generally going into U.S. data centers?
It's primarily U.S. I'd say 85% U.S.
And is there much use for U.S. data centers outside the United States? I guess I'm not saying the case for much non-U.S. income if they're U.S. data centers, or is that technologically?
I mean, you can put a data center in space, right?
And it's still useful to?
Yes.
Okay.
Yeah.
The data center is not going to attract the bulk of the profit. I think it's pretty clear. I think it's pretty clear that all the companies here, actually the LLMs themselves. I think it's expected that the LLMs, so not the oracles of the world that are only in this for the infrastructure, but the Anthropics and OpenAI and Google Meta that are in there for the top line revenue based on the intangibles, they're not likely to be putting that revenue in places like Germany and Japan. It's likely that the German footprint and the Japanese footprint will be reduced to the extent possible. We'll pay some tax there, but the overall tax profile will be first, is it going to be profitable? All this becomes academic, but if it is profitable, then the goal is going to be reduce your foreign tax so that the incremental, the non-routine return that's going to be in the U.S. one way or the other, either directly or through necktie, will result in U.S. tax offset by the minimal amount of foreign tax. So I do think that if the business becomes profitable, the U.S. is going to turn into the big winner here, with the two variables being, is it going to be profitable? Because you do have to cover the trillion or whatever of capital expenditure. And second, how much can you keep the foreign tax depressed? And this is why there's a true danger that the foreign governments are going to say, we don't like the cost plus return on data centers. We want a, DST for AI.
Right. And speaking of executives, I think that's. Oh, okay.
I'm Pam Olson, and I'm delighted to be able to moderate this panel on the role of minimum taxes on businesses. And I'll start with introducing the panelists. To my immediate right is Drew Lyon. Drew literally wrote a book on minimum taxes called Cracking the Code. I don't know whether it's still in print, but I'm sure we can get a copy for you somewhere. In addition to writing the book on corporate minimum taxes, Drew's a former principal at PwC. He also served as Deputy Assistant Treasury Secretary for Tax Analysis, worked at the Joint Committee on Taxation, and did a brief stint at the White House, where he did not work on repealing CAMT, to the best of my knowledge. Next to Drew is Barbara Angus. She didn't write the book, but she may have written a couple of the taxes that we're going to be talking about. In addition to that, Barbara was a principal at EY. She was Chief Tax Counsel of the Ways and Means Committee. She was International Tax Counsel at the Treasury Department and also worked at the Joint Committee on Taxation. And then finally, to Barbara's right is Adam Kern, who's a professor at the University of San Diego Law School. And he didn't write the book or the taxes, but he has written a lot about minimum taxes. So we have a really good panel here to discuss this topic. In thinking about the paper that the three of them have started drafting, it's going to be a great read when it's done. It's going to be well worth the wait. It occurred to me that Billie Holiday may have written the lyrics for the panel. You can help yourself, but don't take too much. So I have to say that I really appreciate the efforts of AEI and the University of Florida and the others who've been involved in planning this project for taking it on, because it's so important for us to approach tax issues from a policy perspective as opposed to a purely political perspective. I've been in Washington for a very long time, and over the decades I've seen things increasingly drift from a conversation about what policy should be into what's politically palatable. So clearly we have a lot of minimum taxes because somebody on a populist bent said something that resonated. And so, when we got CAMT, even though there were a lot of folks at the Treasury Department who had written and spoken against the idea of CAMT, they found themselves unable to say anything because it was going to scratch a political itch. So we're going to back away from the political side and look at this from a policy perspective. What should our North Star be before George Callis's politicians take over? So with that, I'm going to turn it over to Drew.
Okay, thank you, Pam. So we want to start out by defining minimum taxes. And it used to be easy to define a minimum tax. It was a broad base with a lower rate, and you compared it to regular tax, and that was a minimum tax. And on the list of current and recent minimum taxes, several of those fit that model. The 1986 corporate AMT, which I'll refer to as the pre-2018 corporate AMT, CAMT enacted in 2022, and the QDMTT follow that model. So I think of those as sort of the traditional minimum taxes. What's interesting are these more recent foreign minimum taxes, GILTI, NICTI, and the Pillar 2 taxes, with the exception of the QDMTT, is here, instead of comparing the minimum tax liability to regular tax, you're comparing the minimum tax liability to the foreign tax on that income. So there is a distinction, and it does affect our analysis of the different proposals. In terms of our analysis, we assume, like any government policy, the purpose is to maximize national welfare. And I think Mindy might have had that as what the principles of taxation fall from. Interestingly, if to economists there's a social welfare function with all the individuals in society weighted appropriately, corporations don't enter the social welfare function. So when we're analyzing distributional effects, we want to analyze that at the individual level, not the corporate level. Mindy had a longer list of objectives of tax. Maybe the economists sort of boil it down to distribution and efficiency, where efficiency can subsume lots of things like administrative costs and compliance costs, so forth. So we will analyze each of these taxes sort of with that framework. A social welfare function is a very theoretical idea. You have to know a lot about what society's preferences are. But there are cases where we can find taxes that raise the same amount of revenue, have essentially the same distributional consequences. So that allows us to focus on the efficiency effects of the taxes. We're not always going to be able to do that, which means we can't maybe find a superior tax to the tax in question, but in other cases we can. In terms of the distributional effects that we're going to look at, or that are assumed in this, traditionally it's horizontal equity and vertical equity being the progressivity of the tax system that's desired. It's often thought that minimum taxes result in a more progressive tax system, and that's a good thing. But that same progressivity can occur really through any change in the corporate tax that raises equivalent revenue. There's not a different distribution across income groups from a minimum tax relative to other corporate income taxes. So that's going to allow us to put vertical equity aside in most cases. Horizontal equity, how different individuals are treated. At first, it might seem that a minimum tax is important in there because there might be zero tax companies in the absence of minimum tax and high tax companies. But again, you want to analyze how the individuals are affected. And let's assume shareholders bear a disproportionate burden of the corporate tax, the minimum tax, then the shareholders are affected. But what's important to recollect is a lot of these taxes are capitalized into the expected return that the investor is going to receive. At the corporate level, let's say that a fully taxed investment yields 10% before tax and 5% after tax, which would occur if there were a 50% corporate tax. And then there's a tax-favored investment that's effectively untaxed. It also yields 5% after tax, but in that case, it has a 5% pre-tax return. So an investor in either asset is earning the same after-tax yield on the investment. So there is a question, is there any horizontal inequity? Are the different companies affected differently? One pays no tax, the other pays 50% tax, but they both earn the same after-tax return. And I would suggest initially that they are treated equally. You might argue, well, they're inframarginal profits that one of the companies may be earning. And so one shareholder does do, one company or shareholder in that company does do better. Well, if that is occurring, that should be capitalized in the share value of the shareholder. If you're getting a higher return on one asset than the other, it's going to sell at a higher price. So a new shareholder is really treated equally whether they're investing in a tax-favored company or a fully taxed company. And then you might say, well, we saw some AI companies earlier for which the founders hold a great deal of investment. They didn't buy it at the IPO price. They got it much earlier. Maybe they're earning what you might call excess returns. Well, that can be occurring whether or not it's a tax-favored company or not. So minimum tax isn't really addressing that. But let's continue the analogy of a tax-favored company. The special thing about most of these minimum taxes is you only trip into the minimum tax if you make an excessive amount of the benefit, like the Billie Holiday song. If you only partake a little in the tax-favored investment, you're not affected by the minimum tax. So the minimum tax is really a poor way at addressing this last problem that I suggested of founders earning high inframarginal returns. The way to address it is to do away with the tax preference, period, on all investments if it's believed that the tax preference should not belong for distributional reasons. What I think, again, many people are bothered by the idea of zero tax companies, but I think what it's really pointing to is an efficiency issue, not a distributional issue. And to go back to the example of a company that earns 5% pre-tax and 5% after-tax on a very tax-favored investment versus another investment that has to generate pre-tax profits of 10% to earn 5%, that's a real efficiency issue. You could increase output in the economy by 5% by transferring $1 of investment from the tax-favored investment into the fully taxed investment. Instead of earning 5% on that last dollar pre-tax, you'd be earning 10%. So that would be more output for society. So that's an efficiency issue. And you might say a minimum tax can address that by disfavoring those tax-favored investments. But as I just mentioned, that only occurs if a company invests an excessive amount in the tax-favored investments, enough to trip the minimum tax. If you're really concerned about efficiency, if this is a tax preference on an investment that has no positive externalities, you should do away with the tax preference in the regular tax system. That would generate efficiency on all investments. There are other efficiency issues. Minimum taxes add additional calculations, add complexity to the tax system. There have been questions about whether minimum taxes interfere with the automatic stabilizers of the tax system. This is the idea that when you enter a recession, income taxes decline, and that helps moderate the severity of the recession. Well, it could happen that with minimum taxes, as income falls, if the tax preferences are relatively stable, that's when companies get tripped into paying the minimum tax. So there are other ramifications of a minimum tax. Those are sort of the criteria that we're going to be applying. And now starting to dive into the specific taxes, I'll cover the first two, well, the first one rather briefly, the pre-2018 corporate AMT. This really was a classic minimum tax in that taxpayers were required to add back to the regular taxable income certain adjustments and preferences, or put another way, take less favorable deductions on certain items. So for example, private activity taxes on bonds were fully included in taxable income. Depreciation was taken more slowly under the minimum tax rules. So thinking of our criteria, I would argue there's nothing in terms of progressivity achieved by that minimum tax that couldn't be achieved through any other corporate tax change. On efficiency grounds, those changes, for example, reducing preferences across the board, would have been more efficient than only taking it away from companies that tripped in to the minimum tax, assuming, again, it was desirable to limit those tax preferences. So this is a case where we can construct an alternative that raises the same revenue, has the same distributional effects, and is more efficient. You would cut back preferences under the regular tax to the extent that you wanted those cut back under the minimum tax. This can be true even when there are positive externalities. So for example, let's say the minimum tax limited the use of the research credit, which the pre-2018 corporate AMT did. It did it only for companies subject to the minimum tax. It didn't take it away from other companies. You could have had a more efficient result by having a lesser reduction in the research credit for all companies. So the repeal of the corporate AMT was short-lived. In 2022, CAMT was introduced, but it had a somewhat different flavor in that it was a tax on adjusted financial statement income. And so it wasn't directly enumerating what specific policies of the regular tax system were being taken away under the minimum tax. It just said, we're going to use financial statement income with some limited statutory adjustments, such as depreciation was conformed between tax and financial statement income. So in thinking about CAMT, it's really, well, what is it about financial statement income that makes it a better tax base than taxable income for the regular tax system? And mostly academic accounting professionals are quick to cry out, well, they're set up for two different purposes. Accounting financial statements income is intended to inform creditors and investors on the long-term profitability of a company or the viability of a company, whereas for tax purposes, you want a tax base that is easily auditable, is predictable. You might want stability in it. You might not want much discretion by the taxpayer of how much income they can declare, whereas for financial statement income, there is a degree of discretion provided to the auditors. Given that they're constructed for different purposes, you might want to make some adjustments to them. The concern to the academic accountants is financial statement income will become less informative over time to investors if it's also used as the tax base. And the simplest example is, will companies choose to report less financial statement income because that would lower taxable income? Some policy advocates say they'd be fine with that if companies want to reduce their tax liability by reporting less financial statement income. In fact, they may be concerned that companies have been aggressively maybe overstating financial statement income. So this provides a counterforce. Another concern by the accounting academics, well, there was a conference last week at Georgetown on tax sovereignty. They were thinking in the international context. But here the issue is, if the accounting standard setters are actually setting the rules for the tax system, is Congress willing to cede that authority to those bodies? Is Congress giving up sovereignty over the tax code to the accounting standard setters? And if Congress is not willing to do that, are they effectively going to rewrite the financial statement rules? And then, again, the financial statements would become less informative to investors. The other issue is, as we saw in the CAMT legislation, the tax code generally is used for many social and economic policy objectives. Some of those you may want to carry over to the financial statement minimum tax. Very few provisions were carried over into CAMT, depreciation being the most notable. Spectrum rights was another. But was Congress really intending that every other policy objective in the tax system should not be carried over? I don't think they made that sort of affirmative calculation at the time. Again, CAMT is cutting back against many of those policy objectives that are built in to the regular tax system. On efficiency, there are some issues that you're only paying CAMT when the financial statement income exceeds your regular taxable income. And again, it's only if you fall within the scope of CAMT. Complexity is also an important efficiency concern here. There was a recent survey conducted with the help of the Tax Executives Institute of companies with an interest in CAMT, and they reported that CAMT compliance costs amounted to 10% of their overall compliance costs. So you might think, well, they're already reporting financial statement income. It can't be that much more complex to then calculate taxes off of it. But there's a lot of crosswalking that needs to be done that does add to complexity, and tax planning if you are on CAMT. And the complexity isn't only for the companies that pay CAMT, but are potentially subject to CAMT either now or in the future, that they have to plan for it. In terms of how many companies are affected by CAMT, Treasury in the fall of 2024 estimated about 100 companies annually would be paying CAMT. And to put that in some perspective, that's 3% of all companies with revenues exceeding $1 billion. I don't have a breakout for income exceeding $1 billion, which would be the more accurate comparison. But there are a lot of very large companies that are not subject to CAMT or likely to pay CAMT. So in terms of alternatives to CAMT, here it's harder to say exactly what that is because the financial statements are an amalgam of differences between regular taxable income and financial statement income. But I would argue efficiency and simplicity would be best served if Congress focused on the financial statement differences, the specific items that they're most concerned about that differ from regular taxable income, and change the rules for regular tax directly, similar to what I had suggested the better reform for the old AMT would be. So I think that would be feasible. Congress would be making an affirmative decision of how they want to change the regular tax instead of selecting just several items where CAMT today conforms with regular tax.
So my job on the panel is to talk about the BEAT. The BEAT predates CAMT, so it is styled as a minimum tax, but one more like the 86 Act corporate AMT, although it also has some features that are quite different from minimum taxes. So just to start with a brief description of BEAT, and it is hard to do a 30-second description of how BEAT works. But like a traditional minimum tax, it's an add back to the regular tax base of base erosion benefits, which are basically any deductible payment to a foreign related party to the extent that that payment's not subject to U.S. withholding tax. The rate is 50% of the corporate rate. There are special rules about the treatment of credits, with particular focus, although not a lot of discussion about it in the legislative history, but foreign tax credits are an important element here. The BEAT rate, the way the tax works, the BEAT rate is applied to the BEAT base, and that amount is payable to the extent it exceeds the regular tax, but it's the pre-credit regular tax reduced by the amount of foreign tax credits and other credits to the extent that they are not specifically allowed. And so that changes, that effectively changes the base, but capped by 10% of the 10.5% of the expanded base. And then applicable taxpayers, it applies to, it has a revenue threshold and also a base erosion percentage threshold, and that's the percentage of deductible foreign payments as a percentage of total deductions. So the legislative history is relatively brief, but the Senate Budget Committee report includes some reasons for change with respect to the BEAT that were developed by the Senate Finance Committee. And so they cited three concerns: base erosion by foreign multinationals with U.S. subs, tax incentives, the tax creates incentives for foreign takeovers of U.S. companies and inversions of U.S. multinationals, and then a concern about outsourcing of activities by both U.S. and foreign multinationals to the detriment of U.S. jobs and activity. The objectives cited as being achieved by the BEAT was that it would level the playing field for U.S. and foreign multinationals, and that the BEAT, together with the corporate rate reduction, would encourage economically efficient foreign direct investment. So while the legislative history was brief, since BEAT was enacted, there have been hundreds of pages of articles about BEAT that include significant criticisms and counter-criticisms. So criticisms from all directions. And to be fair, you don't usually see a lot of long articles describing what is good about a provision. And you certainly don't see that about BEAT. But to be fair, criticisms tend to be written about more. So the definition of base erosion payments has been criticized as both too broad and too narrow. So those who object to it being over-inclusive cite its application to payments that are properly transfer priced, to payments to high tax countries, or to payments that are subject to U.S. tax, for example, under Subpart F or GILTI. Because in all those situations, there's little indication of indicia of base erosion. And those who object to it as being under-inclusive cite the exclusions for cost of goods sold, which isn't really an exclusion because cost of goods sold isn't a deduction, but the BEAT didn't try to bring cost of goods sold into its base, and some services, and the concern expressed by those who object to that say that allows for some base erosion. The treatment of foreign tax credits and other credits is another area of criticism. Foreign tax credits are not allowed against the BEAT, and then there's the phenomenon that foreign source income and foreign tax credits can increase the BEAT liability because they're a reduction in the offset for regular tax liability. And that the same issue applies with respect to the other credits that aren't allowed. And then the two thresholds are both objected to as creating cliff effects that result in very high marginal rates. Some object to the revenue threshold as too high and argue for replacing it with a phase-in or just eliminating it. And some object to the base erosion percentage as distortive, arguing for its elimination or for changing it so that it instead is a percentage, it's foreign related party payments as a percentage of income instead of as a percentage of other deductions. Since the BEAT was enacted, there have been a variety of proposals to significantly change or replace the BEAT, and those proposals in some ways address some of these criticisms, and in other ways they exacerbate the criticisms. So in the 4 years of the Biden administration, we saw 4 proposals to replace the BEAT with what became the UTPR. In the first year, they couldn't call it the UTPR because that wasn't the discussions of it hadn't yet finished on the global stage. But it would replace the BEAT with a UTPR and a domestic minimum top-up tax. And so the UTPR element really served to focus what was the BEAT on foreign multinationals, and it also eliminated the focus on denying deductions for what were deemed to be base erosion payments, although the collection mechanism for the UTPR was denying deductions for otherwise deductible payments. So there were some elements there. As part of the Build Back Better bill, so same time the administration had these proposals to replace the BEAT, the House version of the Build Back Better bill would have expanded base erosion payments and increased the BEAT rate pretty dramatically, but it would have provided an exception for payments subject to U.S. tax or sufficient foreign tax. And most recently, as part of the OBB3, the Senate Finance Committee version included some substantive changes to the BEAT that weren't ultimately enacted, and that included an exception for payments that were subject to sufficient foreign tax, but it also increased the rate and reduced the base erosion threshold. So again, addressing all of these proposals address some of the criticisms and not others. So thinking about the factors in assessing the BEAT, thinking about the BEAT as a minimum tax, unlike a classic minimum tax, the expanded base does not necessarily move the base closer to true economic income. The denial of deductions for the full amount of a related party payment would reflect economic income only if the arm's length transfer price was 0. And so there might be some instances where there is a move toward economic income through the BEAT if the excess of the actual price and the arm's length price exceeded the difference between the arm's length price and 0, but it is not a systemic move toward toward economic income. And so the rationalization that you can use of using a lower rate it's hard for the lower rate to justify a base that is overtly non-economic income. Necessity for an alternative base. It is an adjustment to regular taxable income, and so it could be done by just denying some of those deductions in the regular tax, mechanism for achieving the stated rationale. It doesn't target base erosion with any particular precision. It doesn't necessarily achieve a level playing field, in part because of other aspects of the U.S. tax system, and the fact that it includes payments that are subject to U.S. tax, and the treatment of foreign tax credits as a reduction in the offset for regular tax. So some have described the BEAT as in part a minimum tax on foreign source income, which didn't seem to be one of its original objectives, and it creates incentives for what may be less economically efficient transactions because they help to avoid getting into the BEAT. Thinking about it from a national welfare perspective, there are distortions that are caused by the uneven effects. It favors certain industries over others or disproportionately impacts certain industries. It has sort of almost infinite marginal tax rates or infinite marginal tax rates near the threshold. So a lot of incentive to avoid crossing a threshold if you're near it, and the combination of covered payments and the treatment of foreign tax credits creates just some almost random effects. There are distortions, which I think is true of any minimum tax. There are distortions when you have companies that may or may not be within the BEAT in any given year. They then face two different tax scenarios that they have to plan for, and different companies are in different spectrums as to whether they have to worry about those two sets of tax systems, and it can encourage the substitution of less efficient transactions, discouraging related party transactions in favor of unrelated party transactions. It also could just encourage the restructuring of a related party transaction, although some of the commentators have suggested that this move to less efficient transactions might be offset somewhat by a move away from transactions that might have been driven by base erosion and therefore were not originally the most economically efficient transaction. I struggle with the implications of a world where other countries or all other countries adopted a BEAT. What would that world look like? And it doesn't feel like it would be a good world. In terms of alternatives to the BEAT, and this is maybe the hardest question, and I think the BEAT's novel approach reflects the difficulty of developing a solution to the underlying concerns. One obvious suggestion is to improve the transfer pricing rules and their enforcement, although that sounds a little, to quote another famous speaker about tax policy issues, the Duke women's basketball coach's advice that you need to handle hard better. I think the starting point for developing any kind of alternative has to be the clear delineation of the intended policy objective or objectives, and that you may well need multiple measures to address what are multiple objectives. Some have suggested you could use a fixed rate excise tax or a partial deduction denial, which certainly would eliminate things like the cliff effects. Others have suggested that you really need to look at some of the more fundamental reforms that were discussed earlier today.
Okay, so now I'm going to talk about two foreign minimum taxes. I'm going to talk about GILTI, or now necktie, and then I'm going to talk about the global minimum tax, Pillar 2. So foreign minimum taxes are distinctive. They are distinctive because they back up regular taxes that that are imposed by other countries. So short of invading, you cannot replicate these taxes by adjusting the regular tax. We need a different framework for evaluating them. So I'll start then by talking about necktie. And my remarks on necktie are going to be brief because we already had a couple of really excellent panels on CFC regimes. So I'm going to keep this at a high level. But you can view necktie as attempting to balance two competing concerns. On the one hand, we want to avoid the erosion of the US tax base through profit shifting to low tax countries. On the other hand, we want to preserve the United States as a competitive destination for the residents of multinational entities. These are probably relatively mobile taxpayers, so if we tax them at too high a rate, we should expect that fewer companies will establish their domiciles in the United States. And the general structure of necktie is kind of a sensible way of navigating that trade-off. You don't want to totally exempt the necktie base because doing so would erode the US tax base. And you don't want to tax it at the full corporate rate because this base is relatively mobile. So instead, you take a middle course and you tax it at a preferential rate. Now, obviously, there's a lot more to be said about the structure of necktie and whether it achieves those goals. In fact, there's a lot that already has been said right here about that. But when it comes to what is the role of minimum taxes on business, that's sort of an intelligible role for at least that minimum tax to play. Okay, that's it on necktie. So now we're going to go global, and we're going to go from necktie to Pillar 2. And I think things will become a lot more controversial now. So like necktie, two of the main elements of Pillar 2, the IIR and the UTPR, are foreign minimum taxes. They back up regular taxes that are typically, not always, but typically, imposed by foreign countries. So they can't be replicated by adjusting the regular tax, and we need a different framework for evaluating Pillar 2. And evaluating Pillar 2 from the perspective of national welfare is complex because Pillar 2 is a cooperative agreement. So to evaluate a cooperative agreement from the perspective of national welfare, you can't just ask one question, you need to ask two questions. The first is, does collective implementation of this agreement benefit your country? So if everyone implemented it, would you be better off? And the second question is it in your interest to implement it yourself? Those two questions are not the same. They are distinct questions because of the logic of collective action. So even if Pillar 2, taken as a whole, is good for a particular country, much of its benefit may arrive whether or not that country implements it itself. So taking on the cost of implementation may not pay off for that country. So I'll start by talking about Pillar 2 and its potentially elusive cooperative gains. So it's an open question whether full implementation of Pillar 2 will be beneficial or harmful. I think we on this panel have somewhat different views on that question. But regardless of where you land on that question, you should be interested in whether Pillar 2 is stable. You might lament Pillar 2's demise, or you might joyously celebrate Pillar 2's demise, but you should want to know whether it's headed in that direction. And in this vein, focusing on the stability of Pillar 2, we've really drilled down into the UTPR. The UTPR is the linchpin that holds Pillar 2 together. If the UTPR did not exist, Pillar 2 might quickly unravel. Countries would have incentives to disband their IIRs or their QDMTTs to attract firms' parent entities or profits. And the UTPR resists that. By design, the UTPR is very difficult to avoid. Its nexus requirement is minimal. A firm is exposed to the UTPR if it has any constituent entity in any country that enacts a UTPR. And any country that enacts a UTPR can collect all of the top-up tax that is potentially owed under the UTPR. So put those features together, and you have an instrument that is very strong at reducing or neutralizing the incentives for countries to withdraw from Pillar 2. Withdrawal is attractive if you can buy additional tax base by cutting your rate. But the UTPR, if it's enacted and firms are in scope, ensures that covered firms pay tax at a minimum rate regardless of whether a single country withdraws. So if those conditions are in place, withdrawing from Pillar 2 just buys you nothing. So that's how the UTPR kind of fits into Pillar 2. It's a very strong rule. It's a very expansive rule. And precisely because it's so expansive, it's attracted a lot of controversy. There is real pressure to narrow it. And there are different ways that one might do that. And they would affect the stability of Pillar 2 in qualitatively different ways. And I think it's worth thinking about how they might. So one first option is to tighten the UTPR's nexus requirement. So for example, you might allow a country to assess the UTPR against a firm only if that firm has like a minimally sufficient economic presence in the country. That reform potentially destabilizes the UTPR itself. The UTPR's stability depends on there being redundancy. So if multiple countries can impose the UTPR on a single firm, no single country's decision to say, okay, I'm not going to enact this UTPR anymore, matters for the firm. Tightening the nexus requirement reduces that redundancy. And if you tighten it enough and one country remains the only one that has nexus with the firm, it's pivotal. So its withdrawal from the UTPR can eliminate the UTPR's effect on that firm entirely. So one consequence of that is that tightening the UTPR's nexus requirement potentially has cliff effects in Pillar 2's stability. Another way to put that is it doesn't matter until it does. So eliminating the 20th or the 10th or the 5th UTPR backup doesn't really undermine a country's incentive to adopt or maintain its UTPR, but eliminating the last backup country does. So there is a potential cliff effect. There's no impact until suddenly there's a very large impact. A second option is to weaken the UTPR's allocation rules. So for example, you might allow a country to collect a share of UTPR top-up tax only if the firm has a minimal amount of economic substance in the country. And that reform, in effect, allows withdrawing countries to give a partial exemption to the UTPR. So weakening those allocation rules has a gradual effect on the UTPR stability rather than the sudden effects that you might have with nexus reform. A third option is to give source countries or the parent jurisdiction like a veto over the UTPR. So under current rules, a residence country can block the UTPR by enacting an IAR or necktie or any other minimum tax regime that qualifies for the side-by-side agreement. Potentially you might want to go further and allow source or residence countries to block the UTPR even if they don't tax the firm at a minimum rate. That reform is a very drastic reform. It's tantamount to undoing the UTPR itself. The whole purpose of the UTPR is to stop source or parent countries from letting profit go undertaxed. And so if you gave them a strong veto, stronger than anything that exists under current rules, you're essentially handing them that power back. Okay, so where you come down on those potential reforms depends on whether you think that Pillar 2 itself will produce cooperative gains. So if you think that Pillar 2 will be beneficial, you might want to avoid large impacts on its stability. However, if you think that it likely will be harmful, you might welcome those effects. So far I've talked about the UTPR's relation to the first question for evaluating Pillar 2 from the perspective of national welfare. So that's its role in achieving cooperative gains under Pillar 2. And now I'm going to move on to our second question. So even if Pillar 2 will be collectively beneficial, and even if the UTPR secures those benefits, is it in a country's best interest to implement the UTPR itself? In many cases, the answer to that question might well be no. So to get into that, let's start with a puzzle. So earlier this year, I have it on Drew's authority. There were 62 QDMTTs, 47 IIRs, and only 33 UTPRs. So if the UTPR is so important, why have many countries not implemented it? And now one explanation is that they just don't understand the UTPR. But another explanation is that they understand it pretty well, and they've determined that enacting it is not in their own interests. And one potential reason for that is, even if we concede that Pillar 2 is collectively beneficial, the UTPR is a public good. The UTPR stabilizes Pillar 2 for the whole coalition, for the whole Pillar 2 coalition, and a country can benefit from that stability even if it does not enact the UTPR itself. Meanwhile, enacting the UTPR has some costs. Maybe you will deter potential investment, maybe you'll create diplomatic frictions, maybe you'll earn a reputation as a country that's not so friendly to business. So a country might reasonably think that it might benefit the most by collecting the benefit of Pillar 2 stability without bearing that cost. And before we move on from that point, I would note that the timing of implementation and transition effects only aggravates that. So once QDMTTs and IIRs are widely adopted, the UTPR, in theory, will only be rarely imposed. But right now, during the transition, the UTPR might actually be assessed against firms with little or no activity in particular countries. And that means potentially significant costs for early adopters. Okay, so the last topic within Pillar 2 is the QDMTT. And so the question here is it in a country's best interest to enact a QDMTT? And the answer, we think, will often be yes. And the reasoning to get there involves a couple of steps. So the first step is, does it make sense to kind of try to soak up the Pillar 2 minimum tax? Does it make sense to tax firms that are within the scope of Pillar 2 at least a 15% rate, even if you might want to tax firms that are out of scope at potentially a lower rate? The answer to that question, for a couple of reasons, is plausibly yes, you might want to do that. In-scope firms probably earn more economic rent than out-of-scope firms, and rent can be taxed efficiently, so the optimal rate on them is higher. Additionally, if you don't tax them at the minimum rate, it's not as though the firms are just going to avoid tax. The tax is just going to be collected by someone else. So the second step is, if you have decided to tax firms at least the 15% rate, how should you do that? Should you enact a QDMTT, or should you adjust your corporate tax? Typically, enacting a QDMTT will be a more precise response. It collects exactly the minimum tax obligation and no more. So I'll now close with just a question to kind of chew on. So the question is, what does this mean for the United States? And to be a little bit more specific, should we replace CAMT with a QDMTT and appropriate targeted adjustments to the regular corporate tax? Obviously, that's a major reform to the US tax system, but it could have some potential benefits. It could cut compliance costs substantially, and any revenue loss that might be occasioned by it could potentially be made up for through regular tax adjustments. And to the extent that the revenue is not made up for, maybe that's revenue that the United States should not be
collecting in the first place. But there are some potentially significant downsides from that reform as well. So I'll just note one, and that is that this reform would limit the US's flexibility in enacting tax incentives, because in order to still qualify as a QDMTT, you need to meet the rules that are promulgated by the inclusive framework. So those trade-offs are large and they're complex, but we think that they deserve serious thought and further study.
All right, thank you all. I'm not sure that there are any points that you'd like to discuss among the three of you before we open it to questions, but have just an observation on your last point, Adam, which is that I've forgotten, maybe 4 or 5 years ago, there was a Senate Finance Committee hearing on international, and I was one of the witnesses at the hearing, and there was a lot of focus on BEAT, and there had been a lot of Democratic focus on BEAT not raising the revenues that had been projected, which is basically, I think, a misunderstanding because the revenue estimates actually showed up in regular corporate tax as opposed to in BEAT, which is probably the same thing we're seeing in CAMT. So I was anticipating those kinds of questions, but the questions that the Democrats turned out to want to focus on was the adverse impact that BEAT was having on tax credits. And so that would seem to be a stumbling block in moving to a QDMTT.
That's true. I mean, it's also a potential issue under CAMT as well. So there are many potential credits that people would like to see preserved that can sometimes get turned off by CAMT. I think in order to evaluate that choice, you need to kind of look at them one by line and really point to, are there particular tax credits that live under CAMT but get turned off under a QDMTT that are really important and are so important that we should want to preserve them despite the compliance burdens under
So
CAMT.
it's really another step in the same kind of analysis that you'd be undertaking with respect to the minimum taxes in general. Is there a more efficient, effective way of getting to the same amount of revenue?
The Biden administration budget proposals that would have replaced BEAT with the UTPR also included, they didn't call it a QDMTT, but that's what they were. That's what it was, and it had a third element, which was an undefined. We're going to use other measures to protect and preserve the benefits of U.S. credits. CAMT was enacted during the tenure of that series of proposals. And my recollection was that there was no suggestion that they would repeal CAMT. So you could also do CAMT plus a QDMTT, and this mythical or yet to be determined protection of credits.
Because one can never get enough minimum taxes. Yes.
Another issue with Pillar 2 and its attempt to limit tax competition, I think John Bella might have referred to it this morning. We're sort of assuming countries only compete on taxes, but if there are non-tax subsidies they can offer firms that aren't within the scope of Pillar 2 rules, then Pillar 2 may not be achieving anything.
But it's certainly keeping a lot of tax people busy. All right. More, the three of you want to comment on each other's presentations? Otherwise, we can throw it to the audience for questions. Okay. Question from the back.
So we're seeing Congress increasingly rely on book income for or financial earnings to impose minimum taxes. How dangerous is this policy of weaponizing GAAP accounting for tax policy? Does it risk poisoning the financial statements themselves, forcing companies to alter their financial reporting to manage their tax liabilities, and ultimately degrading the transparency and data quality that investors rely on?
Is Todd still here?
Yeah.
I was thinking of that same question as a question I wanted to put to Todd. But so just going back on some historical experience, I mean, Drew, you mentioned the fact that book tax distortions can go both ways. If we think back to a crisis from 2021 Enron, that was
2001.
2001. That was generated by generating a whole lot of book income that did not fall into the category of taxable income. So they were reporting enormous amount of income to shareholders, but not on their tax returns. You know, I think one of the issues that's always bothered me about it, I'm not suggesting that we should conform book and tax more as a way of addressing it, although that is something that we looked at the Treasury Department back in 2001, 2002. We actually had a tax shelter proposal that was based on book tax differences. But it is a constant confusion. I mean, I remember testifying once before a House Budget Committee and having one of the members say that he was shocked to read my testimony that shareholders got one number from companies and the IRS got another. You know, I think what we've seen so far, obviously CAMT has a lot of adjustments in getting from pure financial statement income to the applicable financial statement income that's used for CAMT. But I think what we've seen so far is that you know, companies are playing this pretty much straight up. I don't see it. I think it's been a big concern, but I don't think, at least based on what I've seen and heard, I haven't seen it having an actual empirical effect on companies.
I mean, one of the other issues with using financial statement income as a tax base, and it doesn't have to do with your weaponizing point, but it is relevant to Pillar 2, is that there is not one accounting standard in the world. There are several at a minimum, and maybe many, and a lot of so John talked about the 1,000+ pages of rules related to Pillar 2. A lot of some of those pages, but probably not enough yet of those pages, are about reconciling the differences between GAAP and IFRS. That if you want to have one standard, you need to have one standard, and we don't have one financial accounting standard either to use as a base for some kind of global tax.
Yeah, and you know, and sometimes the concerns go the other way as well. I recall Marty Feldstein when he realized that financial statements didn't take into account expensing, was very concerned and thought that there should be an effort to go to FASB and get FASB to recognize the benefits of expensing, and said, I don't think that's really a good idea. I think we should just let them do their own work, keep the tax out of it.
So I think you're making this point that following the side-by-side agreement, a QDMTT would prevent foreign-parented multinationals from having an IAR imposed on their U.S. operations. It wouldn't matter for U.S.-parented multinationals. Do we know, are there any empirical studies on how much those foreign-parented multinationals would be paying on their U.S. operations post side-by-side?
Not that I'm aware of. Just as a general matter, the empirical literature on the effects of Pillar 2 is just in its infancy. Because the agreement is so young and it's only partially implemented yet. You know, I've only just started seeing some empirical studies of its effects come online, and I'm not aware of anything that picks out that precise issue.
So back when they were debating CAMT, there was a lot of concern about using book income because it would claw back the benefit of accelerated depreciation. In response to that, they allow you to adjust. So AFSI is adjusted for accelerated depreciation. Given that, how much concern should we have about the efficiency effects of CAMT? Do we think it's nothing with respect to investment, or should we still be concerned?
I guess that there are all the other deductions in the code. I do think actually most tax credits are permitted against CAMT to the same degree they're permitted against regular tax, the general business credits. But other expenses can trip it up. The other interesting feature, CAMPI is really just a timing of tax differences, so it's an acceleration of tax. But we noticed with some of the tax disclosures companies were making late last year and early this year, there is an effect because under CAMTI, they're expensing an asset at a 15% rate, but the future income may be taxed under the regular tax system at a 21% rate. The other issue is to the extent they already have tentative minimum tax over regular tax, expensing lowers the regular tax by 21 cents, it lowers their tentative minimum tax only by 15 cents. So the wedge increases that they're paying. Their absolute level of tax has gone down, but their minimum tax amount has gone up.
Mindy?
So the question you posed at the beginning was, what is the role of minimum taxes on business? And I think I heard from Drew and Barbara, probably none, but even if there was, what we have is poorly designed to achieve their objectives. Correct me if I'm, and from Adam, I think I heard maybe some role in a kind of global cooperative objective. Did I misstate Drew and Barbara's?
I think you stated our conclusions relatively accurately. And speaking on behalf of Adam,
always happy for you to do that.
It's not necessarily just cooperatively. It could be in a country's own interest, even without cooperation, as the U.S. enacted GILTI, without necessarily expecting cooperation, for it to be in a country's best interest, potential.
Yeah, I think I'm following up on Mindy's point, and a question that's probably familiar, well, I know it's familiar to the panel because I've posed it to you before, and that is to sort of imagine a world in which collective action takes place not at the point of a bayonet, which is to say a world in which new regimes are introduced and countries are encouraged to adopt them. I note, Gary can correct me if I'm get the date wrong here, but I think the OECD released the transfer pricing guidelines in 1995, a number of years ago to be sure, but not centuries and centuries ago. So in a relatively, I would say, brief period of time, the OECD transfer pricing guidelines have been not universally adopted, but quite broadly adopted by a number of jurisdictions. But without there being any sort of forcing function from the OECD or any other jurisdiction, it was just essentially a set of best practices or a standard to say, you all should consider adopting this. I asked sort of you guys to consider the counterfactual, which is the OECD, instead of introducing the UTPR as a concept, had simply introduced the idea of an IIR and had encouraged jurisdictions that are the headquarters of most of the world's multinationals to adopt an IIR. Would we be, how different of a place would we likely be in today? And how do we think we would feel about that in the lens that you guys have applied to analyze this stuff?
Well, one thing that I thought about as we were working on this paper is that when the U.S. adopted GILTI and did the changes, all the changes in the TCJA, unlike after the '86 Act that had a big reduction in the corporate tax rate, you saw other countries responding. You didn't see, and then the U.S. got way behind, but this time you didn't see immediate response to sort of immediate individual country response to GILTI. You saw this idea that we should have collective action. We should copy GILTI, not exactly. We're going to make it different, but we're going to do it collectively and try to bind each other to do it. And it made me start to think about the fact that we did GILTI against a move from a worldwide tax system to, what is it, a fig leaf of a territorial system that was described earlier today. Whereas for the rest of the world, a GILTI-like provision or the IIR is against a backdrop of a territorial system. And did that change the dynamic of response that made countries unwilling to do what the US did, which was to do it alone?
I think there's a collective action problem in Europe. You think about the number of years that Europe spent trying to push the concept of a CCCTB, and they couldn't get there. They needed the OECD to step in and make the whole world do it, and then they could move in that direction.
Yeah. And within the EU, I assume individual countries could not have adopted an IIR without a change to EU rules.
I expect you're right. You're saying essentially it would be a CFC regime and they would have to deal with Cadbury Schweppes, I assume, right? Yeah, yeah, I agree with that, I think.
So like there's like this dimension of book versus taxable income, and then there's also across different nations, there's different tax rates, like two different dimensions here. It's like one motivation for CAMT is like if there was no other countries, just the US, like you might make an argument that you wanted to tax book income rather than taxable income. And Pillar 2, my understanding is it's kind of more of a book income approach. Could you conceive of a world in which you have a minimum tax, but you somehow try to make it on taxable income across countries? Does that not make sense, or is it because it seems like there's like two dimensions here, right? Like whether you want to use book income or taxable income versus whether you want coordination.
If countries had the sovereign ability to set their own taxable income, they could set their base at 0 and have a 50% rate. So you'd need a uniform base if you went with taxable income.
And isn't that part of the reason that we ended up with what we ended up with in Pillar 2 was the lack of any kind of uniformity among the base?
That's right, but they falsely thought there was uniformity among financial statement income base, and perhaps if they were to do it over, they should start by trying to define a new base that isn't differential accounting standards, but that is a single for purposes of the minimum tax base, which wouldn't necessarily look like anybody's financial statement income.
That would be a really heavy lift.
I think that's time.
Yep.
Great. Thank you.
All right, welcome back. We're going to start a minute or two early here for our final session, a session formally titled in the agenda, The AI Race and the Role of Tax Incentives. I like to call it, we saved the best for last, tax breaks for corporations. Our presenters who are going through a set of slides are going to call it Reconsidering the Use and Design of Tax Incentives. I'm Alex Brill. I'm a senior fellow here at the American Enterprise Institute.
Do you guys have our slides? Sorry to interrupt. They're not up, that's why I'm asking.
There.
We will we'll hold for a minute here.
They're not that exciting.
No, they're really not. Come on!
Someone put in a good effort. Put these slides together. Well, I'll fill the space. We're pulling up the slides. We're digging out the slides. Thank you for catching that. If you guys need your slides, then I don't know how to help you.
Right.
But, but I think that,
We did, but I don't, we got to send over. Katie, can you get him to the, okay. We may be a couple minutes late on the slides, but to your point, Alex, no reason not to continue. By the way, that's Katie who did most of the work for this entire presentation, so.
yeah, so as long as Katie knows who to send the slides to.
Right.
The slides will go from, yeah. Okay, so, like the other panels, there's a paper underway. The paper's in draft and it hasn't been shared yet. I think we're going to have a good discussion about tax incentives, and hopefully we'll leave plenty of time for a Q&A and conversation. Maybe that Q&A and conversation will inform the completion and the writing of the draft. Joining me here on the panel is from the far end, Pat Brown from PwC, Nate Carden from Skadden Arps, and Michael Plogden from KPMG. They collaborated together with Katie and others on putting this paper together. And the basic framework, as we're going to hear, is to think about what principles we want to ascribe to or pursue or hold in priority as the government constructs tax incentives. We're thinking really here just on the corporate side, not broader than that, but corporate tax incentives, and then to go through a series of case studies to evaluate that criteria against some actual real-world examples of some actual tax incentives that exist in the code today. And so with that, let me turn it first to Pat to kind of help set the stage before we get into what those three case studies may be.
Yeah, thanks, Alex. And we deliberately teed this up to be chaotic, if you will. So I'm fully expecting all three of my fellow panelists to interrupt me as I go through this. But one thing to note at the outset, we did not seek to consider in the paper whether or not tax incentives, qua tax incentives, are a good idea. We just took it as a given. Congress, has an addiction to the use of tax incentives, longstanding to be sure, and that's not going to change. And so the question is not whether tax incentives, the questions rather are what makes a tax incentive have a better design compared to a worse design, and what can the experience of certain tax incentives that we studied in a bit more detail tell us about those design features and what makes sense and what doesn't. And then we also spent a fair amount of time in the paper considering this question of administration of tax incentives. And because obviously you run something through the tax code, and we all know who's responsible for administering the tax code from the government's perspective, and that's the IRS. And as we'll talk about, the challenges that the IRS faces in administering a tax incentive are maybe somewhat different than the way we would typically think about the IRS's audit function, or maybe they should be different.
They should be different.
So,
right, yeah.
and that's one of the things we want to get to. So the three incentives that we studied in a bit more detail are the R&D tax credit. We're sort of cheating a little bit here with the second category, I think it's fair to say, Michael, but sort of the green energy incentives that were part of the Inflation Reduction Act. So we sort of group those as one. And then the artist formerly known as FDII, now I guess known as FIDE, post the One Big Beautiful Bill. So those are the three things that we talked about in detail. But just in terms of framing up, we sort of started off with a set of questions, which is for purposes of evaluating the effectiveness of a tax incentive, we said, first of all, what is Congress trying to accomplish? Just broadly speaking, Congress gets to decide what behavior they want to incentivize or what action they want to incentivize. So what are they trying to accomplish? And has Congress given essentially taxpayers and the IRS, the appropriate roadmap for what they're trying to get done? Because of course, one of the things we're trying to assess is if you are trying to accomplish certain things, and you want to measure how well the incentive is performing, it's really helpful to be able to go back to that threshold question. Why did Congress adopt the incentive in the first place? Secondly, and we'll see this a lot in the R&D credit, and Michael took the lead on that, this question of spillovers, right? And that is something where there's been a pretty significant amount of literature over time on the so-called spillover effects of the R&D credit. I think given the fact that it's been around for the longest of the three incentives that we studied, far and away the one where we have the most empirical evidence to talk about from that perspective. And then, so the spillover effect is one question. A third question to talk about is just, okay, since the incentives were enacted, have we seen evidence in the real world that suggests they're having an effect, right? And so we'll talk about that with the IRA incentives, we'll talk about that with the R&D credit, and we'll also talk about that with FDII. Compatibility with international norms. The last panel, of course, we talked a fair amount about Pillar 2, and we talked about treatment of U.S. credits. This was a big point of departure for the U.S. and the U.S. Congress in determining whether or not we should adopt Pillar 2. Is it doesn't really mesh very well with some of our incentives, notably the U.S. R&D credit. If I take a different lens at that and I look at something like FDII, at the time FDII was initially adopted, there was a lot of questions hanging over FDII in terms of its compatibility with the WTO agreement that the U.S. had entered into. That has somewhat faded, to be sure, but at the time was a big question. And frankly, I believe had an influence on how Congress described their purposes in adopting FDII, because maybe they didn't want to be quite so open about what some of those purposes were, right, because they might have sort of caused us
we want Treasury and IRS to know and follow the purpose, but we want to make sure that we hide it from the rest of the world.
Right, exactly, to the extent it suits our purposes. Alex talked about this in the title. We didn't focus exclusively, or even I would say predominantly, on AI, but we did talk about, in assessing these incentives, how technological changes may cause us to think, or maybe should cause us to think differently about the incentives going forward. And then, we also sort of then just kind of concluded with sort of based on all the questions we just went through, what would we assert are some of the factors that would make an incentive well designed? So I'm going to turn it over back to you, Alex, to talk about some of these things. But one of the things that sort of came through loud and clear for me in thinking about this, in designing incentives, is, I'll call it go big or go home. And the jumping off point for me, and this is sort of consistent with my lived experience, for a number of years worked at a company, Section 199, domestic manufacturing deduction. And we walked through in the paper how Congress ultimately ended up at Section 199 after trying a lot of other types of incentives that were found incompatible with international norms. We ended up with Section 199. Any company that was engaged in the behavior, the manufacturing, this is domestic manufacturing deduction, any company that was engaged in manufacturing activity, which was quite broadly defined, was eligible for the incentive, could put the incentive on their tax return. And they did. That's a revenue cost to the United States, right? There should be, from Congress's perspective, an offsetting benefit, which is, or some, whether it offsets or not, obviously, is a question, is a broad question, but you would expect for Congress to be doing something like that. They want to see more manufacturing activity, right? That's why you'd have a domestic manufacturing incentive. I want more domestic manufacturing activity. Certainly my lived experience was lots of folks put the domestic manufacturing deduction on their tax return, because why wouldn't you? But did it actually change behavior? Was there actually more manufacturing, or was it just, well, there's a deduction, you might as well take it, and did it actually have an influence on behavior? And that, I think, is a really critical point. And if I pivot from that question, this historical question, to the question of FDII and say, what if Congress adopted FDII, but instead of putting it in at 13.125, it put it in at 19.5? Everybody put it on their tax return to the extent they had qualifying behavior, right? You get a reduction in your tax liability. That's not hard. But would you actually have changed your behavior if you're, instead of being taxed at a 21%, you were taxed at a 19.5% rate? Probably not, right? Don't know, it's counterfactual, but probably not. So this whole question of how do you make it big enough so that you actually change behavior, recognizing that once you hit that magic threshold, every amount you spend beyond that is just costing the fisc money that you don't need to spend. So maybe I'll pause there.
Before we get into the case studies, let me just ask let me ask you, Pat, a general question about how should one identify what that notion of congressional intent is, right? And so should we be reading the report language and saying, should we be reading the hearing history and saying, should we be just asking the trade associations and the lobbyists why they were pushing for it? And the 199 is a great example. Is the intent here more manufacturing activity, or is it to try to find a WTO compliant way to replicate a policy that is being repealed and that we're just trying to, rough justice replicate tax liabilities for a group of firms?
So I have my thoughts, but I definitely want to hear from these guys on this. I mean, one wants to start with we're lawyers. We want to start with legislative history, right? Like the text of the statute itself, and then legislative history, committee reports, et cetera. Congress seems to be moving away from using a lot of legislative history, not to be sure in the case of TCJA. So I dove deep into FDII, and there's a wealth, I would say, a wealth of information in the legislative history to the TCJA about what Congress. Now it doesn't answer every question, but at least I've got a roadmap, and a roadmap that goes beyond just what's in the statutory text. It helps frame it out. But, Michael, I'll contrast that with the Inflation Reduction Act, right? Yeah. There was no committee report guidance in the Inflation Reduction Act. Right. But those were major changes to, our incentive structure. So
but I think you can infer congressional intent as well from the design of the provision, right? I mean, I think you have to do that with FIDE. I think you have to do that with the IRA credits. I don't think it's particularly hard to do in a lot of cases, because it's pretty obvious what an incentive is trying to incentivize.
I'll dissent. I mean, I read these reports, right? I don't know. Let's pick one, right? FIDE/FDII, and I'll come back to this one. But like the rules for FDII services and the rules for FDII sales do not match. What's the policy?
Yeah, look, I'm not going to disagree with you on that, Nate. I agree. You can't answer every question.
At a high level, though, right? I mean, the goal of FIDE is relatively clear.
Well,
in terms of where do you book income?
Yeah, I guess, right? But like this stuff has to get enforced, and ultimately you have to answer. You have to be able to answer.
Well, but I'll take your question, Nate, and sort of come at Michael. Kind of challenge your point a little bit on this as well. So, in the One Big Beautiful Bill, right, FDII became FIDE. We moved from foreign-derived intangible income to foreign-derived deduction-eligible income, right? What was dropped from there? Intangible, right? It is very clear in reading the legislative history of TCJA that Congress was thinking about mobile intangible income and wanting to remove the disincentive for that to be owned in the United States, right? So let's try and encourage that intangible income to be owned in the United States. They changed the name in 2025. They dropped the intangible. They changed the design to accompany that, right? They dropped this concept of not being eligible for your routine return element. And all the economists in the room will say, well, that means they moved away from intangibles. And I'm going to tell you, I don't think for a second Congress thought they were moving away from wanting to attract high margin intangible income into the United States.
Because it's in the report language?
No, there's no report.
So because?
Right.
You know how.
There is no report. So we all have to just guess that's, but I don't believe for a second that Congress, so one of the things that we talk about in the paper is like in assessing how well FIDE is performing, how much can we rely on what Congress wrote in 2017 and the emphasis on intangible income? I would say we can still rely to a very significant extent. It would have been really helpful if Congress had said what I believe was the purpose of making the change in 2025, which was a lot of taxpayers going to Congress and saying, I love this FDII thing, but I've got all this plant and equipment, capital stock in the United States, and the computation that you're making me do is wiping out the benefit that I would otherwise have, and so I'm no longer incentivized to bring my IP back to the United States.
But wasn't the principal, just to run with that one a little bit, wasn't the principal criticism of the FDII math relative to the guilty math with QBI that it encouraged tangible asset investment offshore and it discouraged tangible asset investment onshore, and people said, well, we really don't like that, right? Which that might be true, we really don't like that, But that's entirely contrary to the idea that we want high intangible assets in the United States, and we're not worried about tangibles.
I want to hold on the details because we've got slides that are going to get everybody.
We got slides, we got points.
They're not my slides or your slides, but I think everyone's going to want to see them. So we're going to do
Alex.
what
Very
I call
exciting.
FIDE and you call FIDE. Well, I guess I could drive, but okay. So we did this one.
We did the core question, I think. Right?
We did this one.
Yep.
I think we even did this one.
Sort of.
Sort of, yeah.
Unless somebody wants to say more here. Oh, no, we didn't. Correct. All right.
So, I mean, well, I'm not sure what to say about this. I would look at the incentives that we studied and say the first goal, attractive investment or mobile income to the United States. I would say that is transparently the goal of FDII FIDE. I think, and Michael, you know, you studied the R&D credit and the green energy incentives. To me, that's a little bit more nuanced in terms of what they're trying to do there. So, you know, are we competing for the location of activity? Are we trying to have more activity than would otherwise be the case? Are we doing both? You might even argue, by the way, that FDII is not just trying to encourage where the income is, but also trying to pull other stuff in with it. Although, to go back to our discussion, because I'm not going to leave it, Alex, of legislative history, you know, Congress talked about in the committee report to FDII this idea, they hinted at this idea of trying to have valuable activity associated with the ownership of this mobile income, that's one of the goals. And yet the FDII regime does not have anything in its design that would say you get more, and this is a big contrast with the green energy incentives, you get more if you behave in a particular way in terms of having more employees or things like that associated with the IP income. Yeah. So I would say FDII transparently offers the first of those as a rationale, maybe also has some of 2 and 3 in it, but I think, Michael, for the credits that you looked at,
yeah, I think for FIDE, to be fair, my guess is that 2 and 3 are probably in there as spillovers, right? Which you talked about at the beginning. The idea being that as you bring income into the U.S., especially IP income, that's going to translate into additional jobs in the U.S.
Maybe.
Well, but I think that is part of the thought behind it. Clearly, for the R&E credit and for the IRA credits, it's 2 and 3 primarily, trying to encourage activity, R&D activity, but activity in the United States, right? I mean, the credit and now deductibility of R&E expenses depends on where that activity takes place. Same thing for the IRA credits. Where does the investment happen? Is there a certain level of domestic content? Those kinds of things. It's clearly trying to get new activity, but new activity in the U.S.
But this is controversial and historically not always true with respect to clean energy credits, right? Yep. I mean, you're focused here on the clean energy credits from IRA, but those credits go back to the late 70s, I think, right? Yep. And really one of the inflections, or one of the changes in IRA were these domestic content rules, which previously, and from folks who have concerns or interests in clean energy, location may be completely unimportant for someone with a climate agenda. For someone with a manufacturing agenda, may be critically important.
Yep. Right, absolutely. And actually, I think for the IRA credits, the first goal is important as well, because it clearly attracted investment from around the world into the U.S. into these industries.
So one of the things, Michael, and I know we're probably going out of order, Alex, but one of the things that we talk about in the paper is this concept of periodically reassessing whether or not the incentive makes sense. And I think that's going to be vitally important as we talk about technological changes and things. But the R&D credit is a really great example in some respects, but in other respects it might be an example of, do we really want to have these things keep coming up for renewal?
Yeah.
So, because the R&D credit was temporary for many, many years, arguably, I don't know if people have more of the history of this than I do. Maybe you came across it, Michael, in your analysis. But it seems like it partly became over time just something that you would go in to talk to congressmen about, or congressmen and women about, and usually with your donation check to their reelection campaign to say you wanted the credit to get, you know, redone or re-up, whatever. And so how much of that led to any sort of constructive reexamination, which I think we say in the paper is really important, that this happens over time. But maybe the right way to do that is not through this sunsetting, but I don't know, Michael.
Yeah, well, and it's interesting because there's another cost to that constant renewal, which is that at least in studies in other jurisdictions, but also you can see this in the literature about the U.S. R&D credit, there's a much bigger impact on behavior in the long term than there is in the short term. And that's probably not surprising. Right? It takes a while for taxpayers to get their arms around how to comply, how to use this in their budgeting and planning cycles. And so initially, the R&D credit didn't have a whole lot of uptake, and that's consistent, again, across countries. Over time, much bigger impact. And so the constant expiration and renewal may have had a dampening effect.
I mean, it has a lot to do with expectations, right? I mean,
absolutely.
If it's expiring, but you expect it to be extended, and it's just a technical matter, then you might behave one way. If you really have no idea if it's going to be extended, you're going to behave in a very different way.
Right, until it doesn't. I mean, the thing that I guess I felt like we sort of left off the slide, though, that is coming up here sort of tangentially is, you know, who decides? Right? Because all these, what some people might refer to as a spillover effect from FDDEI, I might also call the private sector deciding what the most efficient way to take advantage of a competitive tax system is, as opposed to, you know, a collection of political actors deciding we like this activity, we don't like this activity, here's the line.
Right.
Right. So I guess, you know, when we say what's the goal of incentives, I do think it's also important to think about, you know, who do we think are the most reliable deciders of who should get the incentive, the private sector or, you know, the people that think are taking checks.
We have two different answers to that question, right?
Correct.
In FDII.
Absolutely. And that, right. I mean, that's the distinction that I want to call out here. It's not just, to my mind, the positive economic activity effects of something like FDII or 199 are not limited to what I would call spillover. It's also a public-private decision.
Okay, let's move forward. We can tee up here the three we already have, but these are the three broad credits that we're almost done. We haven't even started, but these are the credits, the three case studies. I don't know if anyone wants to lay out some of these details, or we just want to let the audience absorb it for a second.
Yeah, I think we've touched on, one thing that we haven't touched on in the 250 context is this idea of parity between GILTI and NICTI. And, you know, this is where I don't, George Callis is in the room and he's slinking down in his chair. Maybe that's just George, who was on the Hill when TCJA was adopted. So, you know, the antecedents to the TCJA were actually then Chairman Camp's HR 1, which was essentially a blueprint for what ultimately came, much of what was adopted in the TCJA. And he did have, Chairman Camp's HR 1 did have this concept of essentially rate parity for activities that were performed in the United States that benefited foreign markets or that were targeted at foreign markets and that would therefore get a lower rate, versus if you perform those activities outside the United States for foreign markets, and they would get the similarly low rate. And the idea here was sort of parity between those two. You know, I would say that kind of stands on its own four legs, but I think it was also, and I alluded to this a little bit earlier, packaged in part in the legislative history the way it was to try and essentially draw attention away from the notion that FDII was giving a lower rate for export income, because the US had a long history of trying to offer incentives for export income and finding them essentially challenged successfully by the World Trade Organization, or before that, the Global Agreement on Tariffs and Trade. So you know, I think that parity, as I say, it stands on its own four legs, but I also think that it was packaged the way it was because there was some concern on the Hill that this was a vulnerability for FDII. By the way, and just I know we want to move on, Alex, but that vulnerability was not just a sort of academic concern. It was, of course, there was the possibility of a real challenge, but there was also the real concern that the incentive would not be effective if taxpayers did not believe it was going to be around, right? So if you believed that there was a serious vulnerability, and to be sure, many of us did, I did in 2017, believe that this was going to be vulnerable to challenge, would I take that leap and move my IP back to the United States when several years later, I might no longer get that rate? Oh, but guess what? I still got my IP in the United States, and good luck getting it out if I wanted to reverse course. So I think that was a real feature that, in the packaging of the design that was really intended on the part of Congress, again, stands on its own legs, but also to make to essentially increase the attractiveness of this, to basically encourage not just other countries, but taxpayers. This is something that actually does pass muster under trade obligations, and therefore you can rely on it. It's going to be around.
You're also framing this as the core objective being the location of the IP is in an economic sense, and that along with these other two examples where we're thinking about real economic activity. But the way the slide's set up and the way the paper is set up is it's really about, as it says here, grabbing hold of a taxing jurisdiction. Yeah. So it's a financial matter more than a real economic matter. And in a sense, I mean, it's debatable, right? Yeah. Whether or not what's the benefit? Who cares where the IP is, right? That's a question one would need to answer. If you said, and frankly, one could ask the same question about R&D, yeah. Right? We want R&D in the world. Do we want it in the United States? Right, like we all benefit from. We benefit from the right. Maybe we benefit more from domestic R&D, but we benefit from the R&D that happens outside the United States in a global economy, right? So the location issue, I think, plays a big role here.
Yeah, I mean, except I think if you go around the world and look at places that have gone with a sort of low rate strategy, you see a dramatic increase in economic activity, right? Maybe some people think not as much as justifies the amount of income that they're earning, but I think 50 years of history tells us that it works.
Works for
the jurisdiction.
For the jurisdiction.
They choose to be competitive.
Right. And my point is that there may be a spillover to the rest of the world.
Yeah. Right.
Move on.
Sure. All right. So let's talk about the R&D credit. The legislative goal of the R&D credit is relatively clear from the legislative history. Congress was concerned that private sector spending on R&D in the U.S. Was not keeping pace with Japan and West Germany, and that was making the U.S. less competitive in global markets. And so the idea behind the R&D credit was to get U.S. firms to spend more on R&D. And so the big question, right, in the literature is Pat's question about 199. Is this just an incentive that is, losing revenue for the fisc and not really changing behavior? And one of the things that Congress did to try and address that was to make it an incremental credit, to say you get a credit with respect to your increase in qualified research expenditures over a base amount. And that has changed over time, and now there's the simplified way of computing it, but the basic framework is the same. It's only on the incremental spend above a base amount. And in theory, that ought to help address this idea of, we're trying to get taxpayers to increase their own spending on R&D rather than just replacing private spending on R&D with public spending. And as we've said already, there's just a tremendous amount of literature about the U.S. R&D credit, as well as R&D incentives around the world. And there are a couple of things that come out of that literature. None of this is bulletproof, right? I mean, I don't want to pretend that we are certain about anything here. But the themes that come out of the literature are that, by and large, R&D incentives tend to increase private spending on R&D. They don't just substitute government spending for the private spending on R&D. There are also a few interesting studies that suggest, right, on this question of, well, okay, so maybe spending goes up, but all you're really doing is you are increasing the wages of the people who would have done the same amount of R&D anyway. And that is harder to tease out, but the studies do suggest that it is an increase in activity, an increase in employment in research occupations, and maybe more interestingly, it also has a positive impact on the number of patents that are issued. So there does seem to be a positive, real impact on not just private sector spending, but on innovation. And then I guess the other thing that has come out of this is the spillover effects that we've touched on a little bit so far as well, right? So the idea is that you've got an increase in knowledge through an increase in R&D that can positively impact not just the firm that incurs the spending, but on similar firms as well. And there have been a number of studies that show that firms in the same industry also create more patents, even if they didn't take advantage of the R&D credit, which I think is an interesting takeaway here. It also is, again, in theory, makes workers more productive and the U.S. economy more competitive in global markets. One of the other things that has come out of the cross jurisdictional studies as well is that it's not clear that the incremental design of the U.S. credit is actually more cost effective than just a flat credit across all R&D. Right, and again, none of this is certain, right? There are studies that say that yes, it is more effective. It's more efficient in stimulating R&D spending. There's a study out of France, though, that said when they changed their R&D credit from an incremental credit to a volume-based, just on all R&D, their private sector spending on R&D went up significantly. And the idea there is that the incremental approach is a little bit more complicated, but it also reduces the incentive for R&D spending. And whereas a volume-based approach just can be a bigger incentive to do R&D spending. And in fact, according to OECD statistics, the U.S. is on the lower end of OECD countries in terms of the generosity of the R&D subsidy under the U.S. tax system. One of the other things that we see in the studies is that the impact of the incentive is very different across different types of firms, with the big dimension being larger firms versus smaller firms. With smaller firms being more responsive to the credit to the extent that they can actually monetize it. And so they do tend to, if they can monetize it, meaning generally they have a tax liability, or they can use it against their payroll taxes after 2015, then they tend to increase their R&D spending more than larger firms. On the flip side, there's some speculation in the literature that larger firms may have greater spillover effects in terms of the kinds of research that they do and the greater reach within the economy, leading to more benefits across industry. And so there's a little bit of this trade-off of, should we be trying to really target the smaller firms that respond more strongly to the incentive, or should we be trying to incentivize the larger firms to engage in more R&D? there's just, I think, a split in the literature there. It is an important element of this debate. One of the things that when I was at Treasury, the economists there were very focused on is the question of refundability and the idea that smaller firms do tend to be more responsive to the incentive, but for a lot of them, they just don't have an income tax liability, and the ability to use the offset against payroll taxes is very limited, and it's time limited as well, and that can really reduce the benefits that smaller firms are able to get through the R&D credit, and may reduce the amount of R&D that we have in the U.S. economy.
Is there a theory why small firms would be more responsive, or it's just an observed fact?
I don't know. There may well be. I'm sure there are theories as to why it is. I just take it as an observed fact.
I mean, perhaps it's the case that the smaller firms have some sort of constraint to the financial markets, right? They can't finance their R&D in the same at the same price. Right. You know, they can't borrow at the same price as a large firm. So the large firms can borrow more cheaply, and therefore they're already doing all the R&D that they could possibly imagine. Yep. And you know, maybe someone has the opposite theory to suggest. But it would be pretty important that it's not just randomly observed, right? I mean, like you'd want like it to be really consistent. It seems like a difficult thing to measure because the types of firms that are small might be different. They might be in different industries. They might be doing different things. The nature of being a small firm might be that you are, I mean, the reason you set yourself up is because you have an innovative idea. That's why you left Google to start your own company, is because you were R&D focused, and you thought you were going to do something different than what the, some slower, larger firm that you were previously employed by. And so and so we're getting, the credit is targeting the larger firms, not intentionally, but
just as a practical matter, it does.
There's also perhaps the case that it's just there's a fixed cost associated with participating, and that a small firm, goes like an administrative thing. Is that likely that if you're a small firm that the compliance cost associated with claiming the credit is too high to claim the credit?
A lot of the studies do talk about that for sure. Yeah, that these are high compliance costs, right? And so they disproportionately impact smaller firms.
Yeah, there's a fixed cost element to it. Right?
This is probably as good a time any, Nate, though, to talk about the fact that one of the things Alex talked about, observed facts. One of the facts that I think we all are observing in practice right now is a very significant uptick on the part of IRS audit activity on companies availing themselves of the research credit. Right. And that I realize, Nate, we're going way out of order here.
Why wait? No, that's absolutely right. I mean, this sort of gets to the fundamental tension that we talk about in the paper, and we have some examples, et cetera. But at a basic level, right, what you're now seeing with the IRS auditing R&D, right? I mean, I think they call it a campaign, right? So there's a systematic sort of review of this thing that is, putting pressure on companies that are claiming the R&D credit, either challenging the documentation as being inadequate, or looking at base period, or the sort of are you doing the work or supervising, or are you supervising supervisors, right? And getting all kinds of strange line drawing questions there. I mean, the fundamental question, though, that we're asking here with respect to those kinds of policies is not so much like what do we think of the IRS R&D credit campaign, as it is like, should Congress, Treasury, somebody give direction to the IRS that says this is something that we're trying to encourage. I come out on the on balance thinking that's a very hard thing to sort of see in statutes, right? I mean, we do see it. Treasury in a few other contexts has issued regs that I think are designed to preempt the field vis-a-vis other anti-abuse provisions, and I think that's a good idea. But in terms of like whatever Section 41Q, give taxpayers a break. I think that's just a really hard thing to ask an agency that is charged with enforcement to do.
Yeah.
But this is a universal concern, right? I mean,
Yes.
this is friction, right? I mean,
Right.
what I think economists might call friction. So IRS is imposing a friction. It's making it more difficult, less reliable, more costly to claim the credit.
Right.
On one hand, but maybe we're getting really high efficiency for those who wiggle their way through the right. You're only going to do this if you're really innovative, if you're really, if there's some return, right? You may end up with a smaller, more efficient credit,
right?
Or not, right? Or maybe you're just
right.
Or maybe you'll just claim the credit, but you'll wish you hadn't after the IRS gets through with you.
The last R&D project I ever did.
That's financing, right? But yeah, I mean, ultimately, right? There's, on the other hand, you might think, look, we don't know, as Congress and Treasury, we don't know all the things that would be good to encourage. Yeah. So, we'll write relatively broad rules, and then that gets back to the question of, legislative history, policy purpose, how do you know? The only, maybe we all have a sense of this provision, that provision, the other provision, but the only time that actually tends to become an issue is when there's a fight.
Yeah.
And so at that point, everybody has an incentive to read the legislative history, with the preferred outcome in mind.
So I know we're going to move on to, and this is actually, Alex, this is part of the moving on to the green energy credits, but it ties back into the point, Nate, you were just making. So my lived experience back at the company with renewable energy credits before the IRA, when they were not transferable credits, there was broadly proliferated tax equity structures. This was a mechanism for taxpayers who were building wind turbines, were installing wind turbines, to essentially avail themselves of the production tax credit. They didn't have the tax base to use it themselves. Mainly large financial institutions did have the tax base, were willing to provide investment, and through that mechanism, essentially, you got more wind turbines built. That seems consistent with Congress's goal. But the catch or the trick was these deals were largely pre-tax negative, right? For the bank, for the financial institution investing. They were not making positive cash flow before you considered the impact of the credit. Now, for tax lawyers, we hear that and we think your only meaningful return on an investment is a tax benefit. That sounds to me like it could be an economic substance problem, right? Or one of the other judicial doctrines. Very clearly, right? You would worry about that, right? And indeed, we did. Now, you could say, well, this is obviously behavior that Congress intended to encourage, so therefore it shouldn't apply here. And that's generally, I think, the analysis that we went through and the conclusion that we came to. But at the same time, you could also argue, the counter argument that we made was, well, Congress didn't make these credits transferable until the Inflation Reduction Act. And what you guys are doing is essentially self-help transferability. Right. Well, if Congress wanted to make the credit transferable, they could have made it transferable. The fact that they didn't, you're making self-help transferability. Does that return you back to this question of the economic substance doctrine? So, I mean, Nate, it's sort of a question for you and the stuff that you had done. But I agree with you. Broadly speaking, it's hard to sort of provide in the text of a statute, be nice to the taxpayer.
But I think that does get at the one idea that we kind of collectively had where you could do something like that, right? Which is, for reasons I don't fully understand, right? We decided to codify common law in 77010, but that does then create a mechanism to turn it off.
Yeah.
Right? Section 77010 and the judicial doctrines referenced therein shall not apply to the application of this section.
Right.
That wouldn't be a bad thing to put in something where you want people to find a way to finance the activity without worrying about pre-tax profit.
Right. Yep.
Do you want to add more on this?
Yeah, just briefly. So as I think Pat said at the beginning, there's not a whole lot of data yet on the IRA credits, the effectiveness of the IRA credits. There are some studies that show a significant increase in investment in emissions-reducing technologies as a percentage of investment in structures and machines. I guess one of our big takeaway on IRA energy credits is that there are multiple legislative objectives in these provisions. The big one obviously was emissions reductions, but you have the domestic content provisions are intended to impact supply chains. You've got the prevailing wage and apprenticeship provisions that are intended to have labor impacts, and you've got energy community provisions that are intended to impact where these investments take place, where these projects take place. Anecdotally, what we see is that the prevailing wage and apprenticeship provisions typically are assumed as part of the project. Those tend to be complied with. The other provisions, which incidentally have a smaller bump associated with them, are much less commonly complied with. Again, anecdotally in our experience. And so...
Just to be clear, so
Yep.
if you don't comply, you're eligible for something but less.
Credit,
But,
exactly.
Right, so you can get it, but you get less. If you comply with additional rules that are imposed, you can increase the...
Exactly, and so it seems like that those incentives were not necessarily large enough to change behavior in the way that Congress wanted behavior to change.
Can I ask a question on that, just from your kind of lived experience dealing with this thing? Is the lesson that you took away from that, the thresholds matter and that sort of thing, or is the threshold that in designing these things, like, pick a lane? Like, don't try to, if you're trying to do all these things, you're actually going to end up with an overall incentive that doesn't accomplish as much as what you're hoping to.
Well, there was, I think, has been some frustration from the reg writing teams for exactly that reason. It was like, how do we balance these different objectives that we're trying to achieve? And so I think, probably there is a view that it would have been better to choose a lane.
Do they stack on top? Do they interact with each other, or they just stack on top of each other? I mean, right? I mean, it's not clear what the degree to which they integrate against, compete against each other. You can get a credit for creating clean energy. You can get more credit if you use labor.
Yeah, but there also are like the foreign entities of concern. Now also the prohibited foreign entities provisions. Those are a significant impediment in some cases, and so there was this tension among the different agencies as well as within Treasury as to how best to how to balance those considerations. I do think, but I do think to answer your question, I think it's both. Right? I think it's both choose a lane, but then also you've got to make whatever incentives that, and to Pat's point at the beginning, right? Whatever incentives big enough to change behavior. And it may be that in some cases tax isn't even big enough to change where supply chains are if wages and other costs are significantly different.
So we talked about the R&E credit and the temporary nature of that. I mean, obviously, eventually it became permanent, but for years this was a temporary, and then that brings up the question about what people are expecting, whether they were doing the R&E and expecting that it would be extended. These IRA credits were, broadly speaking, permanent credits, and they don't exist anymore, right? So to what extent does this notion of temporary versus permanent play into the thinking around some of the decisions that you've seen?
Well, I do think that the fact that they were enacted for a significant period of time did accelerate uptake, right? So you didn't have as much of a slow start as you do with some of the other incentives. But it's hard to answer those questions, right, without some significant studies on this, as compared to, okay, well, how much of this was really driven by the fact that they're transferable credits or direct pay credits, and that gives you relative certainty early on as well. I just don't think we know the answers to those yet.
So one of the things that we saw with the production tax credit, which was subject to periodic expiration, was, and this is sort of not at all surprising, but the closer you got to the expiration date of the upcoming expiration date of the credit, there was a huge upswing in orders and activity, which was great if you were in the wind turbine business, until Congress extended the credit, and then there was this huge fall off in activity for some period of time. So, there was the great quarter where the credit was about to expire and you were shoving everything out the door as quickly as you could, and that was a great quarter, and then there was the quarter immediately after that. So, I mean, there was a real
economists
response.
see this as a cost, right? Not
Right.
as like, great and okay. It's like great and bad, right?
Yeah,
This is
yes,
these are just
yes.
timing shifts.
Yes.
We see similar experiences, I think, with the expensing provision, right? Only now for the first time is expensing on a permanent basis. We've had plenty of periods of time, the last 20 years, where we've had partial or full expensing, but always temporary, and I think the evidence suggests that largely causes timing shifts in investment behaviors more than overall shifts. Anything else on this or on the administration?
Let's go to today, yeah.
Yeah, so we've talked about a lot of these points, but I'll just hit on them very quickly here. I think the overall goal, we talked about this idea of mobile income. We talked about if you, as many people did when FDII was first enacted, they compared FDII to what I'll call European or OECD style patent boxes, which broadly speaking, all have a sort of nexus requirement, right? Which is to say, you want the benefit, you need to have the costs associated with developing or with performing R&D that gives rise to intangible property. Of course, they're also referred to as patent boxes for a reason. They limit the types of IP to which they apply, another restriction that does not apply to FDII/FDAE, right? And so there's some significant differences there. I think of the things that we haven't talked about already, the one of the factors that Michael, you touched on with the R&D credit, which is I definitely see as well in the FDAE context, is the impact of the taxable income limitation. The reality is if you are not profitable or not significantly profitable, this deduction is not very valuable to you because it's capped at your taxable income. There is no mechanism for carrying it forward or back. And so this is definitely a regime that rewards essentially companies that have already experienced some meaningful degree of success, as opposed to, hey, start up your company, own your IP here. You may not be profitable now overall because you're still ramping up. Expenditures are outpacing revenues, but you'll have this benefit that you will ultimately come to realize. I think Section 250 looks at that question and says, no can do. And again, it's not even just that if you're not profitable. If you're not profitable enough in the current year, there's not even a carry forward mechanism. So on that measure, it is an extremely harsh result. That now you could say, well, look, the goal of Congress is to attract the tax base, the primary taxing rights over this mobile income. Well, if you're not profitable, I don't really care, because there's no income for me to tax. I mean, that's not an irrational thing for Congress to necessarily have done. But, if you take the long view over this, could you maybe even do better on that if you were actually a little bit more generous and allowing some sort of a carry forward? I think that's I again, don't know the answer to the question, but it's one of the things, it's a distinguishing feature of FDII/FDAE that aligns with some of the restrictions that Michael talked about earlier, but that could, at least in some fact patterns, will limit its effectiveness. I think the only other thing I'll mention in this regard, there are a few things about Section 250 that sort of stand out, and one of them is there is a very clear assumption that there is not valuable IP in the financial services sector that we care to attract to the United States. Because it's a categorical exclusion. Financial services income, which is very broadly defined, is just simply carved out. I think there are folks in the financial services sector who might take issue with the characterization that they don't actually have any valuable IP that is worth attracting to the United States. But it's just categorically carved out.
And make a defense for that? What's the rationale?
So I think, and not having been inside of Congress at the creation, unlike some people in the room, I think the reason it was carved out is because I believe the assumption of the drafters was financial services income is synonymous almost with passive income. And there's not a lot of IP associated with passive income, interest, dividends, and that type of activity. And you can sort of see a path in the way that the language was drafted to, yeah, we're trying to carve out financial services income, but they cross-referenced to what in the regulations is a much longer list of income that would include things like activities in the investment banking space or things like that, which could have a lot more services activities, which to Nate's point are within FDII.
Do we think, I mean, just to say it, right, and then I think we have a question in the audience, but I don't know, maybe that's true. I wasn't in there either. It struck me much more as a, politicians want to be able to say, I like Main Street, not Wall Street thing.
Well,
not
it could be. It could be.
I mean, not a real policy-driven decision.
We know that in the 86 Act, why did the active financing exception go away? The understanding is that the chairs of the committees hated the banks. They were mad at the banks. And so they dropped the active financing exception. That was a long time ago. I don't know if it's true. It was before I was a tax lawyer. But so it could just be that.
Fire away.
Why they would have not just linked to the definition of passive financing income within financing income or financial services.
It's a great question to be asking, and I don't know the answer to that question. I mean, I think there's probably a broader answer beyond the sort of simple answer I gave, which is passive income, which is that this income is money over money. It's got less to do with the kinds of things, the IP that we would traditionally associate with, with foreign-derived intangible income, I'll say. But George is going to answer the question for us.
Well,
in the form of a question,
I'm going to answer a couple of tangential questions, I think, 'cause I don't specifically remember. I remember in the GILTI context, there was discussion about exempting active financing income from GILTI, because this isn't the base erosion you're looking for, especially in the QBI.
That's a great point, and that was not done.
Yeah, the QBI context, the basis of a financial instrument is not depreciable property, so it's all supernormal return, right? A 3% loan is a supernormal return.
Right.
And so there was serious discussion about that. My recollection, it was a combination of politics and revenue led to, and the big banks who don't have a lot of tax expenditures they're giving up are getting a big rate cut. Banks, retail, think of the industries like banks and retailers who are more like full rate payers.
Right.
We're getting a really good deal from the statutory rate cut. And so just sort of like, you kind of shrug.
Now that does ring true to me. I think I have heard that before.
You're going to contribute something. Is kind of, I think was probably kind of the feeling there. And then the taxable income limitation was because it was really a rate cut, not a deduction. Right? Because you can't carry the benefit of a rate cut forward when you have a loss.
Right.
And so it's mimicking a rate as opposed to thinking of it as like a true deduction. The question I had back on the R&D credit, I thought that was a very interesting comment about the incremental credit maybe not being as effective or not being more effective than just subsidizing the first dollar of spend. Was that on like a bang for the buck basis? Because obviously if you got rid of the floor and gave the credit to the first dollar, the score would blow up, I would think, right? The question really is, would the increase in the fiscal cost, how would the increase in the fiscal cost compare to the increase in R&D that results from that? Not just would there be more R&D, but like what would be the cost efficiency of that R&D with regard to the budget? I don't know whether that's something that has been looked at or not.
Well, there are a wide range of estimates of the elasticity for R&D spending, and so if you look at the high range of that, maybe even on a bagging for buck, it would pan out. On the lower ends, probably not. So I don't think we know the answer to that.
I was also thinking about what's the profile of the company that does. So a company that's either growing or flat on their R&D spend is going to stay above the threshold, and so the marginal subsidy is going to be, they're going to get the full marginal incentive of the credit. Same marginal incentive as if there was no floor that they had to exceed. So is it cyclical companies that they their R&D spend drops down during a cycle, and because they're below the floor, they become ineligible, and therefore there's not as much incentive for them to come back up. Just kind of thinking out loud as to, it's probably companies with a certain profile for whom that's true, and other companies it's not, right?
Cyclical.
Yeah, for sure.
Okay.
For sure.
One last thing to say on FDII, and I'm not going to call on him, but I see Alan in the room. You know, we don't have a lot of, I would say, in-depth studies about the behavioral effects of FDII, relatively new provision. But there is anecdotal evidence suggesting, for example, that a whole lot more royalties started coming into the United States after FDII was enacted. And I believe Alan has written about this as well. A whole lot more of the royalties leaving Ireland came to the United States. Is that right, Alan? Did I get that right?
The relevant citation is Irish economist Seamus Coffey. I'm just the messenger.
Okay, very good, very good. Well, so I heard it from Alan, or read it from Alan. But so even though, you know, one of the things obviously we want is behavior changing. Congress wanted more IP in the United States. Has it had that effect? And the answer is we are seeing more royalty income in the United States, significantly more royalty. I mean, a dramatic increase. Obviously, we don't have the kinds of studies that would look at things like what other factors could have influenced that, how much just reducing the rate caused that to happen, et cetera. We don't know. So.
Sure. We're going to go to questions for the audience in a second. Let me just ask sort of one broad question before we do that. We're right at the top of the hour here. But in the case studies that you guys looked at, 2 credits and an effective rate policy, those are not the only ways that we, 2 questions. So those aren't the only types of subsidies, right? There are other types of subsidies. And do you have any thoughts about whether these 2 tools versus subsidies that are related to deductions, super deductions, or a subsidy that is you know, exclusion of some sort of activity from taxable income might more easily hit some of these policy targets, or are these the tools that are the best? That's my first question. Yeah.
I have a reaction for FIDE, which is, and some of this gets into the question of as technological developments change the nature of the economy going forward, is this, you know, approach suited for purpose? And I actually think the answer to that is yes. I think it actually works quite well. We're trying to attract more income, and incentive that targets income makes actually a lot of sense to me. Again, I continue to think that FDII works best, or FIDE works best, targeting mobile income, IP type income, even though we've dropped the QBI aspect of the computation. And so as I think about, I was reflecting on this, you know, we just had the world's first trillionaire on the back of taking a company public that has never made any money. That's a big bet that you know, that markets are making in the future value of the IP, or the current and future prospects of the IP from that company. Income-based incentives like FDII, if what you're trying to do is get more primary taxing rights over that income, seems pretty closely tied to the purpose. So I think, but it does get back to the question, Alex, of, and what exactly is the purpose? Which is one of the questions that can be hard to answer. I think in FDII, it does have a lot to do with, we want those primary taxing rights. We're less concerned about nexus because we didn't put a nexus requirement in, but we want those primary taxing rights. And I think as we look forward, actually, it seems pretty well suited for that.
I guess just to sort of comment on exclusions, for example, I mean, one of the administrative points that I think actually Section 250 illustrates very well that we explore in the paper is, you know, line drawing is a difficult thing, and the more, you know, the more severe the consequences of being on one side of the line or the other, you know, the more controversy you have and the more administrative difficulty you have. And so to the extent that you have 2 things that look relatively similar, you know, with a 21 versus 14 rate difference, having, you know, a 21 versus 0 rate difference is putting even more pressure on that. So I just think those are, you know, when you look at how Congress has done that, I don't think that they have a particularly attractive track record. And if you look at the changes in OB3, right, with respect to Section 250, I think it's, you know, a step function worse on that front.
Okay.
I have one more question. I'm going to hold it just to allow others in the room to engage. If you have a question, raise your hand. We've got microphones coming around. You've been here for 2 days. You know how this works. Am I missing anything? Okay, while you contemplate any questions, if you have them, I do have one more, which is just going to go back to the title of this the title of this session, which is a close fit to the way that the paper came apart, but the words AI were in the title of the session, and we haven't spent a lot of time thinking about AI. Obviously, none of us are technologists, and we are all wondering and curious whether AI is going to eliminate all the jobs or create really high wages. But if you were to think about using the federal tax code to encourage AI, if that was the goal, we wanted more of it, not less of it, or actually you could say it either way, if you wanted less of it, if you wanted to use the tax code to alter the quantity of AI in the United States, what are the lessons from these three examples that you would sort of draw out and say, here's my AI tax credit? What would that look like?
Wow.
I sort of agree with one of Pat's statements at the beginning of the panel of sort of go big or go home, that you need to have enough juice in the incentive to make it worthwhile. And so I think that's sort of one thing. The other thing that I would say is that we would need to focus on what are the choke points for AI, assuming that we want to incentivize the use of AI, which may be further downstream than just targeting AI itself, right? I mean, we've got issues around energy. We've got issues around chip manufacturing, which we are trying to address through the tax code as well. So I think focusing on some of those, upstream inputs would be important.
Non-specific to AI, but related to in upstream. Okay.
I have a thought, but I'm stealing one of Nate's earlier lines, which is pick a lane. And I think this is going to be really challenging in the AI context, because when you think about the policy goals of the United States with respect to AI right now, they're not necessarily all pointing in one direction, right? We want more data centers, well, except not in my backyard. We want more data centers, but we sort of, on the one hand, we're locked in this competition with China. Very clearly, that's a driver for some of what we're trying to do. And yet there are real concerns about the potential impact of AI on jobs and things like that. And I mean, this is probably a very obvious point to make, but in order for an incentive to influence policy, you want to know what direction you want policy to go. And I don't think we're quite there yet, to be honest. I mean, I think there's sort of, broadly speaking, yes, we must do this, but all these kind of, attendant concerns that are, in the ether, and they don't all go in the same direction. So I think until we can pick a lane, it's going to be really hard to figure out what sort of incentive is best suited to drive in that direction. I continue to think that Congress is going to use tax incentives because they like them. And I think the studies that we've done here show that actually, they can have an effect on behavior in ways that kind of validates what Congress is trying to do. So it doesn't mean they're all going to be equally effective.
If we wanted more AI and we wanted a tax credit to get us there, what would that look like?
Yeah, I mean, if we wanted AI and you wanted to design an incentive, fundamentally, these tools are going to impact, basically every sector of the economy in ways that are very, very hard to imagine right now. And given that, I think that the marketplace will be much better than either end of Pennsylvania Avenue in figuring out how to deploy that. So lower the rate.
Lower the rate on AI, or
just lower the rate?
Lower the rate.
Lower if you're talking about encouraging something that is not going to be sector specific, but is going to impact kind of commerce as a whole, and you want to encourage that thing, lower the rate.
All right.
Can I maybe reframe your question? It seemed from our lunch presentation that there might not be an issue in needing to encourage investment in AI. I mean, we've got like a couple of trillion at a minimum, with numbers going as high as 10 trillion possibly. And maybe the question is, how do we make sure that U.S. has taxing rights over whatever revenue that investment generates? So we already have enough incentive, or tax is irrelevant to how much is being invested in AI. But the backside is.
How do we make sure we tax the income?
I mean, everybody knows what I'm going to say. Lower the rate. That's that you want to draw income, lower the rate. It's going to impact every sector of the economy.
Right.
Sure, because I mean,
Just get under them. Yeah.
There's right. They'll come here instead. I mean, if you know, we do a tourist brochure, right, of Western Ireland and Puerto Rico and other places. Like low rates drive and draw activity.
Right.
Yeah, well, look, if we move to consumption tax, that's a different question, which is fundamentally what a withholding tax on customer use. That's just, a VAT that's politically more popular because it goes on somebody else's invoice. So if we move to consumption tax, I totally agree. I don't know, if we don't want other countries to have consumption taxes on their own people, then, maybe I don't know, we need to bring back $8.99 or something. But in terms of income, I think lower the rate.
So I don't know that I disagree with Nate on this. I would just say, maybe to offer slightly, maybe to use a few more words than lower the rate. I think we want to capture primary taxing rights over what comes out of that, and we want to discourage other countries from essentially trying to poach it away from us. And broadly speaking, I think that's what Treasury's trying to do right now. Now, they're not limiting it to AI, but they're thinking about this in the context of the constructive dialogue at the OECD around, what problem are we trying to solve? Because if all you're trying to do is pick my pocket, I'm not sure I'm interested in that. I feel like that's the direction of travel to capture this income going forward. So have a regime that's attractive for capturing the income and therefore the taxing rights associated with high value intangibles. And try and limit the extent to which other countries encroach on that with various forms of novel forms of taxation that try and pull that taxing base over to the market jurisdiction. I'm not sure there's a better way to come at it than that, at least not what I know.
So this might be a good place to stop because we heard broaden the base and lower the rate. Do we have another question? Oh, we got one more question, but pretend that we stopped on lower the rate and broaden the base, and then I'll turn it back to Kyle.
One element of these tax incentives I find really interesting is the spectrum from refundable, transferable, and then I don't know what the word for it is, but soft transferable, if you can get around the economic substance issues.
Right.
And then all the way to strict non-refundable, non-transferable enforcement, right? And so it seems like the refundable transferable approach is kind of, my interpretation is it's more of a contemporary federal thing. Historically, most of these were designed on the other side of the spectrum, and my understanding is at the state and local level, most tax incentives are still the non-refundable, non-transferable. Are there principled ways that we should think about which bucket to put in a tax incentive?
Boy. My immediate reaction to the transferable, refundable question, which is sort of a cop-out answer, but welcome these guys' thoughts. I think, Nate, it goes to the portion of the paper that you worked on, which is the Congress has historically been allergic to transferable, refundable credits because of the concern about fraud. And I think, I don't have a lot of experience to speak to in terms of how well-founded that concern is, but I do think one of the things in this space that has influenced historically the approach that Congress has taken, and by the way, I think was one of the things that when you talk to Republicans who didn't like some of the Inflation Reduction Act credits, they would say, this is one of the things that we are concerned about. So I'm not really answering your question, but I do think that sort of the allergy on the part of Congress, and maybe some state and local governments as well, I don't know, but on the part of Congress to making these credits more broadly available is, so here's the thing. You can fill out a piece of paper and the government sends you money.
Right.
That seems pretty tempting to a lot of people, right? And so I think that's broadly speaking why we haven't done as much of this. But look, as Michael's analysis shows, I mean, when you make the credit more broadly available, you get more uptake of it, right? Yeah. So, I mean, but I don't know, what are your thoughts?
And I don't know whether this is borne out empirically or not. I have no idea. But a theory for transferability as compared to refundability is that the buyer has the ability and the incentive to check to see that the project actually exists.
Right.
Whereas the IRS would never look at it until 3 years, 4 years down the road when the person might be gone. Right. And so the idea was that the concern about fraud would be ameliorated to some extent by transferability while getting most of the benefit of refundability, which at the end of the day is really just making a credit a lot more like an explicit subsidy, and the good and bad that comes with that.
Yeah, I think my experience would bear that out too, right? I mean, transferability, just to say the same thing slightly differently, externalizes enforcement cost onto the private sector, and maybe that's a good thing, just because it tends to work.
Okay, great question. Thank you to our panelists, and Kyle's coming back up to close us out for the day.
All right, that's a wrap. Thanks for joining us. I want to thank all of our panelists. The discussion was great. I also want to thank Pat, Mindy, and Paul, my co-organizers for the event. I think it went well. Before we go here, 3 things. 1, slides will be available, so if you're interested in that, let us know. There will also be recordings of the event on our website on the event page. And lastly, don't forget, we also, each of the sessions are putting together papers on their respective topics. Most of the papers, I think, at this point are drafts. They're going to be published later in the year, and we will keep people up to date on that. And with that, we're all set. Thank you.